Good morning and welcome to the first trade for Tuesday, June 30th. I'm Brian Sozzi. My co-anchor Alexis Christophorus has the day off today. The second quarter is coming to a close today, and the market is trying to keep its rally vibes going in the face of mounting grim news on the COVID-19 pandemic. Here are the stats. Worldwide cases now top 10.4 million with nearly 510,000 deaths. While here in the U.S., more than 2.6 million people have tested positive for the virus. And as I just mentioned, the news is getting pretty grim. Again, this morning, World Health Organization is warning that the worst of the coronavirus pandemic is yet to come. This comes as more governors roll back reopening plans, and at least 30 states are seeing infection numbers surge. And now Dr. Anthony Fauci, the nation's top infectious disease expert, will be testifying again before Congress today. Dr. Jennifer Ellis is on the front lines and in a Los Angeles emergency room and is seeing the latest surge firsthand. Dr. Ellis, good to see you again. So we talked to you back when this pandemic began. What are you seeing in the hospitals right now? And can you compare and contrast what you're seeing now compared to the start?
Thank you for having me, Brian. What we're seeing right now is an enormous number of people coming back. Our surge capacity is extended. We're starting to see people coming in again with what we know to be, the beginnings of another big surge. So it never really went away for us in Los Angeles County. We had been a hotspot throughout, but I think the rest of the state had maybe started to think that they were that the worst was behind them. But starting about a week ago, we began to see some cases trickling in, and then it started to look more and more like the early days of March.
Dr. Ellis, what the market seems to be, at least from an investor standpoint, is starting to focus on now, I think, is hospital capacity. And I have a good stat here. Houston-based Texas Medical Center, largest in the U.S., 95% capacity. What are you seeing in your hospital right now? Are there enough beds? Is there enough equipment? Are there enough ventilators?
In our hospital, there is. We are having in Los Angeles and in California, we have a little bit of one of our counties, Imperial County, being overwhelmed. And, our hospital system that I work in, we have been in the past able to move patients around in order to accommodate as we had surges in different areas. I think what's a little bit concerning right now for the entire state and for the entire country is that with the recent openings and elective surgeries going on, this is going to be a little bit more of a challenge than perhaps the beginning of the first wave in March.
Dr. Ellis, Jared Blicker here. Just want to follow up on a point you just made. Elective surgeries, we saw those kind of go by the wayside for several months. Is there any chance that those are going to be canceled again for any intensive purposes here?
I think certainly in some of these hotspots like Houston, possibly in Los Angeles County, I think that those are going to be under review again, especially given the fact that hospitals have ability to move patients around. ICU beds can be extended, ventilators can be extended and moved around from place to place, but staffing is difficult, and especially as some of us become ill from treating these patients. It becomes a challenge in the sense that if we're continuing to operate as normal and doing elective procedures, then there's going to be fewer and fewer resources available to treat these patients. So I anticipate that will probably be re-examined going forward.
Doctor, news just hitting the wires now. The FDA has laid out guidelines for COVID-19 approvals. They only have to be vaccines, that is, 50% better or more effective than a placebo. But when you take a step back, what's the risk here with some of these early vaccines about putting them into our bodies? Should we be putting them into our bodies?
Well, let me just start by saying that vaccines as a whole, there isn't really a concern for putting them in your bodies once they've been approved and tested appropriately. I think that the concern here is that there is a desire all over the world for us to sort of rush some of this research and get a viable vaccine as quickly as possible. I think everyone's sort of pinning their hopes on that, but we can't really. That's not something that I would definitely say by next year is going to be a reality. And given that once all the clinical trials are completed, there is also the question of distribution and acceptance. So these are formidable challenges in and of themselves. Just even if we had a vaccine right now, ramping up production and distribution would be formidable. So to think, I've seen a lot of folks saying that we're going to have a vaccine next year. I think that that's very optimistic, and what the FDA did today makes sense, but I don't think we can really count on that anytime soon.
Dr. Ellis, bottom line is for us, based on what you're seeing in the hospitals and in the spread within families, what's your outlook for the winter? Will we go back to where we were in the spring, or will it get worse? Will it get better?
I mean, every year for us in the medical community, the winter is always a surge and always a challenge. This winter, I think a lot of us are bracing ourselves for what could be one of the greatest challenges of our careers and, in fact, our lives. Because when there is also influenza circulating and all of the other respiratory viruses that affect people, there's going to be a greater need for diagnosis, for testing, for treatment above and beyond potentially what some of these hospital systems can manage. So for the winter, there's concern, but I'm also just concerned for the next couple of weeks because we know that deaths are a lagging indicator. And so from what I'm seeing right now, I think that unfortunately there's going to be a lot of death coming.
All right, let's leave it there. Dr. Jennifer Ellis, good to talk with you again, and please stay safe out there.
Thank you.
All right, let's bring in Sevens Report research founder Tom Essay. Tom, you just heard, always good to speak with you. You just heard the doctor speak. This situation with the pandemic is not getting any better. States are starting to close down. You have the market closing out the second quarter, really one heck of a rally. Do you just think the market is overextended?
Hi, Brian. Thank you very much for having me on. Yeah, in the short term, absolutely. I mean, we've seen a huge move in the second quarter, and to be fair, it's been driven by a lot of positivity, right? If we think about where we were at the end of March, we've come a long way, not just with the virus, even though we're seeing a rebound now, we've made some major progress there. And then also the economy is starting to bounce back. But in the near term, you have a market that's really, I don't want to say it's priced for perfection, but it's a bit complacent because, as the doctor just said, the virus count is rising again. That at a minimum is going to delay the economic reopening, and markets have to price that in a bit. And I think that there's a bit more for that to happen, at least a churn sideways or a further dip.
Hey, Tom, it's good to see you here. We've seen the city economic surprise indicator just shoot to record highs in a very short period of time. We got the payrolls report on Thursday. Do you see any kind of slowdown in the data? If that were to materialize, what effect would that have on markets, given that the market is almost accustomed to these big surprises now to the upside?
Yeah, hi, Jared. It's the City Economic Surprise Index. You have to remember that's basically it compares what the actual data is versus what the expectation was. And we are in a whole new world of trying to model what data is going to be, because there's not an economist in the world that's ever gone through a forced economic shutdown. And that's why a lot of these numbers are completely blowing past what the expectation is. Now, as economies pause on their reopenings, should we expect to see that data come in a bit? Absolutely. And we also have to remember that while data may look great month over month from May to April or June to May, go look at it 12 months prior. It looks horrible, even with the increases. So I think that's something that investors need to make sure they realize, especially on Thursday. You're going to see a blowout jobs report, but just remember, we're still going to be net negative 10 million plus jobs over the next 3 months. The one counter to that is that there's tremendous government stimulus. And as long as that stimulus stays active, then the true reality of the economic pain isn't really going to filter through to markets.
All right, Tom, stick around. We're going to have you back later on the show. Appreciate those early insights, though. We do have some heavyweight companies out with earnings that we do want to go over. Let's bring in Yahoo Finance's Emily McCormick to break down the numbers. Emily, Conagra out with earnings this morning. Pretty darn good quarter for frozen food. And you know what? Chef Boyardee too.
Absolutely, Brian. So taking a look at those shares, we do have Conagra stock popping in the pre-market. It is on track to actually turn positive for the year to date if it holds on to these gains. And we did see a beat on the top and bottom line for its fiscal fourth quarter. We saw net sales at $3.3 billion, above expectations for $3.2 billion. And that was up 26% for year over year. And we also saw adjusted EPS beating expectations. Now, CEO Sean Connolly said, quote, "Our business clearly benefited from increased at-home eating in the fourth quarter as the elevated retail demand outweighed the reduced food service demand." So we saw net sales in ConAgra's grocery and snack segment up 44% to $1.5 billion for those 3 months ending May 31st. The company also highlighted a couple brands that were standouts during the quarter and saw double-digit organic sales growth. And those include canned and packaged goods like Chef Boyardee, Hunt's, Libby's, Snack Pack, and Slim Jim. Though on the flip side, as mentioned earlier, we did see some weakness in the food segment. That revenue did fall 28% to $193 million, impacted, of course, by restaurant closures during the quarter. Now, ConAgra did note that the pandemic impact on the current year, fiscal 2021 results remains uncertain, but it does expect to see its retail and food service demand trend back towards historical norms as the fiscal year progresses. So again, we are seeing Wall Street really liking these results, and those shares are popping.
Yeah, Emily, you just kind of reminded me. I haven't had a Slim Jim in about 20 years. Might have to give that a try again. But I do want to talk some Micron. In their quarter, they came out last night. Margins down, but stock's popping this morning. What do you see?
Well, we still saw their adjusted revenue well above expectations at $5.4 billion, also a year-over-year gain. So although we did see some margin pressure, at least that top line was intact and stronger than expected. Micron also believes that it's going to continue seeing this momentum from last quarter continuing into the current quarter. We saw Micron posting record quarterly revenue from its solid state drives, which was driven by a more than doubling in its cloud SSD drive revenue on a quarter-over-quarter basis. We also saw a strong in its data center and networking business. Its cloud DRAM sales saw strong demand due to work from home, online learning, and more activity in the e-commerce space overall. And we did see a bit of a slowing down in auto revenue, but also want to point out that their mobile business grew on a year-over basis, even given some smartphone demand weakness for that end market. We do have Micron shares down 8.6% for the year to date through yesterday's close, but those shares are pairing some of those losses in pre-market trading. They're just over 5.5% now. Brian?
All right, Emily McCormick, thanks so much. Let's head overseas now and check in with Tom Belger. Tom, good to see you this morning here. We got a new data on the health of the UK consumer. What do you have for us?
Yeah, The Economist had a front page recently on the 50% economy, the 90% economy even, that we were going to see after lockdown. But as I've just given away there, the latest retail figures for the UK show it's really a 50% economy. That's how much footfall is down in UK shopping centres last week compared to a year earlier. It's a big improvement on the 80% declines you were seeing I think a couple of weeks ago, just before the UK lockdown was eased. But retailers are really saying that shows the recent reopening is no magic bullet. And the focus now is on what policymakers, what more they can do to stimulate recovery. So we have Boris Johnson, Prime Minister today, vowing to build our way out of this crisis, even comparing it to Roosevelt's New Deal. But it's not actually new money he's announced. It's not clear the stimulus will be big enough. And it's not until next week that we'll get a bit more detail on what those plans involve. Brian.
And Tom, I know the Yahoo Finance UK team is continues to file or just follow this Wirecard scandal. But you have some good news for us potentially on the Wirecard scandal.
Yeah, we're really seeing the ripples outside Germany now of this scandal. Firstly, some good news, as you say, regulators have lifted their freeze on Wirecard's UK arm. That had left thousands of customers of UK fintech firms that use the payments provider without cash over the weekend. So some real difficulty for a lot of customers. But the watchdog has now lifted that, so they've got access to their money. And in the long term, it says that money is now safe in protected UK bank accounts. We also saw Wirecard North America saying yesterday their division is up for sale. And just lastly, growing attention on regulators' role in all of this. The Bank for International Settlements has come out saying we may need more joined up rules in the payments sector. Brian.
All right, Tom Belger, good to see you. All right, do stick around. Much more ahead on the first trade. We will dive into the advertiser revolt that continues against social media giant Facebook. All right, welcome back to the first trade. Many household names are joining in the hashtag Stop Hate for Profit campaign and promising to stop spending money on Facebook ads this month. Starbucks, Coca-Cola, Ford, and our parent company Verizon are among the most recent companies to join the growing movement. Joining us now to discuss how this will financially impact Facebook is Futurum Research Principal Analyst Daniel Newman. Daniel, always good to see you here. And I would say this, for the first time, Facebook shareholders, I wouldn't say all of them, but a good majority of them finally understand that this company might make less money because of this backlash. This has been the Teflon stock for so many negative things against Facebook, but that is not the case here.
Yeah, you said that exactly correct, Brian. 8% last Friday, we saw this thing drop off, and people are reacting. I mean, right now we've had a turbulent quarter from coronavirus to the ongoing Black Lives Matter protests, and we're facing, more and more people are expecting to see real meaningful change. And Facebook, like you said really well, Brian, has been through a number, the Cambridge Analytica scandal. The company has been through a number of different advertising, data tracking scandals, and people have just kind of let it all bounce off them. This time people are saying no, and that was why we saw that big 8% sell-off. Having said that, though, it's definitely going to be a challenge as these big companies, Brian, the top 100 companies that advertise on Facebook only represent about 6% of the ad revenue for the company. So while it's great to see it because these big companies have a lot of influence, it's going to be interesting to see how long these companies can hold out and can more companies join into this boycott to really make a bigger impact to Facebook.
Daniel, can you give us a number? This list, I've seen a list out there on social media approaching 250 companies that will not be advertising on Facebook. Can you give us a number? What's the revenue hit? Is it in excess of $1 billion this year?
Like I said, as I was reading it, the number does appear that it could be. But again, you have a lot of non-committal companies, Brian. You have companies saying they're going to do it for a month. You have some companies saying they're doing it, but they're not necessarily part of this movement. They want to see better from Facebook. They want to see a conscience from the company. They want to see meaningful change. I don't know if you remember this, but in 2017, YouTube had a boycott as advertisements were showing up next to hate content, and advertiser after advertiser started pulling out, and there was a big reaction. And oh my gosh, what's going to happen to YouTube? And then YouTube made a small modification to its ad policy, and I think most people have forgotten it. I think honestly, 3 years later, most people have forgotten that YouTube went through this and Google is back to normal. So I think what we're really hoping for here is that Mark Zuckerberg, who has a lot of control over the direction of the company, takes some real action, shows some real prerogative to mark hate content, to give advertisers more choice over where their advertisements show up, and to really push for a platform that isn't used to create abuse and to spread hate. And I think advertisers will come back, though, because Facebook's been such a critical channel for these companies. And that was actually what I said about that next wave of companies, Brian, beyond those big companies. I'm reading a lot about it, and they're saying, like, look, we want to be part of this movement, but we simply cannot afford. Our businesses will not survive because advertising on Facebook has become so critical. So what I'm really hoping to see is a significant commitment from Facebook to do better, but it has to be more than words. Because Facebook does every time they run into this hurdle, they say something and everyone goes, oh, okay, back to it, stock goes back up. This time I'm hoping those words become real meaningful actions that sustain beyond this election.
Hey, Jared Blickery here. Yeah, we've seen the stock plummet and every time seems to recover to new highs. But in the longer term, I'm looking forward, what are the potential for this to be the defining moment? We've seen changes in leadership at Instagram. Is it possible there's going to be some kind of internal revote that kind of propels this forward?
Yeah, I don't think Mark Zuckerberg's going anywhere. He obviously has set himself up in a very good position with a lot of control. I think we are seeing, though, a pivotal moment where this protest and these defining moments within tech companies saying we're not just going to talk anymore, we're going to do things, we're going to take actions, we're going to make investments, we're going to stop partnering and advertising. I think if these companies can sustain beyond this month, I think when it really starts to hit shareholders, that's when companies make changes. Companies make changes when it starts to hit the bottom line, when investors and shareholders say, you know what, I'm going to put my money in Netflix, or I'm going to put my money over in Amazon or somewhere else than Facebook. So to your point, is this the moment? I think only time is going to tell, but we are going to see some of the most interesting, responses between now and November. And between now and November is going to be a defining period of time of whether we're going to rectify all this toxicity that exists within social media. And it has to start with the companies. And I hope, Jared, that this is a chance, because this is a great opportunity. Right now is that inflection point, and we can make the internet better.
Daniel, I have 20 seconds left here. So just based off of Facebook's struggles, from an investor standpoint, do you take money, put cash to work in a Google or a Snapchat?
Well, I am an industry, not an equities analyst. I really do think Snapchat's doing interesting things. Google's great, but Snapchat's been interesting, and they've been passionate, and they've stood by their ground. We've seen that from their CEO.
All right, we'll leave it there for right now. Daniel Newman of Futurum Research, always good to see you. Talk to you soon.
Thanks, Brian.
All right, do stick around. Much more ahead on the markets on the first trade. All right, welcome back to the first trade. Let's get right back to Jared Blickery for a look at oil, the dollar, copper, commodities, a whole bunch of stuff. Jared, yesterday we had the Chesapeake bankruptcy. Today we have oil taking a massive Shell actually warning of a massive write-down.
Yeah, it looks like everybody's taking their lumps now. Shell is, RDS is warning that they're going to write down between $15 and $22 billion. That would be the biggest write down in their history since their merger in 2005, basically the creation of the new company. And just an example of the carnage that's really hit the energy market. Looking at a chart here, it's down about 3-4% in the pre-market. But just check out a year-to-date chart. A lot of the shale players are getting it hit pretty hard, but even the majors, who do you think would be able to scoop up some of the smaller guys, having some balance sheet issues here. We can see they're 43% down year to date. But just taking a look at some of the other markets that are open right now, we have tech and communication services, the least bad. We can see a lot of red on this board. Apple's down about 0.5% in the pre-market. Facebook only down about 1/4 point, just talking about them and the potential fallout from their advertising revenue. But energy really getting hit the hardest in financials as well. So let's go to some other charts. And actually, let's go to the US dollar index here. And we can see it's been on the rise. This is actually a 1-month high in the Dixie. So we want to take that with some perspective because it's been in a trading range and it's at the bottom of its trading range right now. So it could go materially higher. And if that happens, that's going to put pressure on the entire risk trade globally. Let's take a look at gold futures, and we can see those have been on the climb here, on the prowl. This is basically an 8-year high. We had the record close yesterday, biggest in 8 years, and we're seeing a lot of strength in the safety trade, also bonds. So I want to take a look at the 10-year T-note yield, and we can see on a 2-month chart, just hovering below support. We finally broke down, and this would be the 65 basis point level, and we're trading at 62 basis points right now. The yield curve is compressing, so all of this put together, the dollar strength trade, the sell-off in yields, you put it together, and we're having a little bit of trouble getting the risk markets off the ground this week.
Huh, that is one wild move in the dollar. All right, do stick around. We will be right back on the first trade with the opening bell and another look at the markets. All right, welcome back to the first trade. You're seeing the last day in the quarter, and market trying to figure out if it's going to close on a high note. I will note this now. Here's the opening bell. Our parent company, Verizon, bringing it. All right, and here are the headlines making the first trade front page today. China is implementing a national security law against Hong Kong starting immediately. The law, which is vague at best, would criminalize secession, terrorism, sabotaging the Chinese government, and working with foreign countries in any capacity. It's considered the most radical change since Hong Kong returned to Chinese rule 23 years ago. New York City Council will vote today whether it should slash part of the NYPD's $6 billion budget. Mayor Bill de Blasio wants to cut $1 billion, but fireworks are already taking place outside City Hall. Protesters, some of which have been camping out in City Hall Park for a week, are rallying people to defund the police. And Walmart is dropping All Lives Matters merchandise on its website. The items, which are sold by third-party vendors, were taken down after employees and customers told executives they were concerned about the meaning behind the items. Walmart released a statement saying it minimizes the focus on the painful reality of racial inequity. All right, I want to bring back in Severn's Report Research founder, Tom Essay. Tom, thanks for sticking around here. It's the last day of the quarter here. Market has had a big rally, but again, I go back to what Dr. Ellis told us at the top of the show. If we do see another spike in infections later this year in the winter, no way has the market priced that in. When does it price it in?
It's in the next coming months, essentially. And thank you very much for having me back on. You know, we always expect that sort of the next time will be like the last time. So I think that to a point, markets are expecting some sort of an economic shutdown. They're not getting it. And that's why markets are to a point looking past this surge. But really, we need to get the economy going. And I've been talking about this in the Sevens report. It's not so much about the case count, it's about the economy. And if the economy can kind of soldier on here while cases rise, things will be all right. But if we get into the winter and you see more economic shutdowns, then yeah, this market is way over its skis from a fundamental standpoint.
Hey, Tom, we are at the quarter end right now. I'd like to get your thoughts on that. And also heading into earnings season, what do you see unfolding over the next couple of weeks in the markets?
Yeah, what a quarter, right? And typically when you have a big quarter like this, the last day of the quarter will generally close sort of flat or positive because nobody wants to give up any gains and on the last day of the quarter. And then usually the quarter that comes next starts out a little bit rough as people reposition once the numbers are in the book. So we'll see if that happens. But looking at earnings, nobody knows what the numbers are going to be. The key really is guidance and whether or not companies are willing to commit to guidance. That's what we're going to be focused on is, do these companies have enough visibility to say, listen, here's about where we think we're going to be the rest of the year, and then especially into 2021. Right now that we're seeing some of these economic reopenings pause, I'm nervous that we will not get much guidance. I think that could be a negative for the markets.
Tom, Goldman Sachs out with a note this morning, pretty hot note circulating trading desks, that if masks aren't worn, 5% in GDP could be shaved off of the U.S. economy this year. I don't know about you, but I don't see a lot of people wearing masks by me. Sure, there's large crowds of them, but I'm in New York City. I still see people walking around without a mask. What is the downside risk? Do you think it's actually 5% or it could be more? Because clearly many people across the country are just not wearing masks.
Yeah, I think we have to err on the side of it being more, right? I mean, I love Goldman taking a stab at this. I think that we have really stretched the bounds of modeling at this point, right? We talked about that a little bit in the previous segment with expectations for economic data. Nobody knows what's going to happen with this because we really still 4 months in don't know much about this virus. It's sort of shocking how much we're getting conflicting information 4 months in and 10 million people infected. But at the same time, I think as an investor, especially as you look at over the medium and longer term, you have to err on the side of caution because there has been a big rebound. I mean, Nasdaq is up multiple percentage points year to date in the biggest pandemic in 100 years. That's great. That's awesome. But do we really think it's going to run 30, 40, 50% return, with everything that's going on? So I think that you have to err on the side of caution. I think Goldman's note reiterates that.
Jared, let me get over to you. The market opened down. The Dow opened down about 100 points, but we're seeing a little bit of a comeback here.
Yeah, we're seeing the S&P 500 just barely crawl into the green. Looks like the Nasdaq is leading the way here. That's fairly positive. And just looking at the heat map we have here for the Nasdaq 100, kind of a mixed board, but more green than red. The FANG stocks really carrying the day here. They're outperforming, and we have kind of a safety trade going on, like we were talking about before, with a surge into bonds and gold, depressing yields. And we'll just take a look at the leaderboard here on the Nasdaq. We can see Lululemon and Micron topping the list here. Lulu, of course, merging with Mir, and then Micron reporting on earnings better than expected. And chip names are following suit. They're doing well. We see Western Digital up over 4%, AMD nearly 3%. To the downside, seeing some weakness in retail and also travel stocks. Marriott, Dollar Tree, United Airlines, Ross, those are all lagging right now. And then looking at our sector map here, we can see real estate, utilities, financials, and tech are leading. Kind of an interesting mix, but more defensive than not, and reflecting those lower yields. And then energy, industrials, and discretionary are the biggest laggards. Checking out some other groups, we already hit energy, so we're going to go to the software space. This has been kind of a bastion of strength. It's also in that growth mode that gets some dollars allocated to it when we have depressed yields, and we can see lots of green there. Zscaler up over 1%. And then finally, a more comprehensive map of the travel space. Not a lot of green. The Royal Caribbean, Carnival, they're down 1%, and the airlines are largely down too. But really not a lot of movement here. I'm going to say overnight was pretty choppy, and it's been low volume. We'll have to see what happens into the close here as we close out the month and quarter.
Tom, so many people on the street have been focused the past couple of days on the rising COVID infection numbers, but lost in the sauce yesterday, I think, is a very important headline. Joe Biden telling folks during a fundraiser that he will definitely raise taxes and reverse the Trump tax cuts. What do you think? How bad on a scale of 1 to 10 would President Joe Biden be for the markets? Just based off of those comments, he's telling the market, "I'm going to raise taxes. Corporate profits will probably be lower."
Yeah, so we have to go back to 2017, right? The Tax Cuts and Job Act essentially added $20 of earnings to the S&P 500, which in many ways underwrote this huge rally we had seen up until the coronavirus pandemic. So let's say they don't get all, they don't take away all $20 of earnings. The taxes don't go back to pre-2017 earnings. Well, they're still going to go up as if there is a blue wave. So I think that there's easily 10% sort of longer term earnings risk in this market right now. And I think that that's something that the markets are looking past. It's shocking to me with some of these poll numbers that where there is not more focus on November. And I get that the 2016 was a big surprise. I get that the polls were to a point similar in 2016, although not this bad for President Trump. But I think definitely in this quarter, you're going to get to see markets start to look up and say, wait a second, what if not just there's a Biden presidency, but a blue wave? And it's the blue wave that markets will really begin to react to. And by that, I mean the Democrats taking the presidency, the Senate, and then maintaining the House.
Yeah, we've seen the VIX contracts for October and November elevated for some time right now. But I want to shift to the banking sector. We got some news after the bell yesterday about dividends following the stress test results that we got last week. Of the big banks, only Wells Fargo, it looks like, is going to have to cut their dividend. What are your thoughts on sending money out to shareholders in these times when we could have a second wave down and the banks might need that capital?
Well, I think this is a tough balance, right? Because the shareholders need the capital too, right? A lot of these people own the banks for the dividends, and they need them. So I think it's a tough mix. I think that from an investor standpoint, as I look at the banks, I believe they're solid. I believe there's a Fed backstop. I don't think you have to worry about anything 2008, 2009 coming down the pike. But at the same time, what's the catalyst? Right? Why do I want to allocate money there as opposed to, say, tech or something like that? Because I don't see yields rising anytime soon. And then now you have the banks, under more stringent requirements, really, from the Fed and from the government during these uncertain times. So for me, it's sort of what's the growth catalyst, and I just don't see one in the banks.
Tom, before we let you go real quick, third quarter market prediction.
I'm hoping for a choppy quarter that we don't see a ton of volatility, right? We crashed in Q1, we surged back in Q2. I think it would do everyone a lot of good if we sort of had a normal quarter. I think we chop sideways ahead, looking forward towards the election in Q4. I think Q4 volatility picks up again.
All right, Tom Essay, founder of the Sevens Report Research. Always good to see you. Have a great July 4th weekend.
Thank you, guys. You too.
All right, and some breaking news just crossing the wires and some sad news coming out of Hollywood. Comedy legend and Dick Van Dyke Show creator Carl Reiner has died at the age of 98. Do stick around. Much more ahead on the first trade. All right, welcome back to the first trade. We've got our eyes on housing this morning. The latest S&P CoreLogic Case-Shiller Index shows home prices shot up another 4.7% in April, with Phoenix, Seattle, and Minneapolis leading the way. Let's talk about it now with Craig Lazara of S&P Dow Jones Indices. Craig, always good to speak with you here. So wrap this in a bow for us. What's your read on the housing market as we enter the summer?
My read is that it is remarkably strong. As you said, Brian, the national average is up 4.7%. It has been the rate of increase of housing prices has been rising, accelerating slowly since last fall. That's reflected not only in the 10 and 20 city composites, which we also maintain, it's reflected in the data from every city that we monitor. If you look very hard for evidence of a coronavirus impact on housing prices, it's to me almost impossible to find. The one evidence that something is amiss comes from the fact that we do not have data this month from Detroit, from Wayne County, Michigan, which is the biggest county in the Detroit metro area. Small enough that we can still do the national averages. But if you look at the 19 cities for which we do have data, prices increased year over year in every one of them. This has been that's been the trend for the last several readings, of course. And so to put a bow on it, the market is strong and stable and doing remarkably well.
Jared Blickery here. You look at what's happened since the COVID sell-off began, and I'm just wondering, is it possible that we're seeing demographic trends and structural changes that are simply invigorating the housing market? In other words, people fleeing the cities and really trying to buy up property in suburbia. Does your data get granular enough to analyze that and confirm that trend?
Craig.
Yeah.
Yeah. Do you think just in terms, that one was for you, just in terms of demographics, to Jared's point, do you think we've started to see anything in your data suggests we've seen demographic shifts based on or just because of the COVID-19 pandemic?
The data at the level that we look at them, you really don't permit us to make any conclusions. Now, anecdotally, I can tell you, and this is a small sample, and don't trust it because it's only one observation or set of observations. But I live in suburban Connecticut, and I can tell you every real estate agent I know is very busy. So the implication of that, and I gather that's true in many places, the implication of that is that many probably younger households who were renters in big cities are thinking, given the difficulties of city living in a time of virus, and given that we may be a long way away from a normal return to office environment, perhaps it's time to do what they probably would have done eventually anyway, and move to the suburbs. So part of the strength that we're seeing may be, and I stress maybe, it's really speculation, an above average conversion of renters to buyers, perhaps spurred in part by the difficulties posed by living under quarantine.
Craig, anything in the data, 4.7% price increase, that's pretty good. Anything in your data suggests that the Fed's easy money policy is just causing a lot of people to move aggressively into the housing market, and there are signs of some form of bubble starting to emerge?
Again, the data don't let us address that directly, but I think directionally you're correct, Brian. Certainly mortgage rates are at or near all-time lows, and obviously the lower rates are, the more affordable a given housing price is. So it'd be hard to argue that the Fed is not helping to some degree. I would go. It would have to go a lot farther than this and be a lot bigger for me to think about classifying it as a bubble. I mean, when in the years, when we look back at say 2007, early 2008, when there really was a bubble, housing prices were going up in double digits for in that period of time. So we're well below that level at this point.
When you look at the various levels of housing price, from starter homes up to the luxury space, what kind of trends are you seeing there? Any one particular group doing better than another?
Craig, that one for you.
Sorry, I can't hear Jared at all. I can hear you.
Craig, maybe you could just explain, like how are these transactions getting getting done. We're all quarantined, so to see prices gain as much as they have, I think for a lot of folks out there would be surprised.
They're getting done, I think, in the normal way. Now, obviously, it may be harder to do open houses in a way that would have been done a year ago, but the data are coming from the same sources, and the transactions are being done in the same way. I think part of what we in the Northeast probably are biased by is that New York, having been the epicenter of the pandemic, is shut particularly tightly. In other areas, maybe a little bit more like normal. But at the same time, as long as you, I mean, my impression is as long as you make an appointment to see a new property and wear a mask and wash your hands and keep your distances and things like that, it's still possible to see houses, and obviously transactions are still going on.
All right, we'll leave it there. Craig Lazaro of S&P Dow Jones Indices. Always good to see you. Have a great weekend.
Brian. Thank you.
All right, do stick around. We will be right back with the CEO of L3 Harris. That's up next. All right, welcome back to the first trade. Despite the coronavirus pandemic bringing the U.S. economy to a halt, the government continues to push forward with new defense deals. Defense contractor L3 Harris Technologies just won one of those big deals. And here to discuss that much more is L3 Harris CEO Bill Brown. Bill, good to see you this morning. So you were among a group of 5 companies to secure a almost $1 billion contract with the U.S. Special Operations Command. How did you get this bid when so many parts of the economy are closed down and things aren't functioning normal?
Yeah, it's a very special award for us. It was won by our Aviation Systems business segment. It's for medium endurance UAS for special operations, as you mentioned, something we've been working on for quite some time. It was capability that was brought to us from legacy L3. Of course, a year ago, we completed the merger with Harris Corporation. We're very pleased with our position with special operations on that award, but many others. And in fact, what we're seeing this year is a lot of DoD is moving faster to put opportunities on contract to help the defense industrial base and the small suppliers through this path. And they're accelerating awards. This happens to be one of them.
And Bill, just to, I know you have exposure to the commercial airline sector. What is the, have you been able to sell any simulators? What's the 12-month outlook here?
Yeah, so we have a small business that performs in commercial aerospace. Is less than 5% of our revenue, performing both pilot training as well as avionics for military and commercial aircraft. And that business has been struggling since the beginning of the pandemic. You know, we see that business down this year between 35 and 40% on a full year basis. So from Q2 through the back end of the year, more like 50% down. Most prominently here in the second quarter, we'll see the third quarter maybe a little bit worse. It's going to be a while for that business to recover. But fortunately, it's a relatively small piece of the overall company. When we gave our guidance for the year back at the end of Q1, so in early April, when we gave our guidance for the full year, we brought our revenue guidance down by 2 percentage points. So we're still going to be growing 3 to 5% year over year organically, which is pretty special in this environment. And the only impact really was from the commercial aerospace business. We were able to mitigate the impact on earnings per share because we're accelerating our cost synergies. So even though the commercial aerospace downturn would have impacted us by about 50 cents a share, we limited the adjustments to guidance to less than 2%, less than 20 cents per share, because of, again, accelerating the cost synergies. For the year, we still see earnings per share up about 11%.
I want to get your longer term outlook for the commercial aerospace industry. 2020, kind of a write-off year, but we're seeing the airlines ramp up again. Are we going through structural changes that we might never recover from? Are you seeing kind of a bifurcation, as some other people do in the industry, between the leisure space and the professional space? Just what are your thoughts on the longer term trends here?
Well, first of all, we're not seeing any recovery really at this point in time. I think we're still at the front end of what is likely to be not a multi-quarter, but a multi-year phenomenon. And we're all adjusting to that. So again, we're a relatively small player in commercial aerospace. So I don't have a lot of visibility into what's happening between leisure and business, wide body, narrow body, between the two OEMs. But we play in the space, relatively small. We don't see a recovery this year. We think it's going to be multiple years for that business to come back.
Bill, just checking. I was checking on the pulse, just of your company on Wall Street leading up to the interview, and there still seems to be this optimism in what you're doing on the deal, potentially selling businesses and cutting costs, but there seems to be this lingering concern that rising deficits because of COVID-19 and a potential change in the White House might mean lower defense budgets. Do you share that concern on the street?
Yeah, no, first of all, we're performing really well in the integration. I think there's a lot of enthusiasm inside the company and on the street with the progress we're making on integration, not just cost side, but revenue opportunities. So we're actually getting some traction on revenue opportunities, and that's meaningful in the event that the budgets start to flatten out or come back down. So the way I look at this, we're here in 2020, the budgets over the last 4 years for defense spending are up about $100 billion, up 17%. It's been growing 4% CAGR over the last 4 years. It's at a record level. In 21, the budget's not out of Congress. It needs to go through the appropriations process. But it's supposed to be relatively flat in fiscal 21. And then beyond that, with a $4 trillion deficit this year, we could see a little bit of top line pressure in defense spending. That's possible. But what we're seeing is across both sides of the aisle, between Democrats and Republicans, and almost irrespective of who's in the White House, there is an appreciation that we live in a very dangerous world. The threats are growing. We know that China and others are becoming more assertive. And to adapt against that, the DoD has pivoted its spending more towards near peer competition through the National Defense Strategy. And you start to see that reflected in the budget. So the money is shifting around a little bit. It'll be roughly flat in fiscal 21. There's over $130 billion of unspent prior year funds. So you put all those pieces together, I think it's going to be several years until we see a downturn in defense. And then for us at L3Harris, as a new company, we're underpenetrated internationally. Only 20% of our revenue is international, so we have opportunity to grow there. We're a broader company going after a bigger mission set, so increase our share of market of the DoD spending. And the revenue synergies I mentioned earlier before will start to kick in another year or two. So we think we can still grow earnings per share even in a flat to declining budget.
All right, let's leave it there for now. Bill Brown, CEO of L3Harris Technologies. Good to see you, and we'll have to have you back. Lots to talk about.
Thank you so much.
All right, Jared.
Well, we got a mixed market, and it's tech to the rescue. Nasdaq is performing nicely, but the Dow is in the red, and the S&P 500 has now climbed into the green. Just looking at our Nasdaq 100 heat map, You can see the strength in tech here from Apple and Microsoft, both up under 1%. Amazon's up over 1%. Intel up over 2%. Those chip stocks are really doing well after the Micron earnings. You can see Micron itself up 5%, up 3% over the last 5 days. Lululemon up 7.5% after announcing its merger with Mir. And travel stocks doing even worse than they were at the open. United's down nearly 5%, Marriott off 2.5%, and Dollar Tree off 2%.
All right, thanks, Jared. And make sure to catch our very own Jared Blickery as he hosts Trading Stocks and Managing Risks in the COVID-19 Era, a special webinar for Yahoo Finance Premium members tomorrow, July 1st at 2 p.m. Eastern. Don't forget to check your email inbox to register. And one more quick promo, a programming note for Thursday. We will have our special June jobs report coverage right here on Yahoo Finance beginning at 8:29 a.m. Do stick around, much more ahead. All right, welcome back to the first trade. The second quarter is coming to a close today, potentially on a little bit of a whimper. Let's get right to Inez Ferre for a look at the markets and several stocks. Inez?
And Brian, we're taking a look at the airlines, which took a hit this morning after news that the European Union won't allow Americans to travel to Europe just yet as the European Union opens its border. So you can take a look at United, Delta, American, all of those are down on that headline. Also taking a look at Conagra, that is in the green today after beating on the top and the bottom line. The company saw a surge in demand for products as people stayed at home to eat. Retail demand outweighed a reduction in food service demand. And year to date, the stock has turned positive. And then just taking a look at Micron Technology, that stock is in the green, up more than 5% after its fiscal third quarter results. The company saw some margin pressure, but its top line came in stronger than expected from strong demand coming from cloud giants. And then just looking at Simon Property Group, that stock is up more than 1% after Simon Property declared a dividend of $1.30 a share. The company expects to pay at least $6 in dividends for 2020, subject to board approval. And also Simon giving an update on the number of retail properties that have reopened, with 199 out of 204 U.S. retail properties that have reopened across 37 states. Brian?
All right, thanks, Inez. All right, let's dig into the markets here a little bit more with Megan Horniman, Director of Portfolio Strategy at Verdance Capital Advisors. Megan, always good to see you here. So a note that has been crossing trading desks this morning is coming out of Goldman Sachs, really looking at the potential impact to GDP if we don't wear masks, and they're pinning that at 5%. What's your take?
I think there's going to be a lot of uncertainty around what type of GDP numbers we're going to get, regardless of whether that's wearing masks or not. Right now, with being in uncharted territory with the impact that we saw of second quarter and the decline that we saw, and a lot of uncertainty around what kind of a rebound we'll see. And you can see that in some of the dispersion between those numbers. I think that this is just one of many things that you'll hear as far as people trying to forecast what we're going to see in the third quarter.
Good morning, Megan. It's Heidi here. So going off of that, in terms of what to expect from the third quarter, I have to say the second quarter was quite impressive. All three of the major indices tracking for pretty good quarterly gains. But that being said, things are looking much different as we head into Q3 in the second half. The second spike in cases, obviously very concerning here. So in your position, should investors be getting defensive or should they stay offensive? And in your position, where should they be putting their money?
Mm-hmm. So we've been a bit overweight the global equity market throughout. We added several times in the bear market, but actually what we've done recently is take a little bit of chips off the table. And that's primarily because, just like you said, this has been a euphoria in the past, in the second quarter, where we had that huge decline in not only the equity markets, but also the growth indicators. And now we're seeing this, again, huge spike off of these really negative economic numbers and such a dramatic rally in the equity markets. This is euphoria that we think. Now, as we go into the rest of this summer, there's really several risks that we see that could pose a challenge for the equity market. So there's nothing wrong with holding a little bit of cash. Some of the risks that we see are first earnings. We're going to get a second quarter earnings season around July 14th, the week of July 14th. So while investors have given a pass for first and second quarter earnings, you really want to start to see guidance and what that looks like for the second half of this year. The other factor is that we're starting to see bankruptcies rise, specifically in the consumer and the energy space, but yet the high yield credit market is not really reflecting that from a spread perspective. And then there is the fact that the economic data, when you rebound off of such of a record low, then those numbers are going to be huge. They're going to look great. But once we get through July, August, September, and we're starting to look at those data on a month-over-month basis, they're not going to be as impressive at the headline level. And then lastly, remember that we are coming closer and closer to the presidential election here in the U.S. Now, while it's way too early to forecast anything that may happen, I think that if you look at some of the polling numbers, the markets may accept, a Joe Biden presidency, but I think the biggest fear the markets will have is if we look at a full sweep or the Democrats take the Senate.
Megan, Ines Foray here, and coming up to those elections, a lot people are expecting another stimulus just because it's an election year. Have the markets baked in another stimulus?
I think, yes, I think that partially they're baking in some form of stimulus. If the disappointment is the biggest concern right here. So when we're talking about additional stimulus checks, funding for state and local governments, if there is any disappointment or any political wrangling right ahead of this election, then that could definitely spook the markets as well.
Megan, we were talking about it in the top of the hour with another guest. Joe Biden came out yesterday at a fundraiser and said, I am going to raise your taxes. I am rolling back those Trump tax cuts. What's your take? When does the market start pricing that in?
I think as you get closer to the election, and if you start to see the probability of that Democratic sweep where they have both chambers, the House, the Senate, and also they have the White House, then I think that's going to spook the markets, yes.
Megan, I want to get your thoughts on what to expect this Thursday. Unemployment, obviously a big concern still out there. June numbers, what are you expecting? Is that going to impact markets at all?
I think that markets, they're going to, again, the employment number always impacts markets. It's always an important number. We're going to look at things like the underemployment rate. These are things that are important. But I think looking at some of the forward-looking indicators for the labor market are equally as important. One of the things that I continually look at is that continuing claims number, which has come down now for about 3 consecutive weeks. That's important because we want people to get off of unemployment. And then looking in some of the underlying survey data, whether it's from business sentiment, on what their hiring plans look like going forward.
Megan, Ines again. We had spoken to a doctor in the earlier hour who basically said that a vaccine anytime soon is optimistic. Are the markets disconnected from what's happening with the vaccine, what's happening right now with coronavirus cases spiking?
So the spike that we've seen in coronavirus cases is concerning, obviously, but it's not unexpected because of two things. When you look at states reopening as well as more testing, it's inevitable to see a spike in cases. The more important things here are we overwhelming our hospitals, which right now hospitalization rates seem stable and much better than they were in the pandemic. The death rate as well, which is also much better than it was during the pandemic and has been ticking lower. The most important thing when it comes to the coronavirus is that we know so much more than we did 4 months ago. So whether it's a vaccination, as you mentioned, or it's more therapeutics, we are much more equipped to handle this virus going forward. So as long as we can contain it and also keep the hospitals from being overwhelmed, that's the most important thing.
Megan, some breaking news here. The Consumer Confidence Index increased in June after no change in May. Are you surprised by how resilient the consumer has been? We're seeing a comeback in restaurant sales, retail sales have come back. It's almost not as if only the market investors are ignoring COVID-19. Seeing consumers, I would think a lot of them ignoring some of the risks.
I think that consumers, there's a couple things. They've been cooped up, so they're finally getting out and spending some of that money that they didn't spend. There's been a lot of reports about how much money certain Americans were able to save during the pandemic. So I think you're seeing some pent-up demand on things like furnishing your house, because now we have a lot more people working at home. So I think you got a lot of pent-up demand with consumers there. I don't think it's necessarily that they're complacent on this. I just think that they're able to get back out. You're seeing them come back out. And that's a positive thing, because coming into this pandemic, the biggest concern we had was we don't know the appetite for the consumer to come back. If the consumer doesn't come back, or they warp to that stay-at-home mentality, then that's a much bigger risk for our economy, simply because about 60 to 70% of our economy is made up of consumer spending.
Megan, real quickly, what's your biggest call for the third quarter?
So right now for the third quarter, we're patiently waiting for additional opportunities to enter into the equity markets, specifically in the US and developed international markets. But at this time, valuations just look a bit too frothy. So the biggest thing to do right now is be patient. There is nothing wrong with holding some extra cash in your portfolios, especially given the risks that I already mentioned that could arise in the summer months. So that's what we're doing right now.
Wise counsel as always. Megan Hardiman, Director of Portfolio Strategy at Verdance Capital Advisors. Good to see you. Have a great July 4th weekend.
Thanks, you too.
All right, do stick around. On the other side of the break, we will be right back with Restaurant Brand CEO, Jose Sill. All right, welcome back to the first trade. It looks like Uber's again looking to cut a big food delivery deal. It's reportedly in talks to buy Postmates for some $2.6 billion. Our Heidi Chung is on the food beat here at Yahoo Finance. Does this deal make sense for Uber, Heidi?
Well, Brian, what we do know at this point is that Uber's ride-sharing business has taken a big hit because of the coronavirus. And when we take a look at food delivery, the space is way too saturated. So a lot of folks out there, a lot of experts who cover the space have been expecting consolidation for some time. Remember earlier this year, there was that failed takeover attempt. Uber was trying to take over Grubhub, but those talks fell through after the two companies could not agree on a price. But now it looks like Uber has its eye on Postmates. Uber's offer is reportedly valued at about $2.6 billion. And sources told the New York Times that if it does in fact go through, the deal could be announced as early as Monday. Now, Yahoo Finance did reach out to both Uber and Postmates for comments on the reports, but we have not heard back yet. Even though Postmates, though, has been talking to possible buyers for at least a year, it also has been preparing for a potential IPO. Postmates confidentially filed for an IPO in February of last year, but then those plans were put on hold after the whole debacle with WeWork took place last year as well. Postmates was founded in 2011 and actually gained a lot of momentum early on in the LA area. But since then, the space has been super saturated. We have Grubhub, DoorDash, Uber, and now Postmates is one of the smaller players in the space. The crowded food delivery space, though, has been looking for potential consolidation. And like I mentioned earlier, Grubhub was a potential takeover target by Uber, but the talks fell through. And then eventually, European delivery company Just Eats came in with their offer and purchased Grubhub earlier this month for $7.3 billion, Brian. So a lot of questions out there whether or not this will happen. It's still in the talking phase, according to the reports that we have been seeing. So whether or not it actually goes through is another big question.
Heidi, on one end of the spectrum, we have Uber and Postmates potentially inking or joining forces in a $3 billion deal, nearly $3 billion deal. And then my morning started with seeing news on NPC International. Then this is a major Pizza Hut and Wendy's franchisee. They just filed for bankruptcy.
Yeah, NPC International owns about 1,200 Pizza Hut restaurants and 385 Wendy's, and it's looking to potentially file for that Chapter 11 bankruptcy protection as soon as Thursday, according to some of the reports that we've seen out there. The reports say that NPC missed interest payments on nearly $800 million in loans on January 31st, and as a result, S&P Global Ratings and Moody's both lowered their views on the company's debt. So it looks like there was definitely trouble brewing for NPC before COVID-19 even hit. And if anything, COVID-19 actually gave a boost to Pizza Huts out there, and a lot of delivery companies overall had seen a boost from the pandemic as well. Pizza Hut US recorded the highest delivery and carry-out average sales week in the past 8 years during early May. So even with that boost, NPC unfortunately could not deal with the debt load that it currently has. But Brian, we talk about the fast food industry a lot, and Pizza Hut unfortunately has been a laggard when it comes to Yum Brand's portfolio. It's been losing market share to Domino's and Papa John's for quite some time here. So whether or not it's going to finally be able to turn around its business by closing a lot of those dine-in restaurants, that still remains to be seen.
All right, let's get back onto a more upbeat story in the restaurant space. Sales are starting to sizzle again at Restaurant Brands' own Burger King as states reopen from the COVID-19 pandemic. We're going to talk about its road to recovery as Restaurant Brands CEO Jose Sil. Jose, always good to see you here. So I remember talking to you back when the pandemic started. You had the beer going on now. You don't have the beer going on now. Your sales were down mid-30s at Burger King. Now they're flat. How did that happen?
Hey, Brian, great to be here, and thanks for having me. Yeah, clean shaven today. Looking forward to summertime in Florida. Anyhow, we started, as I mentioned a few times when we've been on the show, when the pandemic hit, we got Burger King, Popeyes, and Tim Hortons, all of our brands here in North America, felt the pain. Our franchisees were struggling, and I think it was the impact of the shutdown changed behavior pretty, from a consumer standpoint, pretty significantly. Our teams had been working really hard on digital, in particular in our off-premise business with drive-throughs and curbside pickup and other components of off-premise service modes. The combination of all this and the great work from our teams and our franchisees and team members in the restaurants helped us on the road to recovery, and we've seen sequential improvements month over month. And now we just reported that we see some improvement at Burger King, getting back to flat last week. Popeyes continues to be positive about 20%, and Tim Hortons has come from low 40s to the teens, the high teens in terms of performance. So we've seen sequential improvement. We're confident in our long-term plans, and really confident and proud of the work that our franchisees and our team members are doing in restaurants. The digital platform that we've been working on for a couple of years now has been a key driver of that, as well as our off-premise business.
Good morning, Jose. It's Heidi Chung here. So
Hi, Heidi.
very good improvements that we've seen across Restaurant Brands portfolio. Burger King recently announcing that Impossible Croissant Witch, that brand new item, hit stores nationwide. I'm curious though, because one of your main rivals actually cut down on its menu offerings though during the COVID-19 pandemic. Why did you guys decide that this was a good time to launch a brand new product?
Yeah, we've been looking at simplification in our restaurants as well for all three brands, and we felt that we've been working on the Impossible sausage, a plant-based sausage for breakfast for Burger King for quite some time, and we felt now heading into the summer with what we expected to see some new traffic in the stores, we felt it was a good opportunity for us to introduce that product. We've got a strong business at Burger King for breakfast. We think it can be much bigger long-term, and we think having variety and options for our guests is an important element of that, and plant-based being a key part of our program and platform for Burger King long-term. We felt it was a good opportunity to introduce that product at that time. The breakfast menu for us at Burger King is relatively simple and straightforward, so it doesn't add too much complexity. So we feel it was a good opportunity, and we'll see how the consumers react to it.
Jose, Ines here. Walk us through some of the changes that you are making in dining as far as social distancing, the masks that employees are wearing.
Sure. Hi, Ines. We've been working on this for quite some time. As you know, we've been open for business since the beginning of the pandemic. And one of the first things we did was learn from the experiences we had with Burger King in China, which was dealing with the pandemic back in January and February. So a lot of the best practices, including temperature checks for all of our team members and logging those daily, as well as PPE, masks, and other components of the contactless procedures. All of that we learned from our partners in China. We brought those to the U.S. Today, what we've been doing in the U.S. is we've been making sure that in addition to those contactless procedures and heightened hygiene and sanitization in the restaurants, we've also brought in social distancing in the dining rooms. We've, in some cases, removed tables or separated the tables to ensure that folks that are dining in the restaurants can enjoy their meals at a social distance from others. In some cases where the tables are core drilled and are not mobile, we'll close them down and have enough space between tables and booths to ensure people can be 6 feet apart. We're also, all of our team members are wearing masks and gloves. And we have acrylic screens in the front counters as well as in the drive-thru to ensure that there's additional protection there. We ensure social distancing in the kitchens as well, and contactless procedures continue to be part of it. We've also included signage everywhere so that folks in the dining rooms can see where they should stand if they're in the queue or if they're waiting for their food, and where they should stand if they're waiting for the restrooms as well. So those are procedures we put in place quite some time ago, and we continue to work on them and enhance them. Our focus is to ensure our team members and our guests are safe, feel safe, and comfortable so they can enjoy their meals either at home, in their cars, or in the dining rooms where permitted.
Jose, you put out an open letter yesterday detailing your sales across brands, but also in there, you are personally leading a diversity initiative at Restaurant Brands. I don't think it got enough attention. Walk us through some of your initiatives there.
Yeah, thanks, Brian. We one of our 6 core values for the company is that diverse voices and perspectives make us better and make us stronger. And I feel very passionate and committed to diversity and inclusion because I believe it's going to make us better as an organization. And so what I communicated yesterday, I first communicated it to our team and then to the entire globe, if you will, is that we're committed to this and we have a KPI or a priority for all of the leadership team in the company that we're every person every position that's open that we're looking for a candidate We're committed to having 50% of the final round candidates for these roles to be folks of demonstrably diverse backgrounds, including race. And that's something that I think is very important to make sure we bring diverse talent to the organization to make us better, make us stronger, and do a better job of delivering against the things that our guests are looking for. Having a better, more engaged team, more diverse team is one of those key components for us as an organization, and for me as the leader of the organization.
All right, we'll leave it there. Restaurant Brands CEO Jose Sil, always good to see you, and good to see you taking a leadership role in that diversity.
Thanks so much, Brian.
Appreciate it. All right, do stick around. We'll have a preview of what you may hear from Fed Chairman Jerome Powell later on today. Welcome back to the first trade. Federal Reserve Chairman Jerome Powell and Treasury Secretary Steven Mnuchin are getting ready again to be questioned by lawmakers regarding the emergency money given out because of the coronavirus pandemic. To break down what you should expect from the Fed chief today is Fed correspondent Brian Chung. Brian, good to see you here. Jerome Powell's prepared remarks are already out. What are they?
Well, Brian, the Federal Reserve Chairman sounding like a broken record and again trying to tell Congress that more might be needed. It really all depends on how the data shakes out. The Federal Reserve did say that it's encouraged by some of the opening up metrics that we've seen. Businesses again coming back online, hiring been picking up, spending has been increasing, employment said to have rebounded strongly in the report that Chairman Powell and the Federal Reserve announced yesterday. Now, Fed Chairman Powell did say, however, quote, while this bounce back in economic activity is welcome, it also presents new challenges, notably the need to keep the virus in check, end quote. So this pointing to some of the worrying economic information, if not data, that there are indeed more cases cropping up in states like Texas, in states like California, that being an economic concern, because obviously if there were to be a pickup and states would have to reclose again, that would pose a number of economic risks to the outlook. Brian?
Brian, I think this market also wants to see Treasury Secretary Steven Mnuchin tease more about a potential stimulus package.
Absolutely. Well, we've heard from the Treasury Secretary in previous weeks that there could be a phase 4 package of some sort, not necessarily clear exactly what would be in that package. We've heard some waffling from some White House officials over whether or not that might include something like another stimulus payment or extended unemployment insurance benefits, for example. But that would be a big focus for this House Financial Services hearing, where you have a number of Democrats, which, by the way, this is a Democrat-led committee, maybe pressing this Treasury Secretary on what could come if there were to be another stimulus package. Now, what we saw in the last time that we had the Treasury Secretary alongside the Federal Reserve Chair testify is that Mnuchin fielded a lot of the fiscal policy questions, and then Chairman Powell received a lot of the monetary policy questions. But as Chairman Powell has pretty clearly laid out previously in press conferences and other congressional hearings, he said that there could be more actions needed from both policymakers, monetary and fiscal policy sides, in terms of making sure that the economic recovery is set up to be as fast and as vigorous as it possibly can be. But again, it seemed like it'll be an interesting update from the two officials over whether or not the government could do more to make sure that that recovery is intact.
Brian, I know you're always working the phones. Are any of your Fed contacts or sources starting to get a little concerned about inflation because of the low rates from the Fed? I ask this because we've seen a tremendous run in gold prices, and that usually happens on inflation concerns.
Well, Brian, I'm checking my phone right now. No text messages so far, which means that unless there's an update, none of the federal officials that at least I've spoken to or that I've heard from have really emphasized any sort of inflationary pressures at all. If anything, some actually expect the inflationary pressures to be more disinflationary, not deflationary, disinflationary. And we've seen that through some of the recent reads that we've gotten on inflation. When you look at CPI, or core personal consumption expenditures, which is the Federal Reserve's preferred measure of inflation, it's actually gone down since the COVID-19 crisis. So the Federal Reserve saying that this is just part of that, trend that we've seen over the past decade or so, where you don't see a lot of the monetary policy overstimulating consumption and therefore overstimulating inflation, which drives a lot of the Federal Reserve's policy making and thinking so far that they can provide the amount of stimulus and print the amount of money that it's printed without any sort of inflationary response to that. So that's something that if Chairman Powell will, and he probably will face a question like that in the hearing today, will probably say something along those lines that if anything, the consequences of this COVID-19 crisis and of the Fed's reaction won't be inflationary, it would be disinflationary.
All right, Brian Chung, let's get you out of here. I know you have those phones to hit hard. Talk to you soon.
Thanks, Brian.
All right. Do stick around. Much more ahead in the first trade, and we'll dive into the latest consumer confidence reading. That's up next. All right, welcome back to the first trade. Let's get right to Inez Ferre. Inez, some breaking news crossing the wires on bookings.com.
That's right, Brian. The Supreme Court ruling in favor of Booking.com in a trademark fight. The site can name it. It can be trademarked. And this was an ongoing dispute between Booking.com and the U.S. Patent and Trademark Office. I also want to mention what's happening with Shell, because that stock is down more than 4% this morning. Shell will take a write-down of its assets in the second quarter, posting post-tax impairment charges in the range anywhere between 15 and 22 billion. Shell gave a revised outlook for 2020, and it's expecting Brent crude to average around $35 a barrel in 2020, $40 a barrel in 2021. And then I just want to mention Cineworld and also AMC Theaters, because Cineworld is going to delay the reopening of its theaters. AMC also will be delaying reopening of theaters for 2 weeks. So they will now reopen at the end of July. You'll recall that Disney just recently announced that it would delay the release of Mulan until August 21st, and Warner Bros. Said that Tenet won't come out until mid-August. So the theaters now also delaying the opening of their theaters. And just want to mention also Tesla stock, which today is seeing new highs again. So Tesla is in the green and seeing new highs. I'm trying to find it here in my Nasdaq 100, and Tesla stock above 1,000 again, of course. And we're also waiting for the numbers that will be coming out in a couple of days on delivery and production. Brian?
Yeah, remarkable to see that move in Tesla. And as you know, we've been seeing reports the past week that Elon Musk is concerned about profits. So I'm sure lots of eyes on that delivery number. Thanks so much. All right, American consumers are getting more optimistic on the U.S. economy. Consumer confidence shot up in June, posting its biggest increase since 2011. With us now is Bart Van Ark, chief economist at the Conference Board. Bart, good to see you this morning. So this data hit the tape, and I think it surprised a lot of people on the street. How do you explain the ongoing strength in the U.S. consumer, given everything going on in the world right now?
Hi, Brian. Good to see you. Yeah, it was a nice uptick, frankly. We did see the index pick up from 86 to 98. A lot of that is consumers' assessment of the current conditions. I mean, in June, things just look better than in May. People feel that, business conditions are not as bad. People feel that, were more jobs available in June than in May. So I think on the present situation, we saw the biggest uptick. We saw also some improvement on the outlook. Consumers thinking that, business conditions are not as bad in the future, fewer jobs. But when you hear me, it's all like they are less pessimistic. They're not necessarily dramatically more optimistic. So I think that's the most important underlying message here.
Good morning, Bart. It's Heidi Chung here. So to your point then, we're still well below those pre-pandemic levels that we saw in February. The test, I guess, for consumer confidence going forward will be when those stimulus checks run out. So I'm curious to get your thoughts on how long you think that recovery will take place and when we will get back to those February levels.
Yeah, I mean, just to fully understand, pre-pandemic in January, the overall index was staying at 130, and now it's still below 100. So we made some way back, but there's still a very, very long way to go. And as I said, I think, consumers are less pessimistic. They just think that, it may be getting slightly better on jobs and on business conditions. But when we ask the question about income and what people think about the income level, we see no improvements at all. So consumers are not optimistic that their income will actually improve. And I think that is somewhat related to your point on the government checks and everything else. And that also kind of leads into, very cautious outlook for the second half of the year, because, once we have this sort of immediate recovery behind us, people are going to look into their wallet and say, well, actually, we don't have all that much to spend. So the second half of the year is not going to look pretty in our view.
Bart, Ines Ferre here. Do you think that outlook would change if the stimulus were to be announced prior to the expiration, for example, at the end of July, of the benefits that are coming? Do you think that the timing of when the stimulus is announced has anything to do with how consumers feel going forward?
Well, it's certainly true that in the first round of the stimulus, the checks came through fairly quickly. So that was good news. So consumers actually noticed that the checks were paid out pretty soon. So if a new announcement of that would happen, consumers would probably expect that to happen again, that these checks would end up in their pocket rather soon. And that could give us somewhat of an upside in the fall. But let's not forget, one thing is to get a check. The other one is, whether consumers think it is safe to go out there to consume, whether they think they can hold on to their jobs going forward and so on. So I think the checks will help a little bit to keep things going, but the longer term outlook, I think, is still pretty dire.
Bart, is this peak, with the reading that we saw today, is this peak consumer confidence for 2020? I look in the back half of the year, I see a presidential election, I see more states potentially closing down again, potentially job prospects weakening yet again. How can it get any better than this?
Yeah, I think it's a little bit early to say that we peaked this. I think this can still go up quite a bit. Let's not forget the present situation was as bad as 68 points just last month. That's now 86. That is likely to continue to improve somewhat. I think it's the expectations component that we need to watch very carefully. And as you say, there are quite a fair amount of uncertainties, including elections, but also how is this virus evolving? How do state governments respond to this? Do people feel comfortable that this situation is under control or not? I think that's going to be very important. The other thing I was going to say is, in your earlier discussion, we were talking about inflation. We also asked consumers about inflation expectations. Consumers always think that inflation is going to be higher than it really is. But the point is that they still do think that inflation will go up. So they go out to the supermarkets, they still see that prices of some goods and services are going up, that some things they can't get. If they go on the internet, it's more expensive. And again, that's another factor that will make consumers pretty cautious going forward.
All right, let's leave it there. Bart Van Ark, Chief Economist at the Conference Board. Good to see you. Have a great weekend.
Pleasure. Same to you.
All right, do stick around. On the other side of the break, we'll dive into the latest on Apple. All right, welcome back to the first trade. Apple, you may have heard of them. Tech giant is giving some customers a second chance while possibly taking away a major accessory. Heidi Chung is back with us. Heidi, my phone charger, it's not going to be in the box. What's up with that? It may not be in the box.
The rumors right now, Brian, it's not for sure yet, but there has been some speculation out there that Apple could be keeping things really simple when it releases its new iPhone come the fall. The iPhones usually come in the box with a charger, adapter, as well as earbuds. But some people are saying Apple could be ditching the charger as well as the earbuds. And there are a couple reasons why analysts and experts think that that might be a good idea. First and foremost, it's for increased margins, shipping cost, transition to a future no-port iPhone, and potentially to protect the environment. So Apple has not confirmed that this is in fact going to be the case. But if you think about it, Brian and Inez, when you purchase an iPhone, a lot of people are just upgrading the phones that they have. So that means they already have an adapter as well as a charging cable. So if that's the case, you don't necessarily need a brand new one. Now you can imagine why consumers might be a little bit irritated about that potential rumor that that might be the case, because that means they just got to shell out more money to purchase another charger and adapter if they do in fact need one. And so I do want to get your thoughts, Inez, as a consumer. How would you feel if they in fact did remove those items?
I think that I like the fact that maybe it doesn't come with a charger, which I have chargers, although I tend to lose a lot of them. But then if it doesn't come with the earbuds also, which I also tend to lose a lot of, then I'd have to buy AirPods, because really I'm not going to go buy AirPods now. I need to buy the AirPods just like the ones Brian has. So I think it is a smart way to get people to buy more and to also increase margins.
All right, some quick breaking news, though, before we continue discussion on Apple. Dr. Fauci says hopefully vaccine doses for COVID-19 will be available in winter, but there is no guarantee. Very, very interesting. Heidi, real quickly, though, getting back to you on Apple, the Apple credit card, what's the latest on that?
So people are still being denied the applications that they're putting in. Some of them are having to wait even longer to potentially get their hands on the card. And, that's just an issue that has been plaguing the Apple Card for quite some time now. It's unclear if and when these people will finally be cleared to get this, but it's been something that has been circulating online as a big concern and complaint amongst Apple loyalists. So that's the latest that we know about that, but another big issue there for Apple potentially in the future.
All right, staying on the consumer beat here a little bit. If the pandemic has taught us anything, it's that we can do a whole lot without ever leaving our houses. One of those things being at-home hair dyeing, which has proven to be crucial for many during this pandemic. Joining us now to discuss is Amy Errett, founder and CEO of hair color and color brand Madison Reed. Amy, good to see you this morning. I've been hearing your commercials on the radio for years, so I'm glad we're able to have you on here today. What have you seen in your business as we all have been quarantined the past 3-4 months?
So first of all, thanks for having me this morning. Happy to be here. The business has really changed dramatically in the sense that we have doubled the size of our business on the top line. We have seen a 12x increase in sales since COVID started. And although that's come down a tiny bit, we're still up dramatically. So we're very pleased. I'm not happy it took a pandemic for this to happen. I'd prefer that not to be happening. But I think that it proves that hair coloring is really important for people emotionally.
Hi, Amy. Thanks for joining. It's Heidi Chung here. I want to get an update on what's been happening with the Madison Reed color bars. I understand that you have about 12 locations across some pretty big metropolitan areas, but how have they held up during the pandemic?
So we have 17, soon to be 20. We have 3 more opening in the next 2 weeks. It's really, Heidi, region by region. So we closed them, obviously, at the time that shelter in place started. We have reopened them, and they have seen some very good traffic. It's been region by region. So we're not open in San Francisco, obviously, because there's still salons that are closed. And we are reopening New York City. But we're open in Atlanta, Dallas, Houston, and we've seen very good volume in them. We are doing something interesting. We're calling it sensible scheduling. So we're only seeing a handful of clients at a time because we want to make sure that all the protocols are in place.
Amy, Ines Ferre here. I'm wondering if you've seen any consumer preferences that have changed because of the pandemic, perhaps bolder colors, something different.
We haven't seen bolder colors. I think what has changed in the pandemic is exactly what we're doing, which is video. And that so many people are on Zoom calls that, I think you've seen it's interesting that color cosmetics hasn't had the same impact as what's happened with hair color or apparel for that purpose. But I think in hair color, primarily women are, want to color their roots and it's important to them. And I think they've found out that it's not hard to do. And so we've had this other piece of our business with getting tons of feedback saying, why was I going to a salon spending $200 in 3 hours when I could do this on Tuesday night at 11:30? So it's been a positive experience for our clients.
Amy, a lot of folks also know you as a venture capitalist, and your firm was one of the early investors in Peloton. Let me tap your VC mind for a bit. What do you make of the valuation that a Lululemon paid for a mirror? And do you see more consolidation in that space happening?
Well, I think that, again, a very similar trend here is that the sort of at-home fitness concepts are really important because most people are not going to be going to gyms and they're looking for still great workouts. So I'm not surprised about the acquisition. I think that, again, at-home fitness is another category benefiting dramatically from this. I know Lululemon had made an investment prior to this, so I suspect they liked what they saw when they decided to make a full acquisition.
Is the market size, the number we always like to talk about is TAM, total addressable market. Are these companies, has their TAM gone up significantly to justify, just some of the valuations they're getting?
I think the TAM has gone up dramatically. I think if you look at the size of the fitness market in general, and then you look at the size of the gym market, which is quite large, I think the TAM is quite attractive. And so I believe that you'll see these companies continue to perform well. And again, I think it's another example, like in hair coloring, once the behavior shifts, it doesn't go back. And so I think that that's the other thing here that as a VC, you look for, which is kind of consumer behavior changes that actually create a long-term impact. And I think we're seeing that in fitness and we're seeing it in hair coloring.
All right, we'll leave it there for right now. Amy Arrett, Madison Reed, founder and CEO. Good to finally talk with you, and I appreciate the Twitter follow.
Thanks very much. Nice to be with you.
Thank you. All right, do stick around. Much more ahead on The First Trade. All right, welcome back to The First Trade. Now, Lululemon announced its plans to acquire interactive at-home fitness startup Mirror for $500 million. This deal comes at a time when working out at home is basically our only option. Yahoo Finance's Melody Hom joins us with the details. Melody, I have to give you a shout. You were one of the first people that I know that reviewed the Mirror. I never heard of the Mirror until I saw your review. Are you surprised by this deal?
Yeah, and that was September 2018. I also have to give a shout out to our own producer, Brooke De Palma, who actually filmed the segment when I went to go try it out. It was a very bootstrapped operation, if you will. And even when I went to go check out the mirror, it was kind of this like sort of pop-up space in Herald Square. Clearly, they were not open to the public just yet, and they were just getting their ducks in a row. Some quick context here. Bryn Putnam is the founder and CEO of Mirror. She's a Harvard-educated ballerina, and she started a boutique fitness studio called Refine Method, which is a very intense Pilates sort of bar method in New York City. She launched that in 2010, and then she realized so many of the fellow moms in her group said, we can't even carve out the time to walk to your studio and to take the class. We need to have a quick 15 minutes here, 30 minutes here. If that sounds familiar, that's the Peloton model too, right? You should be able to kind of exercise with ease. To be perfectly honest, Brian, I can't kind of pat myself on the back too much because at the time I said, okay, this is a very niche market. This will do well. It's a $1,500 mirror. Some very bougie Upper East Side and Upper West Side folks will definitely invest in this. Perhaps those who have space for a home gym will put a mirror, put a Peloton, do the whole shebang. But I have been so blown away by the progress over the last couple of months. And I think this Lululemon acquisition, and keep in mind, it's the first acquisition for Lululemon, is pretty monumental. Some quick stats that I got from Lululemon yesterday. The company launched in 2018. They're set to make $100 million in revenue this year. Their demographic is interesting because it's 50-50 female male. And only 10% of folks are familiar with the Mirror product. We, having been in New York City, I think so often we associate, oh yeah, you see the ads on the subway, everyone knows what it is, or everyone has been exposed to it. Clearly, there's so much more room for penetration. And I think that's what made it such an appealing deal for Lulu.
Hey, Melody. So I have to be quite honest with you. I've been working out at home during the pandemic, but I just don't find it as fun as being in a studio or gym where you have other people really motivating you. After trying out the Mirror, did you feel like this is a product that people would actually enjoy? Was it a good workout? Did you feel like you felt motivated throughout the process? I want to know what you thought about it.
Yeah, Heidi, I'll send you the video of the Twitter link. I mean, it's just me really struggling to do a couple push-ups and having a hard time. And I don't think of myself as unfit, I suppose. But yes, it's a very rigorous workout and many of them are live. So like the Peloton model, you can see the leaderboard, you can invite your friends to join on. I actually like the Mirror better than Peloton because I'm not a spinning person. There's so many other standalone digital subscriptions, but to have a physical device where you can see yourself in the mirror, just like a regular studio, and have a trainer virtually there with you, I think actually was very motivating for me.
Melody, what's the play here? So ultimately, Lululemon now owns Mirror. They have these mirrors hanging in your house, and they're gonna just shoot ads at me while I'm working out for Lululemon socks, shirts, and pants.
So obvious you were a former analyst, Brian, because that was the top question yesterday on the call with analysts, with the executive team at Lulu. And Calvin McDonald kind of shut that down quickly, saying, no, we're not going to bombard you with ads just yet. But it's actually the other approach. They're expecting to put mirrors in every Lululemon store. So just think about the overlap in demo. People who have $98 yoga pants are very likely to be that customer to buy that $1,500 mirror, right? And then also they have a huge ambassador base at Lululemon. Actually, Bryn Putnam, the CEO, she started as a Lululemon ambassador. That's how her connection with the company first began. So if you think about the overlap and the synergy there, I do feel like it's limitless, especially as instructors at Mirror will soon be sporting and donning Lululemon, and even kind of casually, sort of a really great native ad, they could say, hey, yeah, this is the new model, or this is a new collaboration. And so I can see this partnership actually being very fruitful.
All right, let's leave it there. Melody Hom, you are a true trailblazer. Let me know the next device you test out. I definitely got to follow that one.
Got you.
All right. All right, let's get over to Inez Ferre for another look at the markets. Inez?
And Brian, the market's in the green right now. We're taking a look at some of the bank stocks. I want to show you what's happening with Wells Fargo, down slightly after the company said that it's expecting a dividend cut in the third quarter to meet Fed requirements after those stress tests. The Federal Reserve had recently capped dividends and suspended share buybacks for the banks for the third quarter after the stress test. However, JP Morgan Chase, Citi, Goldman Sachs, they came out saying that they would keep their current quarterly dividends since they performed well in those tests. forecasts. Also, taking a look at Intercontinental Hotels, that stock is down more than 2% after the company said it's expecting to report a decline of 75% in revenue per available room for the quarter ending in June. Year to date, the stock is down for year to date 35%. IHG said that the pace of hotel reopenings has recently accelerated, but about 10% of its global hotel real estate remains closed. And then just taking a look at Netflix, Netflix up more than 1% today after Netflix said it will shift up to 2% of its holdings, or about $100 million, to financial institutions focusing on Black communities. I also want to show you what's happening with Tesla stock today, reaching another high, up more than 3%. Tesla right now hovering around 1,047 share, and we're expecting Tesla in a couple of days to report their production and delivery numbers. Brian?
That is just a surprising move in Tesla, Inez. But you know what? It really goes to show how much of a rally we had and have had in the second quarter, when people are just blindly buying Tesla, but know how even with profits, there may be no profits in the second quarter for this company.
That's right. A lot of enthusiasm for this stock.
Yeah. All right. Inez Ferre, thank you so much. And do stick around for On the Move. They'll have the latest market moves, and we'll speak with Senator Sherrod Brown to talk about PPP and how they make real change in society when it comes to inequality. Do stick around.
Welcome to Yahoo Finance on the Move. I'm Adam Shapiro. It is Tuesday, June 30th, end of the second quarter, end of the first half of the year. A lot of people probably want a refund on this one. Markets are trading higher, and we see the Dow above 70 points right now, the S&P 500 above 20 points, Nasdaq up more than 100 points. Paul Schatz is going to join us in a minute to help break all of this down. But some of the headlines driving markets right now: the European Union no longer allowing visitors from the United States, Brazil, or Russia as it reopens to visitors from 15 other countries during the coronavirus pandemic. The EU will use a traveler's country of residence to determine who can enter the 27-member countries. The S&P CoreLogic Case-Shiller National Home Price Index showed prices increased 4.7% on an annual basis in April. The 20-city composite posted a 4% annual gain, led by Phoenix, where the gain was 8.8%. Consumer confidence rose in June as the economy began to reopen, but it remains below levels seen prior to the coronavirus pandemic. The Conference Board's index jumped by 12.2 points to 98.1. That's the biggest one-month gain since late 2011. Federal Reserve Chair Jay Powell and Treasury Secretary Steven Mnuchin will testify before Congress later today. That's in about an hour and a half, on how trillions of dollars in pandemic stimulus money has been spent. Now, one of the programs, the PPP, it expires at the end of the day. Jessica Smith is going to brief us on that in just a minute. Netflix announced it will budget up to $100 million into financial institutions and organizations that directly support Black communities. Netflix says its goal is to help families buy a house and small businesses grow and or get started. Finally, the Wall Street Journal reports NPC International, that's the largest fast food franchise operator in the United States. It is preparing to file for bankruptcy. We're going to have much more on that, but you know them, 1,200 Pizza Hut restaurants, 385 Wendy's restaurants, and they were in trouble before the pandemic. Cases of coronavirus worldwide, 10.4 million people testing positive. The number of dead exceeds 509,000 here in the States, 2.7 million people testing positive, with the number of dead exceeding 129,000. We want to turn our attention to what's happening on Capitol Hill, along with the Paycheck Protection Program. Jessica Smith joins us with more on that. Jessica?
Yeah, Adam, the Paycheck Protection Program is winding down today. The Small Business Administration will stop accepting applications at 11:59 tonight. Now, there is about $130 billion still left in that program, and some lawmakers are pushing for that program to allow other small businesses to get a second loan. So that would probably be targeting very specific small businesses or certain industries that were hardest hit. But there is that push to extend the program in some form. We'll be watching for that in the phase 4 legislation, because these small businesses in many cases still need a lot of help. We've seen at least 16 states pause or roll back their reopening plans. According to CNN, we've seen places like California, Arizona, Texas, Florida, and others shut down bars again, as the local and state leaders say that those gatherings in bars and homes are fueling these increases in cases. Dr. Fauci is actually testifying on Capitol Hill today before the Senate Health Committee, and he just finished up his opening statements a few minutes ago, and he says that there's no way to know for sure that there will be a safe and effective vaccine, but he says he's cautiously optimistic, looking at the data that's out there, that we'll at least know the extent of efficacy, he says, by winter and early next year. And he also says he is hopeful that there will be doses available by the beginning of 2021. So we'll keep watching to see what Dr. Fauci and the other health officials there have to say throughout this hearing. Adam.
Jessica, I just want to remind everybody we're going to carry the testimony before the House Financial Services Committee when Jay Powell and Steven Mnuchin testify. Also want to let everybody know that in New York, the hospitalizations for coronavirus, they rose for the first time since April. The number rose to 891 from 853. So we're going to keep an eye on that. Obviously, New York City looking at a phase 3 reopening on Monday. The governor saying not so fast. So there's going to be more on that. But right now, I want to bring into the program a good friend who's been here before, Paul Schatz, Heritage Capital president. And it's good to see you, Paul.
You too, Adam.
Before we get talking about all of these issues, I want to play a soundbite from our discussion with Gary Cohn last week, in which he said it would be okay to raise the corporate tax to as high as 28%.
You know, I'm actually okay at 28%. You know, the level we got to in our tax plan on the corporate side was actually a bit lower than I thought we needed to go.
Paul, I got to ask you, because Joe Biden's talking about raising it to 28% if Biden wins the presidency and if he can get that through Congress. What do you say?
Well, first, is Gary Cohn a hypocrite? Because when he was in the Trump administration, he was one of the biggest proponents of cutting the corporate tax rate down to a 21, 22%, and maybe even lower. So I think it's, for me anyway, this is all populist nonsense. You cannot argue that a higher corporate tax rate is better for corporate America. You can't argue that. There's absolutely no evidence, no data to suggest that's better for the markets. So no, I totally dismiss that. Now, you want to say that we need the money more than the economic stimulus. You want to go down that path. I'll have the argument, but No, the lower corporate tax rate flat out makes us more competitive in the world economy. And at least for me, that's most important.
So, Paul, having said that, I mean, part of the discussion or part of the reason we're having discussion of raising taxes is largely because there are concerns about the debt piling up. I mean, we've talked a lot about the stimulus as well as the CARES Act. I mean, I guess the broader question is, what's the reckoning waiting on the other side, and how do we pay for all of this?
Flat out, we can't. You could tax every individual making $500,000 and over at 100%. You'll never make a dent in the national debt. It is now fiscally impossible. It's impossible to ever pay down the national debt the way things are. So our economy is too mature to grow our way out. And the reason why it's not an anchor like it would be in Argentina or other countries, because the world has to transact business in dollars. So we're the world's reserve currency. Until or unless the world loses faith in our currency, we can continue to run up these unfathomable debt levels at some point down the road. And it's not in the 2020. This is down the road when I may be retired. Adam will still be here, but I may be done.
Paul, I got to ask you, because everything you've just said, okay, let's look 10 years down the road. If we're not the reserve currency, if we can't grow our way out of the debt, what do I do as an investor? What do all of us do? Because everything you're describing, I would think, is bad news, whether you're going into fixed income or even equities.
Well, so before you conclude that, look across the world at Japan, because the Japanese government essentially owns their bond market. And before all said and done in the 2020s, the ECB is going to own the European bond market. They may come out with just perpetual bonds. And I hope we don't go there. I hope we're at least smarter and learn our lessons from the problems in Japan and Europe. But clearly, we're heading down that path. I don't think there'll be any doubt we'll be the world's reserve currency 10 years from now, to your point. The Fed cannot, and the Treasury, they cannot allow interest rates to go up, because we could never, you would get into this vicious cycle of having to print more and more and more to pay for it. They're going to keep rates artificially low. I'm going to guess at least to the end of this decade. It may not be zero, but they're going to keep notes and the long-term bonds super low, and they may come out with a 50-year bond, or even on the unthinkable, a perpetual bond.
But Paul, when you think about the nature of this financial crisis, I think it differs so starkly, even looking back to 2008, 2009, because China sort of led the way out of that, even if the US was struggling. As you look at our global economy right now and the potential markets to invest in, are you seeing opportunity elsewhere, or do you feel like the virus has just completely decimated any of those prospects?
Oh, no. So first of all, the longer term you look, the more bullish I'm going to be. I think we'll see Dow 40,000 in the next couple of years. There's always an opportunity. People think it's like red light, green light, investors do. People should realize there's always an opportunity. Gold, look what gold's done this year. And people say, well, that's just for the people who want to buy bottled water and spam and sit in a bunker. But gold has its place in the investing cycle. There's always opportunities. You're starting to see, we saw shortages in the economy during the pandemic. I think that may be a theme for the 2020s. Shortages perhaps in areas we've never thought about, maybe in the grains. But we own a good chunk of China equities. People should not put China on their DOA list as dead. That economy is far from dead, and I'll certainly argue that it will be the leading economy, if not this whole decade, for a good portion of this decade. Don't count China out economically or market-wise.
Paul Schatz, always good to have you here. Heritage Capital President, we appreciate your joining us on The Move.
Thanks.
Turning our attention to what happened this morning, actually, in China and Hong Kong, Akiko Fujita is here with what the Chinese did and what it means going forward.
Yeah, Adam, we're talking about the national security law. This was a vote by the National People's Congress, a unanimous one at that, just 2 weeks after they began discussions on this law. And Beijing has framed this as a way to maintain stability within Hong Kong after all the protests that we've seen over the last year. But there's no question it would have sweeping implications for the territory. They would allow authorities to crack down on any voices of dissent, essentially quieting all the protests that we have seen over the last year. Opponents say it would circumvent the one country, two systems, this rule of governance that has been in place since Hong Kong was handed back to China in 1997. But the reality is there's no real clarity on what exactly this law would do, because it just specifics of it just haven't been released to the public. A final draft was not even released before it was voted on, and it is expected to go into effect on the 23rd anniversary of the handover. And the timing of that is important because, again, we talk about the handover in 1997, there was a promise by Beijing to maintain that one country, two systems for 50 years, and we're talking just 23 years in now, essentially Hong Kong coming under the sweeping national security law, the rule of Beijing. The move has already prompted the Trump administration to roll back specifics of Hong Kong's preferential trade status. For one, we've heard from the Commerce Department saying it will suspend export licenses for granted to Hong Kong. And Wilbur Ross released a statement in addition to a tweet yesterday saying further actions to eliminate differential treatment are also being evaluated. The Commerce Department saying we urge Beijing to immediately reverse course and fulfill the promises it has made to people of Hong Kong. Secretary of State Mike Pompeo also talking about this in a tweet, saying the U.S. will stop exporting U.S. defense equipment to Hong Kong for national security reasons. And specifically in that tweet, he says if Beijing now treats Hong Kong as one country, one systems, so must we. One more thing to note, Adam, this law has only been into effect. The vote only took place overnight, as you point out, but it's already had a chilling effect. Joshua Wong, as you know, who's become the face of the pro-democracy movement in Hong Kong, put out a tweet saying that he will now be disbanding his political party because there's just concerns about how this dissent would now be treated within Hong Kong. He essentially said in that tweet, this marks the end of Hong Kong, the world knew.
Akiko, don't go anywhere because I know you're going to have questions for our next guest, because this just throws more confusion into the trade situation with China. And our next guest is here to talk about that and something else that's in place. Stephen Lamar is the AAFA, the American Apparel and Footwear Association CEO and president. He's joining us from Fairfax, Virginia. Good to see you, Steve.
Hey, Adam, how you doing?
I'm very good. I want to get, before we address the issues for trade with China and how your membership, the retailers, are dealing with all of that, there's another issue at play, which has to do with commercial trade credit insurance, especially now because this is a crucial period when retailers would normally be buying and stocking shelves for the fall and the holidays. So what is commercial trade credit and how is that playing out right now given the pandemic?
Yeah, credit is the thing that's going to basically tell us how well we can have a safe and fast restart. Liquidity is really important to keep me in business right now. Credit will be important to keep me in business 6 months from now. And what companies do is when they're getting ready to take an order from a retailer, maybe it's $1 million order, they'll go to a trade credit insurance company and have that company insure the receivables, maybe $900,000 of those receivables, 90%. So I'll take 10% of the risk. The insurance company takes 90% of the risk. And I've now mitigated the risk that I may or may not get paid. That was the way it worked in January, a very routine transaction. The way it works now is because there's no ability to accurately predict cash flow. There are so many questions, so much uncertainty. This is coming on top of the unprecedented business interruption that we've been experiencing. Now what happens is those insurance companies, those trade credit insurance companies, they'll significantly drop back the amount that they'll cover to, say, 10%, if they'll even cover it at all. So if I want to continue to do that transaction, now I've got to absorb a much larger portion of that risk, and I may not be in a position to do it. So the result is it's either going to be a smaller order or I have to walk away from it entirely. And then when you go ahead.
Steve, it sounds like, I mean, in financial parlance, it would sound like a liquidity freeze. Here, it sounds like it would almost be an inventory freeze is what we're talking about, which would only be bad news going into the holiday sales season, right?
That's right. This is about whether we're going to have enough inventory on our store shelves to, make the sales to keep the people employed. So when customers are buying product, they can find it there. And of course, as you mentioned, holiday is such an important part of the year.
So what is there a business solution to this problem, or is this the kind of thing that requires some kind of government solution? And is anyone talking about that?
Well, the business solution will be in place again 9 months from now. What we need right now is a backstop. I mean, this is exactly what what the government should be doing, providing a very short-term backstop so that these credit insurance companies, so that credit decisions can be made using the authorities that they have that were funded through the CARES Act, something that they can put in place in the next couple of weeks. So remember, these are decisions that are being made now that will pan out over the next couple of months. If we can't fix it right now, if we don't have that available credit right now, that's going to be the Grinch that stole Christmas. So we really are working to try to get the Fed and the Treasury Department to focus on a short-term resolution.
Steve, I have a question as it relates to sort of supply chains within, apparel and footwear, because, we've heard over and over that over the last 3 months, a lot of these companies have learned that diversification is much more important and that this is going to trigger this move closer to home. This is one you could argue that had already been in motion as a result of the trade tensions with China. What have you seen over the last several months that leads you to believe this could be accelerated?
Well, the trade war was making companies already diversify out of China, look for alternative sources, and COVID is really accelerating that, as you pointed out. What companies are telling us is they're looking for either closer supply chains, shorter supply chains that can be more nimble, that can react to be resilient because of the issues that we're seeing with COVID. One of the problems that we were experiencing was initially you couldn't get product out of China. Then when you could get product out of China, you couldn't get product out of other countries because they were relying on Chinese fabrics and Chinese yarn. So folks are really looking at diversifying, creating those regional supply chains or supply chains that may not be as dependent on China.
All right, Stephen Lamar is the American Apparel and Footwear Association CEO and president. Always good to see you, Stephen, and we wish you and your membership the best.
Thank you.
When we come back after the break, we're going to check markets, but we're also going to talk about what kind of company can write down $22 billion in assets and still live to talk about it. And welcome back to Yahoo Finance on the Move. Checking markets right now. The Dow is up about 70 points. S&P 500 is up over 25 points. Nasdaq is up 121 points. Want to pay attention to crude oil because crude right now, at least WTI, is trading at $39.57 a barrel. It has fallen a bit. And to talk about this, but also major news that's taking place regarding Royal Dutch Shell, we invite into the program Todd Horowitz, Bubba Trading founder, and it's good to see you joining us from Chicago. How you doing?
Great, Adam. Nice to see you.
It's good to see you. And the reason I wanted to talk about this is Shell is writing down up to possibly $22 billion in assets, essentially because demand for oil they're predicting really isn't going to be there in 21, 22, or 23. I think in 2023, they're predicting Brent will be trading at roughly $60 a barrel. What does this mean for people who want to actively trade in oil? And will we see the other major oil companies follow suit?
Well, I think first of all, Adam, this is a great time, with all the bad things that are going on. As we know, companies like to make the biggest write-downs when there's already so much bad news that it doesn't matter. And I think that these companies have been so beaten down anyways. Why not just write everything off the books now? Now, as far as oil itself, I think there's going to be a lot less usage, a lot less demand, because again, we can't even get the economy open and full. So how are we going to start to continue to use oil? I think that's an issue. And I also think that we've now starting to see some other developments that may eventually help us replace oil, plus some of the restrictions that if Biden gets in, they could start coming in sooner rather than later. So there's a whole bunch of reasons to look at oil that it should go possibly lower from here. I think the days of $100 oil are over. I think probably we may be up to the 50s, might be as high as we may ever see again. And I think that here, looking at it today, I don't see us getting much past 40 anytime soon. I think that this big rally we had was built on a lot of hope, but I think we're starting to find out that that demand is not coming back so fast. So I think I would be looking for lower prices here.
Todd, is the demand not coming back so fast or not coming back at all in the way we used to see it? I mean, we're talking about BP several weeks ago. They had a 15% cut. There's no question, even before all of this, there was a shift that was happening away from fossil fuels. So a lot of these companies have already been thinking about it. And to your point, this is kind of the perfect timing to do the write down. But how much of that demand picture that we saw several years ago, or even in 2019, is not going to come back? And it's not just because of the virus.
Well, I think we should be headed towards other things anyways. And I think that's the right thing to do. I mean, you're seeing this like with Nikola Motors, not a huge player yet, but out there, Tesla, a lot of these cars that aren't going to need fossil fuels. So I think what you're going to see is that demand will start to wane, but we still have big oil is still a big player in the government as well. And until they can get themselves set properly, I think that demand will remain somewhat constant. Again, I don't think that we'll see that major demand that we saw because there are some alternatives starting to show up. But again, until they get their footing, very much like big tobacco years ago, because they're such big contributors, they're going to let them get themselves set up and get involved in this other stuff before they really start turning the pumps off. But I do think demand will wane. But again, the biggest thing right now is the lack of growth in our economy because we just can't get it open, and we're running at about 25%.
Todd, when you said that we will not see $100 a barrel oil again, I was thinking back to 2007, 2008, when they were talking about peak oil and oil would never fall below $140 a barrel. A whole different discussion. But one of the things that's in play in context to that is the big oil companies trying to turn themselves into energy companies and green energy. I realize that is decades down, but even Royal Dutch Shell has said that by 2050, they'll only sell carbon producing energy product to businesses that have carbon offputs. Is this realistic?
Well, I mean, I hope it's realistic, way down in the future. Obviously, I think that we should have been doing more all along. We've got, you've had solar power around, you've other things that could have been tried to be more redefined and put into business. But of course, again, this goes back to a lot of the breakdown in our own government, that big oil has got too big of a hand in big government, which did not force them to make some of these adjustments a long time ago. And especially when we got heavily into the shale producing and we became a world exporter instead of an importer, and we weren't being held up by OPEC anymore. It even left oil to be more in play, fossil fuels more in play, because we had access to it very easily. So those are a lot of the issues, but hopefully we will get to a point where we're going to see more of the electronic cars, the trucks and other things that we use fossil fuels for to burn cleaner energy to save the environment as we go into the future.
Todd Horowitz is the Bubba Trading founder, and he's joining us from, as my team pointed out, it looks like your oil superhero lair behind you. It's really quite a great shot. All the best to you, Todd. When we come back, the return of sports, we're going to talk to one of the people who runs, several sports teams, including the Washington Wizards. Welcome back to Yahoo Finance on the Move. I'm Adam Shapiro. We're watching markets right now. The Dow's still positive, up over 60 points. The S&P 500 is above 25 points, and then the Nasdaq is up over 120 points. Want to give you some headlines, though, to keep in mind. This is the end of the second quarter, the end of the month, obviously, last day of June. And in Arizona, the number of coronavirus cases has risen by 4,682, and that was as of today to 79,215. It's risen 294% in Arizona just this month. So we're keeping an eye on that. Something we're also keeping an eye on is how we get this economy going again and return to normalcy, especially if you love going to an arena and love live events or even sports. Jim Van Stone is Monumental Sports President of Business Operations, and he's joining us now from Washington, D.C. A lot of people may not know Monumental, but they would certainly know the Washington Wizards and the Capitals. And what do you see going forward when we hear teams talking about getting back to play? How is that going to look?
You know, I think we're really excited. I think, you know what, the innovation I think is going to take place in the broadcasting side of our live sports, I think is going to be something that the fans have never seen before. So I think we're really, really excited about that piece. It's been a long 3 months without live events, and you know, I think our country is thirsting for sports. So I think the month of July is going to turn out to be a real great bonanza for the sports enthusiasts. So I think there's going to be a lot of new things that are tried. And, you know, I think it's also going to allow us more time to prep for that ultimate moment when we get fans back in our arenas.
Jim, there's certainly a lot of people, including myself, who are really excited about the return of the NBA at the end of July, but also concerning watching the uptick in the number of cases in Florida. How confident are you that the season will actually start come July 31st? And can you just give us a sense of the conversations that are happening with the NBA as you look to the virus and how it's been spreading in Florida?
No, and that's a great question, Akiko. I think we're really very, very comfortable and confident. I think the leagues have all put together incredible task force to make sure that the players' health and safety, along with all the people that are participating, is at the highest levels. And it's interesting for us here at Monumental. I mean, not only do we have the Wizards participating in the Disney campus, we also have our Mystics at the IMG campus in Bradenton, and then we're waiting on the final hub cities for the NHL. So we could have 3 teams that are active and playing within the next 30 days. So, the health and safety of our players is of most importance for us organizationally. We've been very proactive, but I've really felt very, very good as far as all the support systems that we're getting from the leagues. They have a lot of medical experts. They're working with a lot of the local jurisdictions, and I feel like we're going to have a very safe and healthy experience as we move forward. But, certainly I think the rise of the numbers across our country is something that's alarming for all of us. And, I think it's more important than ever that social distancing, a mask, and every preemptive measure that we can take are critical and important, no matter if it's the greatest athletes in the world or if it's just the general public.
Jim, as you look to the return of these games, how are you looking at the revenue picture right now? I mean, you've got 3 months now where you haven't essentially been able to sell any tickets, bring in any fans. That's not going to happen even with the return of these sports. But I imagine there's some creative ways to look at the engagement with fans and some of the events that you can hold, at least virtually, around these events. What are you looking at in terms of additional revenue that could potentially come in?
Yeah, I think that's a really good question. I think we always look at ourselves as a content business first. Our teams and the properties and the athletes are great pieces of content for us. They're really, really unique. So I think we've been very innovative in terms of, a variety of different content measures that we're taking. I think it's also allowing us to look at, more lifestyle content that we're creating, whether it's the athletes, whether it's the brands that we work with. We've done a lot of great projects. For example, with Capital One, they were really worried about the health and wellness of their cardholders and the general public. We did a great wellness series with them, with our head coach, Scott Brooks, on the Wizards side. And it was a weekly 1-hour clinic on health and wellness. So I think it's really providing a great platform for us to be innovative and creative. And, certainly the marketing, the advertising dollars, we hope will be there. I think social and digital formats are going to continue to grow from a global perspective. And, I think we're fortunate enough with having an NBA, an NHL, and a WNBA team. We feel like we're part of a global platform, and we're very excited about that. I think the other piece that's really been interesting for a lot of organizations is esports. We've been an early adopter to esports here at Monumental. We are an equity partner in Team Liquid, but we're also very active in the NBA 2K League. So it's really allowed us to tap into some new areas of focus for a lot of our customers and clients. We certainly need the live events back, as quickly as possible, whether it's the ticketing, food and beverage revenues, certainly our premium seating revenues. But I think we've got a really unique opportunity on the advertising side.
And Jim, you have been at the forefront, along with Monumental as a whole, just thinking about social justice initiatives. And as I understand it, you helped galvanize a march. You're doing 3-for-1 matching to various organizations. Can you tell us about the genesis of that and the kinds of initiatives going forward that you plan to implement?
Yeah, I think certainly social justice is a huge important platform for us, along with health and wellness. I will say on the social justice side, I have to give a lot of credit to our players. Our athletes have been at the forefront of getting the message out there about the inequalities on the racial side within our country. And, I think as an organization, our platform, we need to do whatever we can to elevate that message. I think the other thing that's going to be important as these leagues get back is the collective bandwidth of the entire leagues itself really is going to extend, I think, what really is a much needed conversation and discussion and change. And, I think fortunately for us, whether it's Bradley Beal on the Wizard side, Braden Holtby on the Capital side, Natasha Cloud on the Mystic side, we have had leaders in that space and speaking up. And, from an organizational standpoint, I mean, we are all involved in this together, and we want to support and help elevate that to the best we can.
James, real quick, I know that a lot of people never read the ticket, but it always says, depending no matter where you go, that there's a kind of clause when you buy the ticket that you're not going to hold the seller responsible for things that happen in the pandemic era. Or is that going to need to be more prominent, that if you come to our venue, you can't sue us if God forbid you get ill?
You know what? Certainly there's legalities that you look at across everything, Adam. I do think, though, what is more important for us is making sure that we take the proactive measures in place before we open up the arena again from that standpoint. So we're looking at a variety of different technologies to make that a much more seamless and safe experience for guests as they come back into the buildings. And I think we're looking at a variety of different models of what the landscape of our arenas look like, from that standpoint. You have to realize when we come in, we certainly are a live events business. We're a culinary business, we're a retail business, we're a content business. So there's a variety of factors that we have to look at, and safety and security of our fans coming into our arenas is really, really important. I will say the good thing is that we really we compete with everyone on the quarter of the ice, but I think often we all own and operate in our own regions. So collectively, we work as leagues in terms of putting together a list of best practices. And I've been very, very positive about the direction we're getting from the leagues in terms of what they think could be really unique innovations and technologies that we look at to make our arenas safe for the fans.
Hey, I just got to tell you, when I saw that one of your partners was Charles Turwitt, I don't know if you can see, but it's the only shirt I wear. So, I mean, I've got 10 blue shirts, so I'm kind of boring, but.
You know what? We've been great partners with them. They're a fabulous partner of ours. We did a great activation a couple of years ago when the Wizards were playing in London, and we had 7'7" George Murasan actually get fitted for a custom suit. It was probably the best piece of content that I've ever seen from a branded opportunity. So I'm glad you're a good customer. I am too.
There you go. Jim Vanstone, Monumental Sports President of Business Operations. Thank you very much for joining us. When we come back, we're going to be talking more about what's going to happen at 12:30 with Jay Powell and Stephen Mnuchin. Welcome back to Yahoo Finance. News on the move right now. Seattle Police Chief Carmen Best condemned the deadly shooting that took the life of a teenager in Seattle's Capitol Hill organized protest zone known as CHOP. It's the fourth shooting in the past 10 days, and there have been no arrests following the latest violence. Chief Best says it is time to dismantle the autonomous zone known as CHOP. President Trump responded to reports that Russia offered cash to Taliban terrorists if they killed U.S. soldiers. He tweeted late last night, U.S. intelligence did not find this information credible and therefore did not report it to me or the vice president. Republicans briefed by the White House yesterday, Representatives Mac Thornberry and Liz Cheney, they say any information related to Russia or any other country targeting our forces must be pursued. Democrats were briefed today by the White House. The popular acrobatic show Cirque du Soleil filed for bankruptcy protection yesterday. The Montreal-based company operates 6 shows in Las Vegas and 10 shows on tour, but has had to cancel performances, obviously, because of the coronavirus pandemic. Cirque du Soleil employs 3,500 people. They had to lay all of them off in order to seek bankruptcy protection under Canadian law. Turning our attention right now to the danger of chasing vaccine stocks on news about vaccine development without the research to back that up. Nina Deca, Robo Global Senior Research Analyst, joins us now to talk about how investors need to still be cautious when making decisions. Good to have you here, Nina.
Thanks for having me.
So one of the things I know that you talk about is, there are ETFs that might protect your exposure to putting all of your investment into, say, a Moderna or J&J. What would you caution an investor who hears the headline about we're making breakthroughs, we're making advances, because we still don't have approval for a vaccine?
I mean, the biggest watchouts are that we don't know, or a lot of investors don't know to what degree a potential coronavirus vaccine might already be priced into the stock. Also, there's over 100 different vaccine opportunity programs that are under clinical trials right now. So it would require a lot of work and heavy lifting and research for for the average investor to decide which companies that they'd like to invest in. What we recommend is diversifying your options and holding a large group of great companies rather than just trying to pick 1 or 2 really good ones. And so if you were to try to determine which company is going to win in terms of coronavirus vaccine therapy, you might be missing out on some other really cool investment opportunities. For example, telehealth, areas like genomics, data analytics are very fast growing opportunities in healthcare right now. Virtual care is still at its very early days about adoption. So one way to capture all of this innovation happening in healthcare is with a healthcare innovation ETF, like ours, HTEC, ticker HTEC. It's up about 15% year to date, and it's outperforming a lot of other healthcare ETFs because it's more heavily weighed in some of these more innovative areas like genomics, robotics, telehealth.
This is an important thing that investor needs to pay attention to, and I know Melody has a question along those lines for you.
Sure.
Yeah, and Nina, I mean, you are making some reasonable, very rational, sound points, but in this era of the resurgence of the retail investor looking to win big and maybe taking some risky bets, even today we saw that Inovio Pharmaceuticals is down double digits after actually some promising data, but they did not disclose data about the participants' antibody response. This seems to be a moving target, right? So in some way, there could be opportunity, right? If perhaps stock is down 20%, I imagine that there could be still appetite for folks to say, hey, this is still worth investing in potentially when it's down.
Sure. And so what I would recommend those investors do is look at broader, longer term opportunities. For example, a couple of the companies active in the coronavirus research space are Moderna, for one, is in the HTEC index, actually. There's so much more to Moderna than what's happening with the coronavirus vaccine. First of all, the company is fully digitized, scalable. Everything they do involves artificial intelligence from the moment a scientist has an idea. And they have over 20 other active therapies under clinical trial right now. Also, if something gets approved with Moderna or with any other mRNA company, that will be a positive catalyst for all mRNA that's under development right now. To date, there is no mRNA therapy that's been commercially approved. So I would look at the longer term scalable opportunities beyond the coronavirus vaccine when trying to pick a winner. We think Regeneron is another really great opportunity.
Well, let me ask you about opportunities, because there's pushback in Congress. For instance, it's not just vaccine development. Bernie Sanders the other day was furious at remdesivir and the situation there because U.S. taxpayers help fund the research, but we're still paying what's like $3,200 with insurance coverage if you need the 5 treatments. But then you get something like diabetes and insulin. There were the issues over how many companies produce insulin and the increase in prices there. So how does an investor protect themselves from the potential to Congress to step in here and push prices down and perhaps even confine the ability for pharmaceutical companies to make money?
I would continue to encourage investors to look for a broader, diversified portfolio. So when you bring up diabetes, it's one of the hottest areas right now in med tech. And so what you might want to make sure you include in your portfolio is a company like Insulet, who has a new technology that's completely tubeless insulin pump that is also available through a pharmacy. So it's available to consumers at a much lower price point than the older types of insulin pumps. And so they also have a new technology that's in clinical trials right now that they're looking to launch and commercialize by the first half of next year, which is a closed loop system. And when that goes live, it's going to be tubeless, it's going to be talking actively to a continuous glucose monitor, and it's going to be available at pay-as-you-go price strategy through actual pharmacies. So there's an area where you could diversify your portfolio and protect it a little bit from some of the volatility that you might see with legislation and pricing.
Nina Deca, unfortunately, we're out of time. It's always good to have insight like yours. Thank you for joining us. Nina, by the way, is the Robo Global Senior Research Analyst. Please consider coming back in the future.
Will do. Thank you.
Sometimes you look at your investments and you think to yourself, oh, nuts. We'll tell you why Acorns may be the way to go. Welcome back to Yahoo Finance on the Move. We're watching markets right now. The Dow is up about 20 points. It is off its session highs. Nasdaq is up about 119 points. S&P 500 up about 20 points. Investing for the long term, very important, but you can get your kids in. You can get a baby in on this. Joining us to talk about that is Noah Kerner. He is the CEO of Acorns. And I think last time you spoke with us, it was over $1 billion assets under management. Do you have the public number available for us, how much it is now?
Yeah, thanks, Adam. We're at 2.6 billion now.
Congratulations. 7.7 million people signing up to use this. But the latest thing that you're introducing, it kind of proves how important it is to take advantage of long-term compounding, annual interest on your investments. $5 a day to help a baby have what, $70,000 by the time they are 18. Tell me more about this.
So we just launched Acorns Early, which is our first foray into the kids space. And prior to this, the earliest you could open up an Acorns account was 18 years old. Now you can open up an Acorns account as early as birth. And when you think about the compounding power there, if you start at 18 years old and do $5 a day, which is easy to do on Acorns, by retirement, you'd have near $1 million, $1.5 million. If you start as early as birth, you could have over $4 million by retirement.
Hi, Noah. Great to see you. I think it was back in our New York City studio that you announced that $1 billion assets under management. So congratulations on this new milestone. As you think about this current environment and the economic crisis that so many Americans are dealing with, I remember one of the statistics you had mentioned is some of the surprising demographics that use Acorns are construction workers, are perhaps very low income folks who are looking to round up their change in some capacity. What kind of information are you seeing right now as so many layoffs and furloughs have been happening?
Well, as an example with this product, so half of our parent customers aren't saving for their kids. So if you think about that and you think about intergenerational wealth, setting the next generation up for success, that's a big problem. And by the way, the half that are, the majority of those are saving in cash and savings rather than investment accounts. So when I think about how to make improvement in the future and how to really set up the next generation for success, parents have to be investing in their kids, and they have to be investing in their kids through investment accounts. Otherwise, they're not going to benefit from compounding.
Noah, there's also trillions of dollars that the older generation is about to bequeath to the younger generation. Is there a way that someone who's part of an Acorn account could take advantage of, I forget the exact name of it, but the Uniform Gift Management Account, right? Is there a way that works into it, the UGMAs?
Yeah, so the investment account is a UGMA. And so parents can invest in their own kids, but anybody can set up an investment account for kids with this product. So it can be uncles, aunts, godparents.
Could an uncle or could a grandparent, if they are fortunate to have extra cash, put a certain amount of money into that to get the kids started? I mean, is there a cap on that?
That's right. No, there's no cap and there's no minimum. It's the easiest way to invest in your kids, hands down.
What kind of transfer of wealth can you share with us? Are you seeing that happen, whether it be from uncles or from grandparents to kids?
We're just actually officially launching today. So our hope is that this goes really big and people really take advantage of it. Because again, to change the future, you've really got to start investing in your kids. And by the way, like I said, you know, Adam, you can invest in a kid's account. You can invest in a neighbor's kid's account. You don't have to actually be the parent. So it's a wonderful opportunity.
And again, you were saying $5 a day. I think that roughly about $1,800 a year. We appreciate your being here. Noah Kerner, Acorn CEO. Look forward to the next update from you.
Thank you.
We'll be right back after this.
Thanks, guys.
Welcome back to Yahoo Finance on the Move. Jared Blickery is joining us on this last day of the second quarter, last day of the first half of 2020. Jared, what's driving the markets?
Well, we got interesting leadership today. Real estate, tech, financials. Those are all outperforming right now. Let's take a look at the Dow. It's up 28 points. Had started out the day slightly in the red. Nasdaq really the big winner today, up 1.2%, and the S&P 500 up 80 basis points or so. Here's a look at the 5-day price action, and you can see we're testing last Thursday's highs right now. And just in the bigger picture, looking at the 2-month, looks like we're trying to break out of this downward wedge that we have right here. Any momentum to the upside could get us to 3,100, 3,150. That would be this resistance point right here. Want to take a look at the 10-year T-note yield because that is up slightly now. Had plunged to a 1-month low close to the open, but it's now to the upside. We do have this breaking down, though, from this earlier upward trend line. So we want to keep an eye on that. Also, the US dollar is now weaker, had been a little bit stronger, but it's trying to punch through this resistance level. It's at the bottom of a multi-year range and could tread higher here, which would probably weigh on equities. Here's a quick look at our NASDAQ heat map, and we can see lots of green here. FANG stocks really outperforming today. Also, the chip stocks are strong after Xilinx, which is the #1 winner, and Micron also beat on their earnings reports yesterday after the bell. Also, take a look at Tesla here. That is up above 1,000, chasing its record highs, and that is up 157% year to date. Well, let's go back. We're going to check out our Yahoo Premium Finance idea of the day, and this is going to be Skechers, and this is a pattern, a technical pattern, which is a bearish head and shoulders. So here is the left shoulder right here. Here is the right shoulder. Excuse me, there's the head, and here is the right shoulder. And we can see this declining neckline right here. Now it's breaking to the upside. A retest is normal in this instance, but we do have a downside price target of 23.68. That would be close to these lows from early May. And you probably want to keep a tight stop on this one. I'm thinking $32, $33. Then you would have the protection of one of the moving averages, the 20. That creates a decent reward risk profile. You can sign up for Yahoo Finance Premium on our website and get a 14-day free trial. Adam?
And want to remind everybody about your webinar tomorrow at 2 o'clock. You can still sign up for that, but don't go anywhere because we've got coming up in the next hour, Sherrod Brown, the senator from Ohio, on steps that employers can take to protect their employees during the pandemic and after. Welcome back to Yahoo Finance on the Move as we head into the 12 noon hour. Watching markets right now, the Dow is up about 20 points, Nasdaq up about 100 points, S&P 500 up a little more than 20 points. This is the last day of the second quarter. We're going to be going into earnings season in July. But one of the things that we are watching, some of the headlines which are driving these markets, in 30 minutes, we're going to hear from Federal Reserve Chair Jay Powell, as well as Treasury Secretary Steven Mnuchin. They will testify before the House Financial Services Committee on how trillions of dollars in pandemic stimulus have been spent. Now, one of the programs that's part of that stimulus, the Paycheck Protection Program, it expires at the end of the day. Of course, Congress trying to take action to extend some of these stimulus programs. We're going to hit all of that in the next half hour. Also, the European Union no longer allowing visitors from the United States, Brazil, or Russia as it reopens to visitors from 15 other countries during the coronavirus pandemic. EU will use a traveler's country of residence to determine who can enter the 27 member countries. And then there's the Wall Street Journal. It reports that NPC International, that's the largest fast food franchise operator here in the United States, preparing to file for bankruptcy. You know them as Pizza Hut. They have 1,200 of those stores, and also 385 Wendy's restaurants. So we're going to have Senator Sherrod Brown of Ohio joining us in about 5 minutes to talk about the ways businesses can do more to protect their essential workers. But in the coronavirus pandemic, essential workers and protecting all of us is key. And Dr. Anthony Fauci has been testifying about the potential for a vaccine to do just that. And here's some of what he had to say.
There is no guarantee, and anyone who's been involved in vaccinology will tell you, that we will have a safe and effective vaccine. But we are cautiously optimistic, looking at animal data and the early preliminary data, that we will at least know the extent of efficacy sometime in the winter and early part of next year.
Heidi and Brian, I'll start with you, Heidi. We've heard from the FDA they will not approve a vaccine for inoculation, in the United States unless it has at least 50% efficacy against a placebo. So we get that from the FDA, and then we hear Fauci saying cautiously optimistic. That is his standard line. Is he trying to prepare us for a letdown?
Well, Adam, I don't know about a future letdown in the works, but I feel like the terms cautiously optimistic, that's just the way that everyone has sort of been viewing the entire pandemic at this point. We're cautiously optimistic about treatment and vaccines. The market is cautiously optimistic that we're going to be able to overcome this potential second spike in COVID-19 cases. I believe there are some 10 US states that have seen their case counts double in the month of June. So all of those statistics, Adam, are very concerning. But like you mentioned earlier, we are about to close out the second quarter. And in the second quarter, both the Dow and the S&P 500 are on track to close out their best quarter since 1998. And the Nasdaq on pace to close out its best quarter since 2001. So a lot of that market momentum and a lot of the positive economic data that we have gotten over the recent weeks has really been predicated on the fact that we're expecting the US to really overcome the coronavirus pandemic here. But a lot of the data points that we've been getting recently are pointing in the opposite direction. So I think a lot of folks out there, a lot of experts are having a bit of trouble finding the direction of the economic recovery as well as the market recovery headed into Q3, as well as the second half of this year. Like you also mentioned earlier, we are headed into earnings season. And as we know, in the previous earnings season, a lot of companies foregoing giving guidance, a lot of companies stepping away from having to give updates related to COVID-19. So this next earnings season will prove to be an ultimate test for markets to see whether or not investors are able to go ahead and invest and take an offensive stance.
Yeah, and absolutely. To Heidi's point, too, you look at the metrics in a number of states. You got Florida cases of COVID-19 rising 4.2%. That's a tick down from the 7-day average of 5.6%. But still, you have the amount of cases at long-term care facilities hitting a record. You have New York expanding the 14-day quarantine that they've imposed on a number of states. They added 8 new states to that: California, Georgia, Iowa, Idaho, Louisiana, Mississippi, Nevada, and Tennessee. And Arizona, of course, coronavirus cases increasing by 294% by Reuters' count in the month of June. Not looking good in some of those states.
I want to throw something at the two of you that it's not official yet, but apparently Postmates may be in play. Uber possibly making an offer that I think it was Wall Street Journal valued at $2.6 billion to buy them. Also, a special purpose acquisition company might also be in play to get them. What do you think, Brian? Would Postmates want to go IPO or not?
Well,
Heidi,
I think
Heidi.
Heidi, go ahead.
Okay, let me just lay out the background here on what we do know right now. As we know, earlier this year, talks between Uber and Grubhub did fall through, and ultimately, European food delivery company Just Eats acquired Grubhub for $7.3 billion. Well, it looks like Uber is not giving up. It's looking to eye Postmates for potential takeover here. Uber's offer is reportedly valued at about $2.6 billion, Adam, and sources told the New York Times that if it does in fact go through, the deal could be announced as early as Monday. Yahoo Finance did reach out to both Uber and Postmates for comment, but have not heard back yet. I do also want to bring up here that Postmates has actually been talking to potential suitors for a merger for at least the past year. It's also confidentially filed for an IPO in February of last year, but then tabled those plans due to the entire WeWork debacle that we covered extensively last year. Postmates was founded in 2011, and it actually had gained a lot of popularity and momentum in the Los Angeles area, but then quickly got pushed out as competition started to ramp up in the food delivery space. It's one of the smaller players when we're thinking about DoorDash, Uber Eats, and Grubhub right now. And Adam, we've been talking a lot about potential consolidation in the food delivery space. A lot of folks were expecting something like this to happen, but the fact that Uber right now has been getting hit particularly hard during the pandemic, when we look at their ride-sharing business, the company has a lot of debt, has a lot of things to work through, and the fact that they still want to push through and potentially acquire another food delivery company is a little bit questionable at this point, according to some analysts that I spoke to.
Heidi, not sure exactly how to phrase the question, but could Postmates be, kind of dating more than two people at once? And would the SPAC be a potential way for them to go public without having to follow through with the traditional IPO that they filed for, as you had pointed out earlier?
Exactly, Adam. So everything you laid out there is exactly correct. Postmates doesn't have to be loyal here. It could be dating more than one company at this time. A lot is still unknown. These are very early preliminary talks, and I'm definitely waiting to hear back from what Postmates has to say here. But a lot of things still in flux. Whether or not we'll potentially get a deal announcement in Monday, that will be a clear indicator of what is to come for the company.
Well, if they are dating two or more at once, just remember, kissing a pig is still kissing a pig. Heidi, thank you. Brian Chung, we are waiting for Jay Powell and Stephen Mnuchin. They're going to testify before the House Financial Services Committee. We don't expect anything shocking or headline earth-shattering, do we?
Nothing particularly new, but obviously anytime there's a Federal Reserve chairman, you do want to hear if there's any update on the economic outlook. And for what it's worth, we did get a set of prepared remarks from the Federal Reserve yesterday in preview of this testimony in front of the House Financial Services Committee today. And Chairman Powell saying that the resurgence of these cases in many corners of the country is definitely something worth watching. He said, quote, "While this bounce back in economic activity is welcome, it also presents new challenges, notably the need to keep the virus in check," end quote. And Adam, just over the past few hours, we've heard from a number of other Fed officials as well. You have John Williams from the New York Fed saying a strong economic recovery depends on effective and sustained containment of COVID-19, saying that he's been observing some disheartening data in other corners of the country. Although you do have Fed Governor Lael Brainerd saying just a few moments ago that she does think the economy seems to have bottomed out. So a little bit of a disparity between the economic data and the actual cases of coronavirus, which, as we know, the coronavirus is going to lead the data on the economy. So if it does indeed prove to be the case that these numbers metrically don't look very good for the economy, that might be bad for some of those metrics that we might expect to see in the second quarter.
Brian, a very quick follow-up for you. When we talk about the PPP program, I realize that that's not the Fed, that's more Mnuchin. But do you think we would hear, because we've heard Powell say so often that we need Congress to do more. You think that's going to be front and center and extending other benefits through Congress to American taxpayers and businesses?
Well, one thing that's worth mentioning when it comes to the Paycheck Protection Program, again, that program that was extended to companies, that small businesses that really needed that bridge funding through the COVID-19 crisis. The Small Business Administration, which has been in charge of running that program, stopped approving loans as of yesterday, the end of the day yesterday, which meant that over $100 billion of the money that Congress had approved actually went unused. Now, you do raise the good question about whether or not in this new fiscal package, if there were to be one, if there were to be some other type of small business support, if it maybe weren't in the form of PPP, if it were to be something else, that's something we should expect to hear lawmakers press the Treasury Secretary on today, as again, he will be testifying alongside Chairman Powell in front of the House Financial Services Committee.
All right. There's so much more to talk about here, and I want to invite into the program somebody we all know very well. That is Senator Sherrod Brown from Ohio. He is joining us to talk about the economy and so many different things. And Senator, it's always good to see you. Thank you for joining us.
Thank you, Adam. You too. Thank you.
But before I jump into some of the points you've raised in your most recent op-ed, I just want to get past the most recent headline, because I know Democrats were briefed, some Democrats were briefed by the White House about this news that Russia was paying Taliban soldiers to kill our soldiers. Is there any kind of uniform Democratic response to how the White House has handled this? Because the president has a relationship with Russia and Putin, but allegedly was told about this several months ago.
Well, there's no Democratic position. I haven't called Senator Schumer and say, what do you want me to say? Or I talk to my colleagues all the time about all different kinds of issues, but there's a unanimous outcry and disgust that the President of the United States, because he and Putin are so close, seems to disregard any kind of quote unquote bad news about Putin and a relationship between the US and Russia on the one hand. On the other hand, that maybe the president didn't know about this because he doesn't read his briefings. He doesn't listen to his staff, and his staff is so intimidated by ever giving him bad news because they know like that they could be fired. So it's a dysfunctional place. An American soldier, the White House, and American soldiers die as a result. And it just breaks my heart. And I think that, I mean, it's not just Democrats think that, it's Republicans think that. They're pretty scared of this president. They have not exactly shown great spine in the last 3 years, and they're afraid of the president calling them a name and coming into their states and campaigning perhaps against them. But it's a sordid chapter, one more sordid chapter in foreign policy.
Let's turn to domestic policy and the economy, because you just had an op-ed. I'm going to give some of the key points of what you're talking about. Raise base pay for all employees to a living wage, a minimum of $15 an hour. Stop forcing people to choose between their jobs and their families' grant paid sick leave. And then end the independent contractor business model. Tell me more about what you're pushing for here, because so many essential employees, you use the example of a grocery store clerk. I used to shop at Heinen's when I lived on the North Coast in Ohio. What is it you want all of us to understand about what's going on economically?
Yeah, I was speaking of Heinen's. This was not a Heinen's store, but I was talking to a grocery store worker in Southwest Ohio, and she said, you know, they call me essential, but really I feel like I'm expendable. They don't pay me much, and I don't have particularly a good protection at work. And you think about that, you go to work every day, you know, whether you're a grocery store worker, a bus driver, a hospital worker, a food preparer, a custodian, all kinds of people go to work every day at barely adequate wages. They have to be fearful, concerned about their safety at work from their employees who wear masks, usually their fellow employees. The customers often don't, in large part because we haven't pushed that in this society from the top. And then they go home and are concerned about the health of their families, about infecting them. So I just wrote this letter saying to employers, don't just run ads saying thank you to these employees. Start paying them more, paying them a living wage, allow them to organize a union if they want to, implement really strong worker safety standards, give them pandemic premium pay. That's one of the things we're trying to do. Speaker Pelosi did that in the HEROES Act. We want to do that in the House version. Stop lobbying Congress for more CEO pay and tax cuts and all of that, and start paying attention to diversity in your workplace.
Senator Brown, Brian Chung here. I want to talk about the economic efforts from the Federal Reserve's part. The Congress had tasked the Federal Reserve with a number of things in response to this crisis through the CARES Act. I'm wondering if you were to grade the Federal Reserve's response so far. Their Main Street lending program is kind of not yet fully started up yet. Money's not necessarily going to borrowers' hands yet. How would you assess the status of the Federal Reserve's reaction here? And would you like to see the Fed doing certain things with the amount of money that it hasn't used that Congress appropriated it?
Yeah, I would first of all grade, this wasn't your question exactly, but I'd grade the Fed, the Treasury, a much lower rate than the Fed. The Treasury seems more about rewarding the president's friends than it does helping small business and minority institutions and the like. The Fed's a mixed bag. This week, I was critical of the Fed because they, in their most recent decision after the stress tests that the Fed's required to do, are allowing corporations to distribute dividends for the next quarter to their stockholders, which generally enriches the wealthiest 1 or 2 or 5% of the country. I understand these investors own stock, but we're doing that. They're allowing that in the midst of this crisis when several large banks barely passed their stress tests. And these stress tests have gotten easier since the Trump administration. And I'm very concerned about the security and the strength of these banks. So the Fed on that hand, in terms of regulation, is doing a poor job. In terms of trying to help the economy, they're doing a more adequate job, but lots need to be done.
Senator, many of us remember when you stood up to Orrin Hatch, and I know you respected him. He was a friend and a colleague, but during tax reform, we just had Gary Cohn on our program recently, and he said it's time to raise the corporate tax rate possibly to 28%, almost vindicates what you and your colleagues were saying. What do you say now about raising taxes? Because we know the Republicans wouldn't go there, but the Democrats are going to push it. What's the likelihood that it will happen?
Well, Republicans are now asking, they're circulating letters around for the next McConnell package, if there is one, for the next stimulus package, to give, again, major tax cuts to corporations. I mean, the problem isn't the tax rate for corporations. The problem is putting money in people's pockets. And I'll do whatever it takes. I know what that unemployment meant to keep people from evictions. And I am very alarmed if we do nothing in the next month. And that seems to be what Senator McConnell is proposing. He says he sees no urgency. And the $600 a week for unemployed workers, there will still be hundreds of thousands of unemployed workers just in the state Adam used to live in the state I represent, Ohio. There will be hundreds of thousands of unemployed workers come Labor Day. We know that. And if they lose their unemployment benefits, we win. And the moratorium on evictions and foreclosures expires, we're going to see so many people be evicted. And to the tens of thousands, I don't know how many in my state and across the country. And what does that mean in the middle of a pandemic? More homeless people, more people in homeless shelters, more people living in their cousins' basements when they're put together in an unhealthy situation. And we'll never get this pandemic under control if we pull back on helping state and local government, helping schools, helping individuals, putting money in their pockets. Enough of the tax cut for the rich talk. That's their solution to every problem. It didn't work, as Gary Cohn, Trump administration chief economic advisor at the time the tax bill passed, Gary Cohn's already stepping back, saying that didn't work. So it's pretty clear the solution of always giving tax cuts to rich people, which is what Mitch McConnell seems to live for, just doesn't work for our country.
A good friend of mine was just laid off at what used to be LTV, ISG, and Middle Steel in the Flat. Senator, unfortunately, we never get enough time with you. Thank you for being here on the move with us. We're going to be
glad to do it again. Sorry about being late. I had a tax committee meeting. Thank you.
And welcome back to Yahoo Finance on the Move. One of the things we're taking a look at is how the economy restarts, but also a recent study. It was Morning Consult along with American Express did some research, and it was on the state of small business. And one of the things they found is that 62% of small businesses need to see consumer spending return by the end of this year in order to make it into 2021 and beyond. So to talk about that and what's happening, at the ground level, we want to bring into the program Walter Fry, who's American Express Vice President of Global Brand Engagement, and also Ben Leventhal, who is the CEO of Resi, who a lot of people know not only going into the pandemic, but as restaurants come back online, making reservations is key. Let me start first with you, Mr. Fry. What the survey shows us is, it seems like common sense, but now more crucial than ever. 56% of businesses say they are invigorated by people coming back to rally around them, but then we get a slowdown in reopening. What's going to happen?
Well, you've said it best. I mean, U.S. small businesses are the lifeline of our economy, but they're also what make our local communities vibrant and unique. We know that they're facing more challenging times than ever before. That 62% stat just shows the vital importance that they do get consumer spending back, and they start to see it this year.
And Ben,
go Heidi.
I'm sorry, Adam. Ben, it's Heidi Chung here. I want to get some updates from what Resi is doing right now. After seeing of sequential improvement when it comes to customer transactions in restaurants, we're starting to see a decline again as we're seeing a spike in COVID cases. So how have things been going on Resi, and what have you guys been doing to help small businesses?
And so, I think the restaurant experience and what we're seeing at Resi varies widely city by city. Obviously, some cities are farther along in the process of coming back than others. And, some cities are making progress and then having to retreat. And I think that the experience at restaurants is very much the same. As far as what Resi is doing, we've offered restaurants fee relief since the start of this crisis, and we have committed to that through 2020. And we're also working closely with all of our restaurant partners to understand the kind of technology that we can deliver to help them come back safely and stronger. And I would point to examples like our capacity monitor and some of the mobile waitlist functionality that we've shipped to restaurants in this crisis as examples of ways that we're helping restaurants get out of it.
Can you tell us more about, though, the partnership you've got with American Express and how that's going to work if you're an existing card member or if you can get an American Express card going forward? Ben?
As far as card members getting access to restaurants, yeah, I mean, everything that we're offering is available to all card members. You can and they can visit, use the Resi app and the Resi website to access all of the things that our restaurants are offering. What we're seeing is that restaurants are differentiating what they're offering to consumers. And so whereas what they were obviously historically offering was seats in restaurants, there's a much more wide variety of things that restaurants are selling now, which is sort of at the center of why we've shipped this at home functionality. And so if you're an American Express card member, it's all there in the Resi app. And you'll see things like in New York, you have restaurants offering picnic baskets and meal kits, and we're seeing sort of limited time things like lobster rolls at other restaurants, all kinds of amazing food and amazing things from the restaurants that you love, just sort of in a slightly different venue.
Walter, I imagine American Express sees the data in real time as to what, how restaurants have taken a hit. It's no surprise to anybody. So this partnership, will there be more that American Express does going forward, not only with Resi, but perhaps with others?
I mean, dining is a very important category for our card members. And we are seeing as markets open up that there is more spend happening across the country. Just today, we are starting to really inspire that spend with a new card member offer, where card members can enroll, and when they spend $10 or more at an eligible small business, including restaurants around the country, we're going to start to give them $5 back up to 10 times over the course of the next 12 weeks.
All right, Walter Fry is American Express Vice President of Global Brand Engagement. Ben Leventhal is Resi CEO and founder. They join us from New York City, one of the largest municipalities in the tri-state area. We'll be right back. Welcome back to Yahoo Finance on the Move as we await Jay Powell and Treasury Secretary Steven Mnuchin. We're checking markets for you right now, and I'm looking off at the other monitor. The Dow is now up over 50 points, S&P 500 up over 20 points. Nasdaq is up 130 plus points. Crude WTI flat for the day, $39.70 a barrel. Brian Chung, we've talked before about what Jay Powell might say today. What do you think they're going to grill him on?
Well, a number of things. One thing that he got a lot of heat for in the last time he testified, which by the way wasn't that long ago, it was only about 2 weeks ago in front of the Senate Banking Committee, was really the Federal Reserve's actions in the corporate debt markets. You might recall that exchange with Pennsylvania Republican Pat Toomey, where the questions really arose about whether or not the Federal Reserve was acting appropriate in intervening in the corporate bond market. As we know, the Federal Reserve, through its secondary market corporate credit facility, has been taking on corporate bond ETFs and also individual corporate bonds as of the second week of June. So companies like Apple, AT&T, Verizon, which is the parent company of Yahoo Finance, now part of the Federal Reserve's facility. Now, keep in mind, the Federal Reserve is not actively doing this at a scale that would be too large. The last reading that I saw in terms of this facility's holdings as of June 24th was only just above $8 billion when you consider that the Federal Reserve facility could take up to $500 billion. Actually, it's $750 billion, in addition to the fact that the corporate bond market is extremely liquid and much larger than that. So I think there's a lot of questions about to what degree the Federal Reserve might be affecting price signals. For Fed Chairman Jerome Powell's part, he's been saying we don't want to act like an elephant in the room. So whether or not you land on one side of the argument or not is up to you. But it seemed like that could be something that lawmakers could ask about in this session.
Do you think they might ask about something Paul Schatz talked about with us at the top of the 11 a.m. hour? And that's the U.S. dollar as the reserve currency. And Paul said something that I don't think you'll ever hear from Secretary Mnuchin. But Paul said there's no way for this economy to ever grow its way out of the now trillions upon trillions of dollars of debt. But he also said that the reserve currency, that the U.S. dollar as reserve currency for the world is not in jeopardy. Yet you read every now and then that may not be the case. You think they'll be asked about that?
Well, Adam, you bring up a really interesting question here, which is what's the delineation between a weaker dollar and whether or not the dollar gets weak enough where it threatens its role as a reserve currency globally. And that line is going to be different depending on who you're asking. There are some people that have pounded the alarm and said that the depreciation that we've seen from the US dollar over the previous weeks might point to the US dollar losing steam globally. But you can also just argue that's a function of lower rates here in the United States, right? For the longest time for the COVID-19 crisis, it was in other countries that you had negative rates, whereas here in the United States, you had positive rates. That would imply a lot of flows into US dollar denominated assets. Now, one thing that's worth watching is whether or not we should expect to see the dollar further depreciate. That is definitely a valid point, especially when you consider the discussion around yield curve control. What the Federal Reserve might do is pin down rates on, say, a 3 or a 5-year US Treasury. If it's lowering those medium-term rates beyond the low points that they're already at right now, there could be an argument that you might see more flows outside of the United States as those medium-term assets become less attractive to invest in. So that's definitely something worth watching. If they are asked the question, being Treasury Secretary Steven Mnuchin or Fed Chairman Jerome Powell, I would expect to say they wouldn't expect to say, hey, this is a threatening concern to our US dollar, but it could be something that they're watching closely.
Heidi, this gives us a chance to dive a little bit deeper into something you were talking about with the potential for Uber to, say, buy a Postmates. I mean, it's very cheap to borrow money right now, even though Uber has that huge debt situation. Do you think the Treasury Secretary will be asked about, and the Federal Reserve Chair, the fact that we're creating an environment where you can get as much cash as you need if you're going to do that kind of takeover?
Yeah, and Adam, specifically when we're taking a look at the small businesses, of course, Uber, not a small business, and neither is Postmates, but the smaller businesses are what's really been hit hard during this pandemic. And we also do need to mention that the PPP program is wrapping up and about $520 billion have been spent, but there's still money that hasn't been spent, which would be roughly $130 billion. It'll be interesting to see what we are going to hear from Treasury Secretary Mnuchin, what he's going to say about more help on the fiscal side, because as we know, the Fed has done so much already. And Jay Powell has said on many occasions that we do need, in fact, more fiscal stimulus here to prop up the economy. We talked earlier about that spike again in cases across several US states. So in an environment like that, we need help on both ends. So if we hear anything from Mnuchin when it comes to additional aid, I think that will particularly be a big market mover.
Brian, the Main Street lending facility, isn't that backstopped by cash that came from Treasury, even though it's the Federal Reserve that is running this program? That's a first in our history, is it not?
It's not the first for the Federal Reserve to use what they call its emergency 13.3 lender of last resort power, but it is the first time that the Federal Reserve is trying to use that authority to specifically underwrite loans to Main Street businesses, that being non-financial, non-bank companies. So a retailer on Main Street, or even a large cap stock that's a retailer that's publicly traded. So these are definitely unprecedented times, but keep in mind that the Federal Reserve is still rejiggering the terms of this facility. There's been a lot of institutional knowledge that the Federal Reserve has had to plug because of all this. And one reason why the Federal Reserve still technically doesn't have it stood up, lenders are registering right now, but no loans have actually gotten into businesses' hands yet, is because the Federal Reserve doesn't know how to do this type of thing. It's had to consult with a number of different types of parties about that. Now, one thing that the Federal Reserve has said it will do is expanding this facility to nonprofits, things like universities or charitable organizations, for example. The Federal Reserve still has yet to announce the specific terms of how exactly it would do that. But again, the Federal Reserve kind of moving the guideposts as it goes along to make sure that it can really cast as wide net as possible to make sure that companies that really need that funding can access it.
Brian, this is where I think a lot of us get confused by how all of this works, because didn't Treasury put US tax dollars up as the backstop for potential losses for the Federal Reserve in this program?
That's exactly it. So the way that this works is that the CARES Act, which we have to rewind to March to remember that it was Congress who gave the Treasury $454 billion to say, hey, you can use this for a variety of different programs. Congress did lay out the intention to set up some sort of Main Street lending program, but said the Fed could do other things like backstop corporate debt markets as well. The Treasury then works with the Fed to determine what types of facilities it needs to open up. Now, $454 billion does not mean that's the only amount of money that's available to actually go into the hands of companies that need it. One example is that it's equity that helps stand up the facility as backstop to losses under that program. So let's say, for example, the Fed starts to underwrite loans to some of these Main Street businesses. The Main Street business ultimately defaults. They can't pay it back. Well, at least the Fed would have the equity that the Treasury put into it from the CARES Act to sustain those losses. So because of that, the Fed can lever up the amount of money that the US Treasury gives it to then set up these programs to actually loan at what they call a 10-to-1 aggregate. So for example, the corporate credit facilities, the Federal Reserve is getting $75 billion of backing that would actually help absorb any possible losses, but the Fed can lever that up to $750 billion in the actual corporate bond market.
You know, yesterday, Brian, you did a special Yahoo U for us where you talked about some of the lending facilities. And one of the things we talked about in that Yahoo U was, I use the term junk bonds. The Fed is only purchasing, 2% of the assets they're buying are below investment grade, is how they would say it, right?
Yeah, well, only 2.8% of the Fed's index. Again, this is the aspirational setup of the amount of corporate debt that it would take on. Only 2.8% of that would be in junk debt. But Adam, you'll know that one man's junk is another man's treasure, and the corporate bond market is especially deep in these types of corporate bonds. Now, keep in mind, junk is also another word for below investment grade debt. Now, there's a lot of companies that have fallen to from investment grade to junk bond status. Examples being Delta or Ford. These are companies that fell to junk status after March 22nd, meaning that they were likely a victim of the COVID-19 crisis. The Federal Reserve saying it will help what they call those fallen angel companies that need the help in financing markets because of that. So you'll actually notice if you look at the Fed index, which they published on Sunday, that it does include the likes of Delta and Ford. But again, the Federal Reserve trying to make sure it's not backstopping all the junk companies. Only those that fell after March 22nd will be part of that. And again, the Fed will be publicly disclosing that on a regular basis.
Jared Blickery, you want to try and top one man's junk is another man's gold?
I'm not going to be able to do that. I'm just going to sign off. I'm looking at the bond market too in a slightly different way. I don't know if you guys are talking about yield curve control, but that's been a big topic with the Fed. And you can make the argument that people are the bond vigilantes are actually front running that trade. So just looking at the Wi-Fi Interactive, the 10-year T-note yield is bouncing today. It has reversed. It was down early. And that's off of a lowest point that we've had in about 5 weeks. And we can see we broke down from this consolidation period, and we've been tracking that for a couple of weeks as bonds, at least their yields, were breaking down here, and now kind of shooting to the upside. Could be a retest of this area, but if we continue to head down, that doesn't bode well for equities. And it's the same for the 5-year T-note. I believe this is a record low or very close to a record low that we have here. So you can make the case that the bond vigilantes, people trade the bond market, are trying to get the Fed to implement this. And as we've seen before, bonds often lead the Fed, and they also lead equities. So we'll have to see what comes of that.
Jared?
Yeah.
When you talk about these yields being so low, they also have, for those of us who are not as experienced or wise in these matters as you, it hides the companies that should go out of business. They can extend their ability to stay alive by borrowing. That makes it harder for someone who might be trying to choose a stock to purchase. And we're in an environment where there was an article in the Wall Street Journal yesterday kind of along these lines. Banks are having a hard time to determine who's credit worthy. It's almost as if we're setting up for potential tightening and freezing in the market.
This is the biggest experiment in moral hazard that we've ever seen, because the Fed is essentially in most markets right now. Once it started getting into high yield ETFs, not that it's been purchasing in a big way, but just the fact that it's willing to step into the market, you could very well make the argument that it's basically picking winners and losers. And in the case of the Fed, picking almost all winners. And I think that kind of goes with the bankruptcy trade we see in Robinhood. People just think that stocks are going to go up forever and anything has a Fed put in it. So it permeates through the entire investing landscape and has wide-reaching consequences that we're experiencing now, but I don't think we're going to see the full effect for years.
And to follow up on Jared's point, I mean, this is definitely something that the Federal Reserve faces in terms of a communication problem, which is people are reading some of these headlines and saying, oh, wait, so the Federal Reserve is going in and saving all of these companies that might be going bankrupt. Well, partially true, partially not true. Again, as I mentioned earlier, the Fed is not going to save all high yield debt, right? It's only going in to address those fallen angels that reach that high yield status after March 22nd. But it really brings up that question that under these unprecedented times, the Fed is putting out these unprecedented tools, and it's having to draw those lines that may not be as easy to explain to people. It's almost like if you are trying to set up your wedding party, right? Trying to decide who your groomsmen are going to be, and you've set off that cutoff at 7 people. Well, what's the criteria for those 7 people, right? Some people are going to get boxed out, and that's not going to be so easy to communicate. And you're ultimately going to have to go back to the market, go back to those groomsmen and say, hey, look, I'm really sorry, but you just didn't make the cut.
All right, we're going to take a break. Brian Chung just warning his parents when he brought up wedding party that maybe there's an announcement coming. No, just giving you a hard time there, Brian. But we are going to take a break. We'll check markets as we await Jay Powell and Stephen Mnuchin on Capitol Hill. Yahoo Finance on the Move. I'm Adam Shapiro along with Brian Chung, Jared Blickery, and Heidi Chung. And we're watching markets right now as we await the hearing before the House Financial Services Committee with Jay Powell and Treasury Secretary Steven Mnuchin to begin. There may be some technical issues, so they have not started that hearing as of yet, but we're going to bring it to you live here on the Wi-Fi platform. Markets right now, the Dow has gone negative. S&P 500 remains in positive territory by about 20 points. Nasdaq is up about 100 points. Heidi Chung, what fears might small business owners have, and what might they be paying attention to as the Treasury Secretary testifies before this hearing?
Well, Adam, I think small business owners are very concerned here and really waiting with bated breath to hear what Treasury Secretary Steven Mnuchin is about to say during his testimony. We talked a little bit earlier about how the PPP program is expiring today and how there is still about $130 billion left on the table that were not used. But that being said, a lot of the economic activity has actually been depressed a little longer than a lot of people have been anticipating, largely because we are seeing that second spike in coronavirus cases. So here on a local level, I'm in Los Angeles, and although a lot of restaurants are allowed to open their dining rooms, I noticed that a lot of them have not yet. And so it'll be very crucial to hear what Treasury Secretary Steven Mnuchin has to say about the future of additional fiscal stimulus. Another thing I want to mention is that the additional expanded unemployment benefit, so that extra $600 that Americans were getting as a result of unemployment, that will be set to expire at the end of this month. So a lot of things are running out here. And I want to highlight what Mnuchin actually outlined in his prepared remarks. He says, quote, "We are in a strong position to recover because the Trump administration worked with Congress on a bipartisan basis to pass legislation, improve liquidity to workers and markets in record time." So that does tell us what they have done. It doesn't necessarily tell us what's to come in the future. So a lot of this testimony, small business owners are going to be hanging on his every word to see if there's any additional clues on what's to come on the fiscal side.
Yeah, and two, on the point of the businesses trying to open up, what we're seeing is that if not necessarily a second wave, but the continuation of this first wave does require in some states businesses to close back down, whether or not that's restaurants or specifically retail, then that is going to have an effect on a lot of that unemployment insurance that's supposed to be keeping those workers bridged through this period. Because the UI expires in July, there is that question of maybe this is extending longer than lawmakers had originally planned for when they first designed the CARES Act. So that is something that lawmakers are mulling over. That's not a new talking point. Lawmakers have been talking about whether or not they should have extended that at some point in time. But again, as we're waiting for the stream here, which I'm hearing should be starting soon, there is going to be that pressure on Steven Mnuchin as the Treasury Secretary to provide more details on that.
Okay, we're going to go live to the hearing right now with Jay Powell and Steven Mnuchin.
Is authorized to declare recess of the committee at any time. I want to welcome all members and our distinguished witnesses to the first full committee hybrid hearing being conducted by the Committee on Financial Services. As Congress breaks new ground with these remote hearings, I want to remind members of a few matters, including some required by the regulations accompanying House Resolution 965, which established the framework for remote and hybrid committee proceedings. First, I would ask all members on the web text platform to keep themselves muted when they are not being recognized. This will minimize disturbances while members are asking questions of our witnesses. Members on the WebEx platform are responsible for muting and unmuting themselves. The staff have been instructed not to mute members except when not recognized and there is inadvertent background noise. Members on the WebEx platform are reminded they may only attend one remote hearing at a time. So if you're participating today, please remain with us during the hearing. Members should try to avoid coming in and out of the meeting, particularly during the question period. If during the hearing, members wish to be recognized, the chair recommends that members identify themselves by name so as to facilitate the chair's recognition. I would also ask that members be patient as the chair proceeds, given the nature of the online platform the committee is using. In addition, the chair informs the members participating in person that in enforcing order and decorum in the hearing room, the chair has a duty to protect the safety of members. The attending physician provided the following guidance. For U.S. House of Representatives meetings in a limited enclosed space, such as a committee hearing room. For greater than 15 minutes, face coverings are required. Accordingly, the chair will treat wearing masks as a matter of order and decorum, and all members should wear masks. The chair has a strong preference for members to continue to wear masks, even while recognized. Members who do not wish to wear masks may participate virtually through the WebEx platform. Before proceeding to the hearing, I have one committee business matter. Without objection, 2 resolutions distributed in advance to all members' offices establishing committee task forces for the chair will treat wearing masks as a matter of order and decorum, and all members should wear masks. The chair has a strong preference for members to continue to wear masks, even while recognized. Members who do not wish to wear masks may participate virtually through the WebEx platform. Before proceeding to the hearing, I have one committee business matter. Without objection, 2 resolutions distributed in advance to all members' offices establishing committee task forces for the remainder of 2020 are approved. This hearing is entitled Oversight of Department of the Treasury, Departments, and Federal Reserve's Pandemic Response. This hearing is the committee's first quarterly hearing required by the CARES Act for oversight of the various facilities and programs under the Act. I would like to inform members that our witnesses have a hard stop today at 2 o'clock. I now recognize myself for 4 minutes to give an opening statement. Secretary Mnuchin, Chair Powell, welcome back. The pandemic continues to have a terrible impact. More than 126,000 people have lost their lives in the United States, and this past Sunday, there were 40,000 new cases of COVID-19, the highest number of daily cases. And so the unemployment rate in May was 13.3%, nearly 4 times higher than it was last May. All of the job gains of the past decade have been wiped out. Communities of color have been affected disproportionately, both by the virus and its economic impacts. The Centers for Disease Control reports that as of June, Black and Latinx Americans are 4 to 5 times more likely than whites to be hospitalized for COVID-19. And half of all Black adults are not working. During the 2008 foreclosure crisis, we saw a similarly disproportionate impact on communities of color. This was followed by an unequal recovery where white households gained the wealth they lost. Black and brown households are still trying to catch up. We cannot endure another unequal crisis or unequal recovery. Your agencies and Congress must do all that we can to ensure that history does not repeat itself. So, I want to thank both of you for your efforts thus far and for the ways that you have worked with me and my members of this committee, including taking my many calls to strengthen the implementation of the CARES Act. Secretary Mnuchin, you have used your authority to provide community development financial institutions, that is, our CDFIs, and minority depository institutions, our MDIs, greater access to the Paycheck Protection Program, including by setting aside $10 billion for them to lend to ensure more loans go to small minority-owned businesses. Chairman Powell, you have worked with us to reduce the minimum loan size at the Main Street lending facility from $1 million to $250,000 and to extend the length of the loans. You've also broadened the eligibility of the municipal liquidity facility to increase access to a greater number of cities and towns. The CARES Act has provided important relief to struggling families and communities. But as the pandemic has strengthened, so must our efforts. And so with that, I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Well, thank you. Thank you all for being before the committee and behind these salad guards that we've arranged for you. Good to see your smiling faces behind your masks. But I'm grateful that we're able to assemble. This is certainly a large undertaking for the second largest committee in Congress. And I do want to commend Chairwoman for those efforts so that we can actually have this hybrid hearing. I think it shows that Congress and our government are still working. even if we have to do so using technology. Thank you all for your response and your active response since this crisis began. So I want to say, first of all, I believe the Fed and Treasury's decisive actions prevented the worst of the economic catastrophe, but there's still much work to be done. It's important to remember this is not a crisis that was caused by irresponsible choices by any specific industry or corporation. What we've seen is the impact of a voluntary shutdown of our economy and an effort to save lives. The Bipartisan CARES Act directed both the Treasury Department and the Federal Reserve to stand up responsible programs that would have been unthinkable even months ago, and to do so quickly, and you have done so rather quickly. Now that many of these programs are up and running, we must be forward-thinking to seek solutions to return us to the roaring economy that we experienced right before the global health crisis. That means we need to understand the nature of what we've done and what we need to do going forward. We know the pandemic has touched nearly every aspect of our economy and every family. Facilities discussed today need to be similarly far-reaching and responsive to economic conditions, not political ones. And I know there are a number of programs that have been desired by policymakers to be company-specific or something like that. That's not the appropriate response nor commensurate with the law. Moreover, members are going to have a lot of questions about fiscal policy, which I think Secretary Mnuchin is best fitted to, and monetary policy, which Chairman Powell is best suited to. And I think the understanding of that is important for us as policymakers to experience at the beginning of this hearing, rather than to hear you defer to one another. Our role in Congress is to assess the effectiveness of existing programs, determine the goals for additional relief programs, and identify the appropriate entity to provide that relief. That's our role. Of course, we need to access the key programmatic data. And so I want to commend Secretary Mnuchin for coming forward with the type of oversight material in a massive, unprecedented way, with the type of loan level data that we requested in Congress, and to provide that in a transparent way. The thousands of pages of documents that you and your team have assembled for just this committee alone is staggering in such a short period of time. So I hope my colleagues will use this data appropriately so that we can assess these programs and make sure they're working. And so I do want to commend you, Secretary Mnuchin, for the delivery of the PPP program so effectively and so quickly. It wasn't perfect, of course, but it saved millions of jobs. And Chairman Powell, I want to commend you. You've made your word good in terms of action. And that builds confidence in the institution of the Federal Reserve, that your words actually are as good as action by the Federal Reserve. So thank you for following through on your word and your commitment. So I think there's positive news in terms of the assessment for this initial response. And I want to thank you for being here at the first quarterly oversight hearing under the CARES Act. Madam Chair, on a personal note, I would like to welcome back our friend and colleague, the ranking member of the Oversight Subcommittee, Andy Barr, from his family concerns he's been attending to. So thank you, Andy. We welcome you back.
Thank you. Thank you very much. I now recognize the chair of the subcommittee on oversight and investigations, Mr. Green, for 1 minute.
Thank you, Madam Chair. Thank everyone. It is an honor to serve under your leadership, Madam Chair. The 2019 Home Mortgage Disclosure Act HONDA data were released last week and demonstrate that unequal access to credit on the basis of race and ethnicity remains the norm in America today. This is something that we can do something about. But there's a problem. Many of the people who have the authority and who are in positions to make a difference refuse to even acknowledge that the problem exists. I have the evidence. I have pictures from prior hearings. The one to my right asks, do you believe that discrimination in lending exists? One person has his hand up. He is with the NAACP. He is African American. The 4 Anglo persons on this panel refuse to raise their hands. These are the problems that we have to contend with. I yield back the balance of my time.
Thank you, Mr. Green. I now recognize the subcommittee's ranking member, Mr. Barr for 1 minute.
Madam Chairwoman, before I deliver my opening statement,
All right, we're going to take a brief break. We're going to get back to the important stuff. When we come back from the commercial break, that will be Jay Powell, as well as Treasury Secretary Steven Mnuchin.
Welcome into live market coverage here on Yahoo Finance. You're watching the ticker, and we are providing you live coverage right now of Fed Chair Jerome Powell and Treasury Secretary Steven Mnuchin's testimony right now in front of the House Financial Services Committee. That began just moments ago. We're hearing opening statements from committee members there, and shortly going to be hearing from Chair Powell and Secretary Treasury Mnuchin, and we will bring you that right now. We'll head there and listen in.
5 minutes to summarize your testimony. When you have 1 minute remaining, a yellow light will appear. At that time, I would ask you to wrap up your testimony so we can be respectful of the committee members' time. Secretary Mnuchin, you are now recognized for 5 minutes to present your oral testimony.
Thank you very much. And Mr. Barr, let me express my condolences for your loss. Chairwoman Waters, Ranking Member McHenry, and members of the committee, I'm pleased to join you today to discuss how the Treasury Department and the Federal Reserve are working together to provide liquidity to the credit markets, business, households, as well as state and municipal governments. We remain committed to making sure that every American gets back to work as quickly as possible. America's economy continues to recover from the challenges posed by the COVID-19 pandemic. The jobs report for the month of May vastly exceeded expectations with a record gain of 2.5 million jobs after experts had predicted nearly 8 million loss. While the unemployment rate is still historically high, we are seeing additional signs that conditions will improve significantly in the third and fourth quarters of this year. The Blue Chip report is forecasting our GDP will grow by 17% annualized in the third quarter and by 9% in the fourth quarter. The U.S. Chamber of Commerce reported this month that 79% of small businesses are at least partially open, and half of the remaining businesses are opening very soon. Retail sales rose in May by 18%, more than double the expectation. Investors in business have historically high cash positions, the highest level since 1992, indicating that private capital is ready to return as communities reopen. We are in a strong position to recover because the administration, working with Congress on a bipartisan basis to pass legislation and provide liquidity to markets in record time. In particular, the PPP is keeping tens of millions of employees connected to their jobs. Economic impact payments are also helping millions of families and workers through these challenging months. We are monitoring economic conditions closely. Certain industries, such as construction, are recovering quickly, while others, such as retail and travel, are facing longer impacts and may require additional relief. We look forward to continued conversations with you to address these critical economic issues. Treasury has been hard at work implementing CARES Act's program. The PPP, we've approved over 4.8 million small business loans for $519 billion. Economic impact payments, we distributed nearly 160 million payments in record time. Programs to support aviation and other eligible business, we have approved and dispersed over 27 billion to over 500 airlines and other aviation business, preserving hundreds of thousands of jobs. We're in the process of documenting loans to business and critical national security for approximately 25 billion. The Coronavirus Relief Fund, from this fund, we've distributed $150 billion across states and local governments, nearly half of all in additional money to tribal governments. The CARES Act also granted Treasury the authority to provide $454 billion to support Federal Reserve lending facilities under Section 13.3. Since March 17th, using funds available, I have approved a number of Federal Reserve programs. The Commercial Paper Program, the Primary Dealer Program, the Money Market Mutual Program, the TALF, the Primary Market Corporate Credit Facility, the Secondary Facility, the Main Street Facility, the Municipal Facility, and the PPP Lending Facility. We have committed approximately $200 billion, and to support these, the announcements of these programs have helped unlock markets and promote much-needed access to liquidity. We have over $250 billion remaining to create or expand programs as needed. While we're beginning to have conversations about supplemental relief legislation, we look forward to working with Congress on a bipartisan basis in July on any other further legislation that will be necessary. Treasury has already been entrusted with a tremendous amount of funding to inject into the economy. We are closely monitoring these results and seeing conditions approved. We would anticipate that any additional relief would be targeted to certain industries that have been especially hard hit by the pandemic, with a focus on jobs and putting all Americans back to work who have lost their jobs through no fault of their own. The Treasury Department is implementing the CARES Act with transparency and accountability. We are providing information to the government-wide reporting on USA spending and updates to Congress. We're also cooperating with the Congressional Oversight Committee, GAO, and others. We are pleased that the Federal Reserve has announced plans to boost loan information on its website regarding its facilities. Chair Powell and I have had very productive initial meetings with 4 members of the Oversight Committee, and we look forward to continuing to work with them. Thank you very much.
Thank you. Chair Powell, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and other members of the committee, thank you for the opportunity to testify today to discuss the extraordinary challenges our nation is facing and the steps we're taking to address them. We meet as the pandemic continues to cause tremendous hardship, taking lives and livelihoods both at home and around the world. This is a global public health crisis, and we remain grateful to our healthcare professionals for delivering the most important response, and to our essential workers who help us meet our daily needs. These dedicated people put themselves at risk day after day in service to others and to our country. Beginning in March, the virus and the forceful measures taken to control its spread induced a sharp decline in economic activity and a surge in job losses. As the economy reopens, incoming data are beginning to reflect a resumption of economic activity. Many businesses are opening their doors, hiring is picking up, and spending is increasing. The economy has entered an important new phase and done so sooner than expected. While this bounce back in economic activity is welcome, it also presents new challenges, notably the need to keep the virus in check. While recent economic data offer some positive signs, we're keeping in mind that more than 20 million Americans have lost their jobs and that the pain has not been evenly spread. The rise in joblessness has been especially severe for lower wage workers, for women, and for African Americans and Hispanics. This reversal of economic fortune has caused a level of pain that's hard to capture in words as lives are upended amid great uncertainty about the future. The path forward for the economy remains extraordinarily uncertain and will depend in large part on our success in containing the virus. A full recovery is unlikely to occur until people are confident that it's safe to engage in a broad range of activities. The path forward will also depend on policy actions taken at all levels of government to provide relief and support the recovery for as long as needed. The Federal Reserve is strongly committed to using our tools to do whatever we can for as long as it takes to provide some relief and stability to ensure that the recovery will be as strong as possible and to limit lasting damage to the economy. After lowering the federal funds rate to essentially zero, our actions so far fall into four categories: stabilizing Treasury and agency MBS markets, money market and liquidity and funding measures, direct efforts to support the flow of credit in the economy, and targeted regulatory measures to support those efforts. So far, we've created 11 facilities under Section 13(3) of the Federal Reserve Act to support liquidity, funding, and the flow of credit to households and businesses and state and local governments. Without access to credit, families could be forced to cut back on necessities or even lose their homes. Businesses could be forced to downsize or close, resulting in further losses of jobs and incomes and worsening the downturn. Our emergency lending facilities have all been undertaken with the approval of the Treasury Secretary, and many are supported by funding from the CARES Act. Their status and effects are discussed in greater length in my written statement, which I've provided to the committee. The Fed will continue to use these powers forcefully, proactively, and aggressively until we're confident that the nation is solidly on the road to recovery. When the time comes, after the crisis is passed, we will put these emergency tools back in the toolbox. I would stress that these are lending powers, not spending powers. I will also note that we design our facilities to work for broad ranges of businesses and municipalities. We do not target particular firms or industries. Elected officials have the power to tax and spend and to make decisions about where to direct such targeted relief. The CARES Act and other legislation provide direct help to people, businesses, and communities. This direct support is making a critical difference, not just in helping families and businesses in a time of need, but also in limiting long-lasting damage to our economy. Public faith in our operations depends on transparency. At the Fed, we're committed to that transparency, particularly in deploying our emergency powers. Thank you. I'll look forward to our questions.
Thank you very much, Chairman Powell. I now recognize myself for 5 minutes for questions. As I mentioned in my opening, the pandemic is strengthening, and so too must our response. 2 weeks ago, Chair Powell, when I asked you about the need for more congressional action to protect our communities, you said, and I quote, "There are something like 25 million people who are still dislodged from their job in full or in part due to the pandemic. I would think it would be a concern if Congress were to pull back from the support that it's providing too quickly," end quote. Unfortunately, tomorrow this is exactly what will happen if the Senate does not pass the HEROES Act. Tomorrow the PPP program stops taking new loan applications. The PPP should be extended immediately so that the remaining $135 billion in funding can support small businesses. Also happening tomorrow, millions of families will be unable to pay their rent and mortgages. In June, 1/3 of renters couldn't pay rent. 4.2 million homeowners are currently in forbearance because they're unable to pay their mortgages, and evictions have already started in many states where local eviction moratoria have expired. While the moratorium should be extended, it is not conscionable to simply delay an eviction and foreclosure crisis. Congress and the administration must provide support to struggling low-income families to cover their rent and utility payments. So, Chairman Powell, millions of families are at risk of being stripped of their homes. Do you think Congress should provide financial assistance to ensure people stay in their homes?
Thank you, Madam Chairwoman. So I try to keep my fiscal comments at a very high level, and that comment you referred to was referring to the unemployment insurance that expires at the end of July. And I think for the specifics of what you need to be doing, I think we have the Treasury Secretary here, and I would defer to the Treasury Secretary on fiscal matters here.
Okay,
So you put it off on Mr. Mnuchin. So while you have made some changes to broaden the municipal liquidity facility, many jurisdictions like the territories are still locked out. When we last spoke, you mentioned that it was difficult, but perhaps there was a way that Guam may be eligible. Did you find a way to take a serious look at that and determine whether or not something could happen?
Yes, we are taking a serious look at that. So the territories themselves are not investment grade rated, and they weren't before the pandemic set in, and that's the minimum standard for access to the municipal liquidity facility. Of course, businesses in the territories would be eligible for the Main Street facility. Some of the revenue-based facilities that that Guam has are investment grade rated, but below the minimum, and we're actually reviewing our credit standards in the municipal liquidity facility at the moment to determine if there's a way to adjust the facility in a way that would make eligible some creditworthy issuers without sort of violating the spirit or letter of Section 13.3.
Thank you. Secretary Mnuchin, with critical unemployment support expiring next month and today marking the last day that Treasury and SBA claim that new PPP loans can be approved, does the administration support extending these programs as proposed in the HEROES Act?
Well, we do support additional legislation, and we look forward to working with the House and the Senate on that. As it relates to the PPP, I've already had conversations with the SBA committee in the Senate about repurposing that $135 billion and think that should be done, and look forward to working with both the House and the Senate so that we can pass legislation by the end of July.
Thank you very much. I now yield to
maybe not.
No. The gentleman from North Carolina, Mr. McHenry, is now recognized for 5 minutes.
Well, thank you for your testimony, Secretary Mnuchin. I think there's wide agreement that your engagement in the PPP program made things largely better, right? The Treasury expertise in making sure that SBA could deliver on this really seminal program of the CARES Act. It's proven out because you got 4.5 million small businesses that have benefited from it. The average loan size is quite modest in the context for our economy, but the effect is pretty wide scale. So what would you say regarding the additional funds that are purposed for PPP? What should be our focus as policymakers on repurposing that $134 billion? How can we best do that? Is it the 7A program? Is that expedited loan programs? How do you see this fitting in, given the actions of Main Street and the other facilities you've stood up through the Fed?
Well, thank you, and I appreciate your comments. I think at the time when we passed the last CARES Act, the economy was in very difficult shape, and we needed to get money quickly. And as I'd said before, programs that took 3 or 4 months were not the focus. I think that there appears to be bipartisan support in the Senate to repurpose the $130 billion for PPP, extending it to businesses that are most hard hit, that have a requirement that their revenues have dropped significantly, things like restaurants and hotels and others, where it is critical to get people back to work.
Okay, and so that seems like a reasonable step in the right direction. Chairman Powell, the reputation you've garnered this year in particular is that your actions have been predictable, and that you signal what you're going to do and you follow through on it. Transparent, in that you lay out the metrics for action, you therefore follow those metrics. Incredible. One example is that at announcement, you said that you're going to support corporate bonds. And by saying that you're going to support corporate bonds, the market acted as if the Fed already had the program up and running, to the point where once you were up and running, people ask why you followed through on that program. Now, I think that's important to note. That transparency, that guidance, that communication has been effective in this opening stage in setting up these responses. So along those lines, the Fed took what I would call strong medicine in terms of action on the stress tests to restrict dividends and buybacks. and restraints on these large financial institutions. I would call that quite strong medicine. I think what we want to understand are the metrics that the Fed is going to use in order to make these judgments and assessments sort of in this next phase over the next couple of months for these large financials.
So I think you have to start with the sort of two major facts here. One is that the banking system is very strong, has been a source of strength. The banks have been taking on a wave of deposits. They've been engaging in forbearance. They've been making loans. So they're a source of strength in this situation, unlike the last crisis where they were a source of weakness. It's also a fact that things are highly uncertain. And so to preserve that strength, what we've done is we've stopped all share repurchases and we've stopped increases in dividends. So we're preserving the level of capital in the system. So to address the uncertainty and looking forward, we did run these three sensitivity analyses, and they were really to assess the overall strength of the system in the face of these downside cases. We found that the majority of firms were still adequately capitalized, sufficiently capitalized in all of those scenarios. Notwithstanding that, what we did was that we said for the first time in the history of these tests, we said that we're going to ask the banks to resubmit their capital plans. We're going to distribute scenarios, and we're going to look at the results again as we learn more about the path of the crisis. And in terms of the precise metrics we're going to be looking at, we'll be providing more clarity about that going forward.
But based off that uncertainty, you want to you're asserting as a regulator that you will actively review this to ensure that we don't have a financial crisis as a result of this health crisis.
Yes, we're going to keep monitoring this. We're learning so much every quarter, and the path of the economy is highly uncertain. And in our system, dividends are declared every quarter. We've already stopped the overwhelming majority of distributions, so we think that's the right place to be.
Thank you. Thanks for your leadership and effectiveness, and thank you as well, Secretary Mnuchin, for your effectiveness and leadership. Yield back.
All right, there you go. We're going to take a quick break here and bring you much more from the committee, House Financial Services Committee hearing right after this. Welcome back to live market coverage here on the ticker. Right now, we still have the Dow trading sideways since the House Financial Services Committee hearing with Fed Chair Jay Powell began just a few moments ago. The Dow only off by about 0.2% right now. We now resume coverage there with questioning now being held up here by New York Representative Carolyn Maloney. We'll take you there now and resume coverage.
Well, thank you. I appreciate your comments, and I assure you we are very much committed to working with the oversight committees on transparency. Now, as it relates to this, I can assure you it was not bad faith. I'm happy to have our office follow up with you. It has to do with a technical issue of recipients reporting. As it relates to the issue of monitoring state spending, I'm more than happy to put the PRAC in touch with our Inspector General, who has primary oversight, and make sure that whatever information specifically the PRAC wants on the states that we accommodate.
Well, I would say that that's not what I'm asking. What I'm asking is, will you commit to interpreting the PRAC's oversight authorities as applying to all of the CARES Act spending? That was our intent. I wrote that section of the law. That was what Congress wanted. There's no problem with the interpretation. It's very clear and explicit. Will you commit to allowing the oversight that was in the bill?
Well, I appreciate you wrote that portion. I would also say I appreciate I had very direct discussions with people in the Senate about various different oversight. That's why we agreed to a new oversight committee with full transparency. We agreed to provide information that was not required under 13.3. So we have full transparency. And again, I'm happy to follow up with you on the specific concerns as to which different entities should receive what information. I think it's important that there is not bureaucratic overlap, but again, let me emphasize, if the PRAC needs certain information, we will try to do what we can to accommodate it.
Well, I'm very disappointed with that answer, and I guess we'll have to pursue a legislative solution. It was very clear that the intent of Congress is that PRAC would have oversight of all of the CARES spending. I yield back. And I'm out of town, out of time.
The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. And thank you for joining us today, Secretary Mnuchin and Chairman Powell. I want to commend you both on the outset here for your leadership during this unprecedented time. Both the United States Department of Treasury and the Federal Reserve System have shown their ability to both effectively and rapidly respond to the economic crisis caused by COVID-19 by providing trillions of dollars to stabilize our economy. Chairman Powell and Secretary Mnuchin, lender registration for the Main Street lending program went live on June 15th, I believe. Do either of you know how many lenders have registered so far? And do you know the average size of the lenders participating? If not, when do you think this information might be made available? I'll toss it to either.
Sure. So in the range of 300 banks, and it may be higher than that, that number's a few days old, have entered the registration process. It takes a few days, so I can't tell you exactly how many, but that's how many will come out of the pipeline.
Average size of lenders
Don't
participating?
know. The size ranges from the large to the very small, and the very small are particularly well represented, but it does range across the full spectrum.
And you will be providing this information to us on a regular basis?
We're working with the borrowers to figure out the right way to connect lenders and borrowers and lenders so they can get in touch with each other. So we're working with the lenders to put something together that will make that happen in the most efficient way.
Thank you, Chairman Powell. In your efforts to create broad-based programs, do you think that the Main Street facility will need to expand any further to meet the needs of our businesses?
Let me say as you've seen, the Secretary and I have worked very closely on this, and we've been very willing to learn from experience and learn from what we're hearing from different parts of the economy. So we
certainly did with the PPP program, so I would hope that we would approach this the same way.
We will. I mean, as you know, we're in the relatively early stages of opening up a nonprofit Main Street facility, and I think we'll be watching as regular Main Street fully comes online and continuing to look to see whether there are ways we can improve it.
Thank you. Chairman Powell, last week's release of the Federal Reserve's CCAR outcome and, more importantly, the results of their COVID-19 sensitivity analysis underscores the resilience, I think, of the banking system. While we can all agree that the level of uncertainty in the economy continues to be high given the progression of the COVID-19 pandemic, I believe the Federal Reserve subjected CCAR filers to extraordinary assumptions regarding unemployment and GDP contraction. Despite these assumptions, the 33 largest banks remained above minimum Tier 1 capital requirements. Given that, I'm wondering why the Federal Reserve has indicated firms will need to resubmit capital plans, and in addition, there will be an off-cycle supervisory stress test in the, quote, latter part of the year. The Federal Reserve already concluded firms' capital planning, management processes, I think approaches and assumptions passed the toughest tests. So could you explain that, please?
Sure. So what the 33 institutions all passed was the regular way severely adverse scenario that we wrote before the pandemic arrived. So that's what controlled the outcome at this time. We also, though, remember the pandemic arrived right in the middle of the stress test period. So we quickly devised, without going through our usual very thorough vetting process, 3 alternative sensitivity analysis, one of which was a V-shaped recovery, one of which was U-shaped, and one of which was a serious double dip. And these are very serious downside cases. We didn't use them to evaluate individual institutions, but rather to evaluate the broad range of institutions, and we didn't.
I'm running out of time, and I just, why lock up additional capital now? I guess this has the potential to have, I think, a chilling effect on the economy at exactly the point where banks need to provide credit and liquidity to households and businesses to facilitate economic recovery and support financial intermediation in the capital markets. So I leave you with that.
We didn't do that. We're not looking to raise capital standards
Okay.
during a crisis. That's not what's going on here.
Thank you for that clarification, and I yield back.
Thank you. The gentlewoman from New York, Ms. Velasquez.
All right, and there you go. Fed Chair Powell there trying to defending against the banks. We'll bring you much more from the House Financial Services Committee hearing with Fed Chair Jay Powell and Secretary of the Treasury Steve Mnuchin. Much more coming your way right after this. Well, welcome back to live coverage here on Yahoo Finance. You're watching the Ticker's live presentation of the House Financial Services Committee hearing with Fed Chair Jerome Powell and Secretary of the Treasury Stephen Mnuchin. Right now, stocks trading pretty range-bound. The S&P up by about 0.6%, not moving much in the 30 minutes that we've heard so far, but we will take you there now as Congresswoman Velasquez from New York is picking up the line of questioning.
Congress. We know that 4 million businesses access the program. But what about the millions of minority and women-owned businesses that were not able to access the program? So you're saying maybe a restaurant might need to get a second loan. I just heard Senator Marco Rubio. Well, no one should get a second loan unless we know that most businesses who are struggling get a chance to get a loan. Chairman Powell, as chair of the House Small Business Committee, I am particularly concerned about the state of our nation's small businesses as the pandemic poses an acute risk to their survival. How would the failure of small businesses, especially those that are women or minority-owned, adversely affect the communities they serve, particularly those of color? What impact could these failures have on future labor market conditions?
Of course, the effects could be very significant. Small businesses generate most of the jobs and most of the growth in the economy, so that could be very important, particularly in minority communities.
Chairman Powell, earlier this month, the OECD said the pandemic has triggered the most severe recession in a century and warned that the global economy could contract by 7.6% this year should a second outbreak hit. Do you agree with this assessment?
That particular number, there's a range of assessments, but I would say that that's in the range, and yes, I can't think of a more.
And what impact do you see a second outbreak having on both the U.S. and the global economy?
Well, I certainly wouldn't forecast that, and so this just hypothetically, a second outbreak could force governments and force people to withdraw again from economic activity, and I think the worst part of it would be to undermine public confidence, which is what we need to get back to lots of kinds of economic activity that involve crowds.
Thank you. I yield back.
Thank you. Mr. Lucas, you're recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell and Secretary Mnuchin, thank you for attending this hearing today. And I want to begin by commending Chairman Powell on finalizing the inter-affiliate margin rule. This may be the last time we discuss this, sir. While these rules may seem abstract and difficult to understand, they have a real impact on agriculture and oil and gas producers back home that use financial derivatives to manage risk and plan for the future, which, as we've seen in past months, can be, to put it mildly, unpredictable. That said, as both of you know, commercial paper finances a wide array of economic activity and provides liquidity for companies to meet their operational needs. With the commercial paper market under significant strain due to COVID-19, in mid-March, the Federal Reserve established the Commercial Paper Funding Facility to encourage investors to lend in the commercial paper market, which ultimately supports businesses and jobs across the country. Chairman Powell, could you describe the current indicators of how the commercial paper market responded to the creation of the facility? And has there been a discussion, to expand the facility to address liquidity issues faced by Tier 2 issuers?
So the commercial paper facility has substantially healed. As you point out, it really closed there in the beginning part of March, as so many markets did. And when we announced the facility, the highest graded borrowers were able to start borrowing, and so largely, but not completely, that market has returned to fairly normal function, and we're watching it carefully. I would say we're not currently assessing whether to broaden that facility, but should the situation deteriorate, we would have that as an option.
Thank you. Secretary Mnuchin, there have been reports that China is restricting global agricultural imports due to COVID-19. How are we working to resolve this with China, and do you anticipate this impacting the terms of the Phase 1 trade agreement to purchase $200 billion in U.S. goods and services, particularly the commitment to purchase $40 billion in U.S. farm products?
Well, let me just first emphasize we have various serious concerns about the lack of transparency from China as it relates to COVID. Having said that, we have every expectation that they will support and live up to the Phase 1 agreement, and they are well on their way for those commitments.
One last question. Native American tribes have been hit particularly hard by COVID-19. Tribal employment is often concentrated in arts, recreation, and accommodation industries. How has the Federal Reserve and Treasury been looking specifically at the economic challenges faced by tribes?
I can answer as to Main Street. Of course, the tribal businesses are eligible for participating in Main Street, and that's where a lot of the economic activity is there. The tribes themselves are not really general obligation issuers, so they're not particular candidates for the municipal facility.
Thank you. And with that, Madam Chair, I yield back the balance of my time.
Thank you. Mr. Chairman, you are now recognized for 5 minutes.
Thank you. Secretary Mnuchin, I'm a very nice guy, so I won't mention the press reports that say that over $1 billion in stimulus payments have gone to people who are deceased. But I will urge you to adhere quickly to the agreement that you've made with the Senate Small Business Committee to very quickly release the names and data about all PPP borrowers that have borrowed over $150,000. Chairman Powell, back on March 12th, I sent you a letter urging that you prohibit stock buybacks by banks. You have done so. Thank you very much. About 2 weeks ago, you went on the record to say, I would think that it would be of concern if Congress were to pull back their support, having just said that there are 25 million people who have been dislodged from their job. I thank you for that advocacy, and I hope Congress listens. We need to do more to stimulate this economy under these circumstances. Secretary Mnuchin mentioned the support that he's providing to local and state governments, but that is all in the form of loans, and of course, almost all state and local governments can't run a deficit. So with their revenues down by hundreds of billions of dollars, I hope we pass the HEROES Act and actually provide aid to state and local governments. One issue, Chairman Powell, for the Main Street lending program that is particularly relevant to commercial real estate is that if they get a loan from you, they violate the loan covenants that they have in their existing mortgage. I look forward to working with you on that. One possible solution is the bill that I submitted and we've had hearings on in this committee, the Business Borrowers Protection Act. Certainly getting a loan on a program that we've authorized because of the COVID crisis should not trigger and make a pre-existing mortgage immediately due and payable. I want to spend this morning at the White House with a few of our colleagues getting briefed on Russian involvement in Afghanistan. And it appears to me, Secretary Mnuchin, that they have been bold. They have killed our soldiers because when they do something else that we catch them on, we don't sanction them very much. The debate now is whether they took the obscene step of putting a bounty on the heads of individual soldiers, or whether they've limited their involvement to Afghanistan to just aiding the Taliban, but not correlating that aid to how many dead Americans this or that operation created. Of course, the response from the administration to this seems to be, well, let them into the G8 and otherwise help them. That kind of lax response will lead to more deceased American soldiers. Under the Chemical Weapons Act, which Congress passed a couple years ago, your department was supposed to sanction Russia for their violation of the Chemical Weapons Act when they used poison to try to assassinate a Russian dissident in Britain. But you opted for the weakest sanctions allowed by the Act. It doesn't apply to ruble what it does is it prohibits certain loans from Americans to the Russian government. But it doesn't apply to ruble transactions. It doesn't apply to loans to state-owned enterprises. And it apparently doesn't apply to purchases in the secondary market. Given the fact that our under-sanctioning of Russia has led at least to their aiding the Taliban in a general sense, and according to press reports has led to the specific putting a bounty on our soldiers. Could you revisit your decision on this existing law and impose these bans on ruble transactions, state-owned enterprises, and secondary markets?
Well, you covered a lot of things.
It must be a tough question. You took off your mask.
Let me just comment on, we believe we followed the law and selected amongst a series of items at the time, but I'm happy to go back and I recall the situation. I'm happy to go back and look at it again.
There are credible reports that they put bounties on our troops. Please look at it again.
Well, again, on that, I just want to be clear. So for the record, I am not commenting on classified information, nor do I think it's appropriate in this setting to talk about alleged information that's in the press.
Mr. Posey, you are now recognized for 5 minutes.
Thank you, Madam Chair and Ranking.
All right, we'll pick up our continued coverage of the House Financial Services Committee hearing right after this short break. Welcome back to live coverage here on the ticker right now. The Dow moving lower as the House Financial Services Committee hearing drags on here into minute 45. The Dow off by about 67 points, so it has traded mostly sideways. We'll bring you back to that coverage there from Washington, D.C. now.
Are very strict contractual obligation, and that's why one of the things I do think we need to look at in the next CARES Act is additional funding for these industries that are the hardest hit so they can continue to rehire people so that as occupancy increases that they have employees that they can maintain.
Great, thank you. I recently wrote to both of you expressing my concern for businesses that are asset-based, and I believe they'll face hurdles to assessing Main Street lending facilities because of the nature of their business challenges, their ability to meet lending criteria, based on the earnings before interest, tax, depreciation, amortization, so-called EBITDA. For example, an aircraft developer in my district, especially an R&D organization, falls into this category. And I wonder if you could tell me what the possibilities are of providing access to Main Street lending facilities for businesses like that. And you go first, Mr. Secretary.
We've discussed about looking at asset-based financing, and that's something we continue to discuss with the Federal Reserve.
Okay. Mr. Powell?
Yes, that's where we are.
All right. Thank you, Madam Chair. I'll yield back.
Thank you. Mr. Clay, you're now recognized for 5 minutes.
Thank you so much, Madam Chair, and thank both witnesses for your participation today. Mr. Secretary, I'm somewhat troubled by recent reports that some banks have taken stimulus payments from individuals and families with garnishment orders or negative account balances to offset unrelated debts owed to them. I find it troubling that banks would serve as debt collectors at a time like this when families need the resources most. When will Treasury issue guidelines articulating your expectation that financial institutions refrain from taking stimulus funds away from their customers during a time like this?
Well, let me first say I agree with you and that I think it would be awfully unfortunate if banks are doing that. We have had inquiries about the issue of garnishment, and we agree from a policy standpoint that there should have been no garnishment. Unfortunately, that's something we need to address in the next CARES Act if we do additional direct payments, because there are certain state laws that were not overridden in the existing CARES Act. But my understanding that's a state issue and not a federal issue. We agree from a policy.
But think about the cruelty of the policy. Wouldn't you want to?
As I said, I agree with you on the policy.
Couldn't you all issue a blanket?
We've asked our legal department, and unfortunately we can't, and that's one of the things we would want to fix in the next CARES Act. So we agree with you from the policy standpoint.
Thank you. Chairman Powell, for many nonprofits and small businesses, earnings before interest, taxes, depreciation, and amortization is not a widely used metric. Have you considered applying other metrics of debt, future growth, or financial health to the Main Street lending program so that nonprofits and small businesses are fully able to participate?
Yes, as a matter of fact, we have, particularly for nonprofits, of course, earnings before interest taxes doesn't make any sense. So you don't need to take taxes out. They're nonprofits. They don't pay tax. So we're looking at a range of, and we actually put this out for comment. We got a lot of very thoughtful comments from the nonprofit community of looking at cash flow and also financial resources more broadly. In terms of companies, EBITDA is just basically pre-tax cash flow. It's a very widely used metric, but there are other metrics. And as the Secretary mentioned, one of them, probably the next one in line, is something along the lines of asset-based, and that's something that we're looking at with the Treasury.
Now, under the Main Street lending program, you reduced the minimum loan threshold from $1 million to $250,000, and then by expanding the program to nonprofits with more than 50 employees. However, many small businesses may not need $250,000. Mr. Chairman, has the Fed considered eliminating the minimum loan threshold altogether?
We have not considered eliminating it yet. Of course, and we're just now getting rolling with loans, as you know. So we can, once we get up and running, look at lowering it again. But you get into a very different kind of lending when you're down lower. These are really personal loans rather than business loans. They're generally guaranteed by the business operator. And we could look at that, but that would be something we'd look at once we get up and running.
Yeah, but I mean, it's kind of concerning that you have that threshold at $250,000 when, say, a small business in St. Louis needs $100,000. to survive through this pandemic until they get back on their feet. Any consideration given to accommodate?
Yes, no, we can see ourselves possibly lowering the threshold again, but just logistically, for us to be making very, very small loans would be difficult, and those people may be better dealt with through fiscal policy. But I can see us down the road looking at a lower threshold.
I see. And thank you both for your responses. And Madam Chair, I yield back.
Thank you. Mr. Scott, you're recognized for 5 minutes.
Thank you, Chairman.
Yeah,
I'm on now.
Yeah.
I think I need. Chairman Powell. Now, we all know that job losses have disproportionately impacted women, African Americans, and other minorities, but at the same time, our capital markets have improved significantly since the epidemic. Why is this? Is there something you're doing more so to help the capital markets than helping job losses corrected?
No, not. In fact, the objective of everything we're doing, every single thing we're doing, is to take the 25 million people whose working lives have been disrupted and create a situation in which they have the best chance to go back to their old job or to get a new job. And that includes all the facilities that we're doing. That's the overriding goal of what we're doing, and every one of them helps in that direction.
Yeah, I know that's your goal, but what I'm trying to get at is it correctable? Are there some things you can do to fix this imbalance between staggering, lowering unemployment and soaring rise in our financial capital markets?
So we're trying to, what we've been trying to do is create accommodative financial conditions and supportive financial conditions so that when the economy reopens, remember we sort of deliberately closed down, so that when the economy reopens, that expansion can be vigorous and strong, and it's just beginning now. So our support for that is part of what's driving the job growth that you saw in May, which was surprising to the upside.
Yeah, I also, while we got both of you all here, I want to pick up on what Chair Lady Waters was saying. We got a great opportunity here to do both of these things with our housing and homeowner tranche that we're putting forward. This goes right into the belly of our economic wheelhouse, jobs, keeping people secure. Because it's coming, man. When you lose 25, 30 million people lose their jobs, how they going to pay their house note? How they going to pay the rent? How they going to pay utilities? And more than that, how the banks and the financial institutions going to get their mortgage payments in so that they can make payments for the securitization of those mortgages that keeps our financial system healthy. So I want to ask you to make sure that you all start talking about these things that we are putting forward. May not be everything you agree with us on, but this is one that is very important. Now let me go to one other area, to you, Secretary Mnuchin. None of the lending facilities established have targeted the needs of our agriculture industry. Now, why do I mention that? Food. It's coming. I mean, I can't see why people can't see this crisis. Food shortages are coming. It's almost like the farmers have been the forgotten ones. Are they qualifiable as small businesses? many of them don't know. They're sort of out there, just drifting along the misty flats. What are you all doing to help lift up and make sure that we give our farmers, our rural communities, the kind of help that they need? Because all the food chain is going down. You hear about the closures. The food processors are going out. Farmers are coming. These are small, most of them, but they're very important. Why can't they be qualified as small businesses? Where are they? They're getting lost in the shuffle. And if we get a food shortage, we're in, well.
Thank you, Mr. Lukemeyer. You're recognized for 5 minutes. I would encourage all of the members to keep their masks.
All right, there you go. We're going to bring you much more coverage here, as it looks like the hearing is going to be extending past its 2 p.m. hard stop that we heard from Chairwoman Waters. We'll bring you much more from the hearing on the other side of the break here on The Ticker. Stay with us.
Welcome back to the second hour of The Ticker. I'm Julia LaRoche in New York. It's 2 p.m. We're going to send things back down to Washington, D.C., where we have Federal Reserve Chairman Jerome Powell and Treasury Secretary Steven Mnuchin before the House Financial Services Committee.
Most recently, Senate sent a bipartisan letter to FSOC urging for delay in CECL implementation for all entities until 2022, so that every entity, both banks and non-banks, which were not included in the CARES Act, on the same footing, and Treasury can conduct this study with the input of a real-life scenario that we have ongoing today. Given the actions by Congress and the prudential regulators, should we delay CECL as I and my colleagues have called for? And should the Treasury examine the real-life scenario we've gone through when conducting their study? Mr. Mnuchin?
I think that should be seriously considered, and yes, we are working on the study.
You know, the President issued an executive order with regards to each agency going through and looking at all the rules, regulations, that were either waived, declined, changed, whatever. If they don't work now, why should we continue them down the road when we get out of this mess? And so I assume everybody is doing that. And this particular accounting principle would seem to fall in that area of we need to be looking at this as something down the road we need to get rid of in its entirety. Mr. Powell, Chairman Powell, would you like to comment on this as well?
No, I would agree.
Okay. Thank you. Appreciate that, because I think there's a time and place for rules and regulations. There's a time and place that if they're not functioning, we need to get rid of them and start over. With the nationally recognized statistical rating organizations, in the Federal Reserve emergency facilities. I know you've heard a lot about this issue from members on both sides of the aisle. Chairman Powell, especially, the Fed took modest steps to include smaller NRSROs in the most recent FAQs, but only if those ratings are accompanied by one of the three incumbent NRSROs. I remain concerned that the Fed's unilateral and haphazard tiering of these NRSROs is going to have serious implications for small and mid-sized businesses. Have you examined the impact the delineating between the large and smalls is having in the marketplace?
Well, as you mentioned, we started out getting these facilities set up very quickly, and we just went with the big three. After that, I think more than a month ago, we broadened it out to another group after taking a look. And, we're balancing the need to move quickly and to move with institutions that we know well or that are well known, and then we've included more and more, and that's a process that we're still looking at.
Okay. All right. Thank you very much. I yield back, Madam Chair.
Thank you. Mr. Huizinga, you are now recognized for 5 minutes.
Point of inquiry, Madam Chair, should it not be on the other side of the aisle? Oh, I'm sorry. Okay. All right. So, well, thank you. I appreciate that. Chairman and Mr. Secretary, the word unprecedented has been banned in my house by my college, graduate. He graduated remotely because he was looking around and was a little tired of that word maybe being used. So he has a history. His grandfather, my dad, was born in 1921 on a kitchen table in the hired man's home. My mother was born in 1931 in Flint, Michigan. Yes, that Flint, Michigan, and had to move to Oklahoma into the Dust Bowl in the middle of the Depression to try to survive when they lost their house and my grandfather lost his job. We know that there's history behind this. So I'm not sure if this is unprecedented. It certainly may be unprecedented in a way in the modern era where we've seen the government come in and sort of shut this down. But what we do know is from looking at history is we need to get the economy moving again. Now the question is how? Whether it's getting kids back to school, as some have suggested, because if you can't get kids into school, that's not going to then free up those parents to be available to work. Anecdotally, in my area, I know that manufacturers and service companies are having a very difficult time getting enough workers to come in to complete a full contingent of line workers, for example, or to get a full shift filled. And there's various reasons. Some have debated about the $600 additional per week kicker as being a bit of a disincentive. But nonetheless, we know that we have to address those folks who really, truly are not able to get a job, and how do we distinguish from those that are just deciding not to take that job. One of the things that I have proposed is something called the Patriot Bonus. Patriot Bonus would be a 50% tax credit to any company that would give a per-hour bump to their employees, or a weekly bonus to their employees, or even a one-time bonus to their employees, to incentivize them to come off of that unemployment insurance system and get back engaged in the workforce. And I think it's critical that we do that. I do want to say also thank you for your work on the Paycheck Protection Program. I've talked to Cheryl, who owns a very popular bagel and coffee shop in my hometown, who knows that she survived because of it. Don, who owns a bowling alley in my district, who was able to keep his folks on the payroll. Those types of things are critical and were very, very important. As we're shifting to the Main Street program, I do want to draw attention, and Chairman Powell and I had this conversation a couple of weeks ago. I brought up Lacombe. Lacombe is a Philadelphia-based company that has a manufacturing production facility in my district. It's a 26-year-old fast-growing company. You may have gotten their coffee in the can, and they produce a number of great products. But for the last 6 years, they've been really focused on their growth. And that also means they've had to borrow a tremendous amount of money, and that led to an accumulation of debt. Under some of the rules as they're currently written, Lacombe would not qualify to participate in the Main Street lending program. And I believe that the way that the leverage ratio requirements in the program are currently drafted really sort of frankly punishes companies like Lacombe and others who would otherwise be viewed as really, frankly, success stories. If it is the way the rules are currently written, it's designed to prevent funds from going to companies that have this debt, but sometimes those companies might be some of those that need it the most. I'm hoping that you'll commit, Mr. Secretary, to working with me on that to address that issue.
Yes, I'm not familiar with the company, but we're happy to follow up with you and see if it can work.
Great. And then in the remaining time, I talked to Jeff this morning. Jeff is 52. Talked to Jim and Liza. He's 64. She's slightly younger. She won't tell me exactly how old. But what I do want them to know is I want them to hear from you. What do you want to tell them and the rest of Joe and Jane 401k that have their small investments in the markets that are there, frankly, to help them as they approach retirement? What assurances can we give them about the economy?
Well, I want to tell them and all the other people that we are going to work with Congress to make sure we can do whatever we can do to get everybody back to work who lost their job because of COVID. And I'm also extremely optimistic about the research that is being done on vaccines and virals and us combating this terrible disease.
Thank you.
Yeah, I would just say
Mr. Meeks, you're recognized for 5 minutes.
You're listening to Secretary Mnuchin and Reserve Chairman Jerome Powell talk about their actions as it relates to recovering from this pandemic. We'll bring you more from Washington, D.C. when we return. You're watching the ticker on Yahoo Finance. We're going to send things back down to Washington, D.C., where we have Treasury Secretary Steven Mnuchin and Federal Reserve Chairman Jerome Powell before the House Financial Services Committee talking about their efforts as it relates to the recovery from the COVID-19 pandemic.
From trust funds into MDIs, either directly or through custodial accounts, but it does not do so. And since we agree that we need to have investments, would you agree that MDIs play a critical role, as we found doing PPP, in providing minority communities access to capital? And ask you then, will the Treasury use its existing authority and capital to provide direct support to MDIs?
I'll have to review those authorities and get back to you. So if that's something we have, it sounds very interesting. I'm not familiar with those specific authorities, so let me look into it. And let me just say also the CDFIs did a terrific job as well.
I agree. I should have added the CDFIs. We concur on that. So, but I look forward to working with you to make sure that we're investing. I mean, we have, public money as well as private money to invest in those MDIs so that they have the capital and the wherewithal to move forward. That is the way to go. Now, have the Fed and or the Treasury Department made on another issue, I'll ask Mr. Powell this, has the Fed made a requirement of all asset managers and broker-dealers with which they contract to partner with minority firms in fulfilling contracts and transactions?
Yes, we do have obligations, for example, with the companies we've contracted with during the pandemic. They have to address diversity and inclusion issues at their company, and they have to also reach out to minority suppliers as well.
And the Treasury, Secretary Mnuchin?
Yes.
Okay. So then I'm hearing from both of you that you'll commit to incorporating this and making it a standard for the Fed and the Treasury policies across all capital market programs that involve partnerships with private sector asset managers or broker-dealers going forward with minority broker-dealers and asset managers. Is that correct?
That's really part of our rule book now, actually.
Mr. Mnuchin?
Yes, that's something we work on as well.
Thank you. Out of time, I yield back.
Mr. Stivers, you're recognized for 5 minutes.
Thank you, Madam Chair. Thanks for being here, Mr. Secretary, Mr. Chairman. I really appreciate it. Secretary Mnuchin, I'm hearing from some lenders that are being accused of failing to pay agents who assisted businesses in preparation of their Paycheck Protection Program loan submissions. And before participating in PPP, I heard comments from banks that they were worried they might be exposed to legal liability without sufficient safeguards in what's essentially a government grant program. But they largely participated anyway because obviously they felt like they had a duty to their customers and the country during a time of need. Now I'm told that many banks are being targeted by litigation that takes advantage of the lack of clarity about how agent fees are supposed to be processed and how they work. For example, banks don't have precise answers on where the fees were supposed to come from. Is an agreement between a bank and an agent required before any work on the application is completed or processed? Is this an issue you're aware of, and does Treasury have a plan to offer any additional FAQs to clarify the issue of agent fees and when they're due and how that works?
So I have recently become aware of this issue as well. What our guidance did say is that banks could pay agent fees out of the fees that they received. That was intended to be based upon a contractual relationship between the agent and the bank. And to the extent there's any confusion on that, we'll look at clarifying that.
It'd be great if you could do a clarifying FAQ, because I think it'll prevent some litigation, or at least allow for that litigation to move expeditiously and less costly through the process. So
we'll review that. Thank you.
Thank you, Mr. Secretary. Chairman Powell, Treasury and the International Association of Insurance Supervisors have stated publicly that proposals to retroactively amend business interruption insurance policies to cover COVID-19 claims would endanger financial stability. Specifically, AIIS stated that they caution against initiatives seeking to require insurers to retroactively cover COVID-19 related losses, such as business insurance, and that those things were excluded in the insurance contracts. Such initiatives could ultimately threaten policyholder protection and financial stability. Do you share the concern requiring payouts of uncovered policies and that they could result in insurer insolvencies and destabilize our financial system?
So that's an issue that's really kind of outside the periphery of our authority, except as you point out, to the extent to which it relates to
financial stability. So we're monitoring it. So far, we haven't taken a position on that, but we're aware of it.
Please continue to monitor it. If it results in any kind of destabilization of the financial system, that's your role. I get it, and I'm not asking you to exceed your role, but please pay attention to it. Chairman Powell, could you kind of give us an overview of the current state of municipal finance markets and the effectiveness of the Fed's efforts to stabilize those markets?
I'd be glad to. So the municipal markets, like so many other markets, really just about shut down in the middle of March, and we announced the municipal liquidity facility. And really, that announcement has had an enormous effect on the functioning of that market. So you see a lot of healing in that market. You see plenty of issuance of issuers of different credit ratings and also different kinds of issuers, revenue issuers. So it hasn't returned to where it was in February of 2020, but there's been a lot of progress. So as an example, the state of Illinois did most of its financing in the private markets without our support, and then came to our facility for its last piece of financing. So I'm very pleased that the announcement effect was very strong and effective and is helping a lot of borrowers now.
Finally, I just want to say thank you, Secretary Mnuchin. Thank you, Chairman Powell, for your incredible leadership and availability through this crisis. This hasn't been easy. Clearly mistakes will happen when we're in uncharted waters, but you both have been bold in your leadership. You've made a difference. You've helped businesses survive. You've helped the economy survive. Thank you for your incredible leadership. And we wouldn't be doing as well without it. There's more work to be done. I appreciate everything you have done and hope you'll continue to focus on small businesses and medium businesses around Main Street because they're still struggling. Thank you so much.
Thank you. Mr. Green,
You're watching Secretary Mnuchin and Federal Reserve Chairman Jerome Powell before the House Financial Services Committee. We'll bring you more on the other side of this break. You're watching the ticker on Yahoo Finance. Let's send it back down to Capitol Hill, where we have Secretary Mnuchin and Federal Reserve Chairman Powell before the House Financial Services Committee.
Invidious discrimination as it relates to people of color. So my question to you is, do you believe that this invidious discrimination exists in lending as it relates to people of color? If you do believe so, would you kindly extend a hand into the air? right. Would you kind of hold it up just like to get a good picture of you, Mr. Secretary? All right, thank you very much. Now, next question. Do you believe that this invidious discrimination against borrowers of color can be addressed with legislation? Can we craft legislation to help end this invidious discrimination? If you think so, would you kindly raise a hand? Legislation. Can we craft legislation? Chair Powell seems to think so. Mr. Mnuchin?
Can I respond to the answer?
Well, you can respond, but if you would be so kind as to let me know where you're going first. Sometimes when people finish, I don't know what they've said.
I think
this wouldn't apply to you, of course. So
I think we have legislation, so I think we need to do a better job. So I'll say we can look at legislation, but I think it's more than just legislation.
okay, I agree with you that it's more than legislation, but would you agree that legislation can be a part of the remedy? If you would kindly extend a hand. Thank you. Now, I'm in agreement with you. We have a couple of pieces of legislation. H.R. 149, the Housing Fairness Act, helps to deal with discrimination in housing as it relates to people of color and others as well. And then H.R. 166, the Fair Lending for All Act, that would put an end to this race-based lending and discrimination. Two pieces of legislation, hopefully they'll move in Congress. But here's my final question. I believe that it's time for us to reconcile in this country. We've survived slavery, but we didn't reconcile. We survived the invidious discrimination that exists now, segregation, but we haven't reconciled. If we had a Department of Reconciliation with a Secretary of Reconciliation, would you work with a Secretary of Reconciliation, your departments, the agencies that you represent? Would you work with such a person to help us reconcile in this country? If so, raise your hand. All right.
Not knowing what that is, I guess,
They
but
both
sure,
would.
if there's a department, then, you know.
Well, I can tell you it would be a department designed to eliminate invidious discrimination and racism. That's what it would be all about at the cabinet level, hopefully. Thank you both. Thank you, Madam Chair. You're back.
Thank you. Mr. Barr, you're recognized for 5 minutes.
Thank you, Madam Chair, and to Secretary Mnuchin and Chairman Powell, I want to thank you all for your very decisive and aggressive actions that you all have taken from the outset of this pandemic. I think both the Fed and Treasury, through the emergency lending and with the tools that we've given you through the Exchange Stabilization Fund, have really made a difference in making a bad situation a lot less bad given the circumstances. So thank you for your actions. And as an example of the agility that you've shown, Secretary, let me thank you in particular for responding favorably to a letter that Representative Hill and I sent to you about streamlining and making less bureaucratic the loan forgiveness application under the PPP program. That was tremendously helpful for both borrowers and lenders, cutting that red tape. The easy form is very welcome and appreciated the fact that you were responsive to that. Let me ask you a follow-up question about commercial real estate. We've had a couple of questions from Mr. Sherman, Mr. Posey. This is a problem we have not addressed yet. And I'm hearing from many commercial property owners and borrowers in my district across the country, especially hoteliers, where occupancy rates remain very, very low. Shopping center owners, retail clearly has not recovered. Other businesses significantly disrupted by the pandemic. I think we're going to see, without intervention, a wave of foreclosures and defaults. And Secretary, you did identify the problem with the inflexibility of these servicing agreements. But I think you mentioned that we might need additional legislation to allow hoteliers to hire back workers. That's really not the issue. The issue is debt. They can't service their debt because they don't have revenue. They don't have. So my question is, both of you all recently received a letter from me, Congressman Taylor, Congressman Heck, Congressman Lawson, plus over 100 of our colleagues urging the Fed and Treasury to establish a facility to assist commercial real estate borrowers, especially those with CMBS loans. Secretary, you testified that you have $250 billion remaining in the ESF. To both of you, does the Fed currently have the authority to establish such a facility? And do you feel that market conditions in commercial real estate warrant action by the Fed and Treasury?
Well, let me just appreciate and thank you for your letter. This is a large challenge. So we have, working with the Fed, we have not yet figured out a way to set up a facility. So it's not out of a lack of interest or a lack of desire. There are structural problems. And let me just add, in many of these cases, these companies don't need more debt. They need support. So one of the things we will want to look at in the next CARES Act, as I said, is additional support for these hardest hit industries. As the chair has said, there's a difference between lending and spending.
Right. Chairman?
I just would echo, and I've got your letter right here. You know, I've been very focused on this, and you said it in your comments, and it's in the letter. You know, more debt may not be the answer here. Debt doesn't solve every problem. You've got people who can't currently service debt. You've got these inflexible arrangements. So there's a serious problem here that needs to get fixed, and we're racking our brains to see how it could be something we could do by lending, but that's really what we can do is create more debt.
Yeah,
so.
I would encourage you to consider in some cases the covenants against additional indebtedness may be too restrictive that these owners could take on additional debt to get them through this period of time. But I look forward to working with you, whatever the answer is. Real quick on Main Street, Chairman Powell, I have heard from a number of lenders and business owners who've indicated that the terms of Main Street may discourage borrowers from applying and lenders from participating. Some lenders have welcomed the changes made recently by the Fed, but many are still far from enthusiastic about participating. What has been the response thus far from the lender community, and how is the Fed going to encourage lender participation given the hesitations?
We've had a lot of interest. You know, we do webinars, we do outreach, and as I mentioned earlier, we've had something like 300, a little more than 300 now, I think, turn up. What the banks tell us is, though, that it's sort of a mixed thing. They're not getting a ton of interest from borrowers, and many of them say that they expect that'll change. You know, over the course of the next few months, they do expect that demand from borrowers will increase. And I'll just echo that we continue to be open to playing with the formula and making adjustments going forward.
Well, my time has expired, but the reason why Main Street doesn't work for commercial real estate is that EBITDA limitation, as you know. But thank you. I yield back.
Thank you very much. And Mr. Powell, the issue of commercials that we've talked about, it's on my radar. We'll continue to talk about this issue and pay attention to what you're saying to us about it. With that, Mr. Cleaver, you're recognized for 5 minutes.
Thank you very much, Madam Chair.
Where is he? Where is that guy?
I'm sorry.
Yes.
Thank you very much, Madam Chair. Secretary Mnuchin, thank you for being here. Chairman Powell, thank you for being here again. I know that you've been asked by a number of members before me about the issue with black and brown business owners being left out of the pot that we clearly intended to help during these downtimes. And so I'm frustrated, like a lot of people, not only in Congress, but a lot of people around the country. What is your philosophy, Mr. Secretary? Maybe not philosophy, but what do you have to say to a question? Why weren't rural and minority businesses more equally supported in the emergency program? I mean, what do you think happened?
Well, let me just first say we need to all do a better job at making sure that we have sources of funds for those businesses and to support those businesses. In the PPP, we've worked with lots of different people to make sure the CDFIs and the MDIs get there. But across the board, we can always be doing a better job.
And thank you. I guess where I'm now, because I'm I'm here dealing with these minority businesses right now, and if I say we all agree we need to do a better job, do you have any ideas or an idea on specifically what we can do better?
Well, we'd be happy to work with you on that. We've been working with Robert Smith and a bunch of external people to try to figure out how we can use the CDFIs, how we can make sure MDIs have more access to capital, and I think there's a lot of good ideas out there that we need to continue to explore before we have a one solution. I think there's multiple solutions.
I'll just add, Mr. Cleaver, I'll just add that we're doing a great deal of outreach with MDIs and CDFIs to get them access to the programs that we're doing, including the PPP. And in fact, we have a meeting with the National Bankers Association tomorrow on July 1st. So we're doing a lot of outreach, and we think it's having an effect.
Well, thank you. Actually, after you appeared before our committee, I did have about a 35-40-minute meeting with Esther George here in our the Kansas City Fed office, and I said I appreciated her going into detail about issues that we were raising as best as she could. So thank you for doing that. I appreciate that. I just was hoping that the Secretary would understand the pressure that these businesses are under, which means that as representatives of theirs, we are also in tremendously pressurized situations, and I was hoping that I could go back and say, this is what we're going to do henceforth. But I appreciate where we are. Many of my colleagues have already raised the issues I was going to raise. I would just say, you mentioned earlier, you can't respond to any classified intelligence, so I won't ask those questions. But I am nevertheless going to send you a letter.
Which caused the human, cultural, business, and political ramifications, and what remedies are currently available or should be created to combat this unfair trade practice. On a bilateral basis, what is clear is the lack of reciprocity from countries like China or Russia and the United States. The Chinese government spends billions of dollars to promote its propaganda overseas, a form of offensive censorship. For years, Russia has broadcast state propaganda in the United States and has justly been designated as a foreign agent. The lack of reciprocity takes advantage of our system of free expression to promote these countries' agenda online, in media, entertainment, as well as our education system. Meanwhile, China and Russia do not grant the United States the same access to its markets or media. Instead, China has been expelling our media, having kicked out 3 Wall Street Journal and other reporters earlier this year over Chinese censorship of COVID-19. For centuries, countries.
You have been watching Treasury Secretary Steven Mnuchin and Federal Reserve Chairman Jerome Powell before the House Financial Services Committee talking about their efforts as it relates to a recovery here, what that might look like coming out of the COVID-19 pandemic. I do want to bring in Yahoo Finance's Brian Chung, who follows the Fed for us. Brian, what was your big takeaway from the hearing?
One big takeaway, Julia, was that Fed Chairman Jerome Powell was really warning about the economic consequences if there were to be a failure to contain the COVID-19 pandemic. That's been a concern as we've seen new amounts of cases cropping up in states like Arizona, like Florida, like California. And Jay Powell saying, quote, a second outbreak could force government and force people to withdraw again from economic activity, end quote. This is something that he also included in his written testimony, where he did worry that a resurgence of cases could undermine confidence in the economic recovery. But for right now, it did sound like he does see positive signs for right now in terms of the aggregate U.S. economy. He did say that the expansion can be vigorous and strong, and quote, it's just beginning. now, end quote. So I think his message to policymakers right now is that we can make this recovery strong. The Federal Reserve already has interest rates and other monetary policy in an accommodative place. But the main thing is making sure that from an epidemiological standpoint, that you can actually contain the virus, that you don't need to re-shut down the economy, send people back inside, and then undermine that confidence. Julia?
Brian, thank you so much. Well, I want to bring in our next guest. We have Chief Market Strategist David Zervos, who used to work at the Federal Reserve back in the day. David, thank you so much for calling in. David, you might have to hit *6 to unmute.
I think I did unmute. Is that, can you hear me, Julia?
Great to hear from you. Yeah, I can hear you,
Great
David.
to hear from you.
Yeah, I can hear you. Thank you so much for calling in. I want to get your reaction. You follow the Fed closely. You work there, as I was just referencing back in the day. What's been kind of your takeaway the last few months during this pandemic? Some of their steps that they've taken to kind of stem the pain, if you will, that's been happening in the economy.
Well, Julia, for our clients at Jefferies, we pushed very hard on the idea that the Fed learned a lot from the global financial crisis back in 2008 and 2009. In particular, they learned a lot of things that they would probably want to do differently in the next crisis. And I think Governor Brainerd gave a great speech kind of outlining some of that in early February, which I thought was a great template for what was on tap for us in late February and early March, when the Fed really kicked into gear as the virus started to really take hold. And I think that the two things that were the takeaways, if you asked any official that worked at the Fed during the 08-09 period and then onward, what were their two kind of biggest regrets, or what would they have done differently? And I think to a person, the answer was they would have gone bigger and they would have gone earlier. And I think what we saw is a Fed that went big and they went early. That was the intermediate rate cuts, bringing the meeting in March forward to the weekend, bringing the CPFF and the money market mutual fund facilities on board quickly, coming up with this the new credit market facilities, which have done an amazing job at delivering low funding rates to our investment grade corporates and helped stem some of the bloodletting in the higher yielding parts of the debt markets, the muni market funds, the muni market, as well as what Chair Powell was talking about in the testimony, the Main Street funding facility, which is just getting going. So I think that the message was clear. If you read between the lines of what you learned, what they told you they learned, and the Fed very much delivered on that message. So we've had our clients very focused on a big early Fed with a lot of firepower that doesn't look like it's going to let up anytime soon. That's
David, you just mentioned
positive news for financials.
Yeah, you just mentioned the go big and go early from the Fed, and you also touched upon what's happening within the credit markets. I would love to get your take on the corporate credit facilities, and sometimes you'll hear folks on the street criticize this. I'd like to get your take on it, and you were also referencing how that benefits Main Street, because that seems like that's something the Fed would like to do. How is there a benefit?
Well, these are great questions, and they're sort of at the heart of kind of the Monday morning quarterbacking that went into play after reassessing what was done correctly and incorrectly after 08 and 09. And I do think, even though the Fed doesn't like to admit mistakes, I do think that there was a lot of concern that the policies put in place did not filter down to Main Street, and a lot of Wall Street stimulus got stuck there for a variety of reasons. I think the Main Street lending facility is really an attempt by the Fed to rectify that. Whether it works or not remains to be seen. It's early days, but clearly, lending to these businesses with very, very sort of easy terms, if you will, compared to what would be available in the private sector, should be quite helpful to a number of businesses that are struggling to figure out what the next direction is. But going specifically to the corporate credit facility, we're purchasing. The Fed is purchasing the bonds of all of these investment grade corporates, or many of these investment grade corporates. That's lowering their borrowing costs, lowering their hurdle rates for investment in new activities, and in particular in hiring. So that frees up money so that more jobs can be created, more activities that generate real returns on capital can be conducted for shareholders, and generally provides easier financial conditions for our business community. And I think that's where the jobs are going to get created. That's where the innovations are going to get created. That's where the growth is going to get created. So this is a very powerful and direct effect on American entrepreneurial activity. And it's much different than the traditional sort of let's make treasuries really expensive and buy all those and then force the private sector to go buy investment grade or higher yielding corporates. They're actually just going in and doing it directly. So it's a much more direct impact on the balance sheets of the growth generating engine of our economy, which is the entrepreneurial business sectors that do the hiring and and create the growth. So I'm pretty excited about those facilities. I think they've done I don't find the criticisms very compelling.
Got it. Well, certainly something that we will be keeping an eye on. David Zervos, the Chief Market Strategist for Jefferies, I thank you so much for calling in the program. And on the other side of this break, we're going to talk about market outlook for the back half of the year. Stay tuned. Welcome back to the ticker. I'm Julia LaRoche. Well, we just wrapped up the hearing on Capitol Hill with Jerome Powell and Stephen Mnuchin. I want to bring in one strategist. We have Tom Thornton from Hedge Fund Telemetry. Tom, thank you so much for joining us.
Thanks for having me.
All right, Tom, I want to get your take on what we were listening to today with Mnuchin and Powell and what your views are on the second half of the year.
Well, look, I think just to follow up with what David Zervos said, the Fed has done a great job at stabilizing the markets. They were quite unstable, as you know, in March, and they've thrown just about everything at this and then some, a lot more than I think anybody could have ever imagined. I think the question that I probably would have wanted to hear from perhaps some of the minority Congress people, why is the Fed buying Apple bonds, foreign bonds like Daimler, BMW? They're buying Altice in the high yield, and why are they buying those bonds rather than putting money directly towards those minority areas, because I think that would be a bigger punch for the economy, especially in those really beat up areas and cities. I think that would have been something really important. The last thing, Apple also is buying back stock with the bonds that they issue. So I think there's a bit of a moral dilemma too of why they're buying Apple bonds.
Yeah, it's interesting, Tom, because there is kind of this tension that you keep hearing market participants around the corporate credit facility, and some folks are for it, others are against it. As someone in the markets, you just kind of outlined your view, but has it been frustrating from a market participant viewpoint?
No, not at all. I mean, we headed into the March period short. We got long around the middle of March, which worked out well. It's now getting to a point where you just keep hearing more and more and more facilities, whether it's from the Fed or even with the federal government. The federal government's going to have to make a big decision in the next month with some of these states that have a fiscal cliff looming, because they're just depleted with all their funds. So it's not necessarily frustrating because we have the market that we have and we just have to trade that. But I think that there's some big questions for the second half.
I guess if you had to in on some of those questions for the second half. Also, I should mention we're just finishing the quarter. We're going to be getting into earnings season, those sorts of things. What are the questions that are top of mind for you as you go in the second half of the year?
Well, look, we've seen a lot of companies come back from the recovery to even higher highs. And in my opinion, when they didn't give guidance and everything was withheld, withholding guidance for this quarter, now they have to give guidance. And I think that's going to be tough. And I'm not sure if the market, it's going to be enough for the market to keep this momentum going. You also have a few other things happening. The election is going to be a complete a mess, I think, on both sides, with the with the electorate so polarized. And with some of this tension in the streets, I really think there's going to be a lot of uncertainty around that. And that happened not so much as bad in 2000, but we didn't know who won the 2000 election, and the markets really took it hard with that uncertainty. So this could be another wild time.
Well, Tom Thornton of Hedge Fund, I thank you so much for your time. And on the other side of this break, we will be joined by Schwab's Chief Investment Officer, Liz Ann Saunders. Welcome back to the ticker on Yahoo Finance. I'm Julia LaRoche. We just wrapped up the hearing with Federal Reserve Chairman Jerome Powell and Treasury Secretary Steven Mnuchin on Capitol Hill. Our next guest is Liz Ann Saunders, Schwab's Chief Investment Strategist. Liz Ann, thank you so much for calling in.
My pleasure. Thanks for having me.
So we had Jerome say that a full recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. He also added that the path forward will the policy actions taken at all levels of government to provide relief and to support the recovery for as long as needed. Your takeaway from Fed Chair comments?
Well, I think he's probably accurate in his assessment and not sugarcoating the situation, maybe trying to remind investors that, extrapolating the first month of recovery's percentage increase is often incredibly compressed low, and much of this economic data probably had too much optimism associated with it. So I think he's trying to sort of refute the notion that this is a definitive V and we're straight up from here. So I think he's learned valuable lessons over the last year and a half about how to use his words when communicating the Fed's views.
Yeah, it's a good point. And you just mentioned a V. Obviously, we have this narrative of a V-shaped recovery, and then you have, so many different letters, whether it's U, a W, an L, a Nike swoosh, and whatnot. What kind of recovery are you anticipating here?
So I think it obviously depends on the industry, but I think in the aggregate, it probably is more likely to be a series of rolling Ws. And I think one of the reasons that the V narrative developed wasn't just because the initial rebound percentage increases were so significant, which we already talked about, but the idea that we were unlikely to see a federally mandated government shutdown again of the economy, and therefore we didn't have risk of a significant sort of recontraction in growth. The problem with that narrative is that even absent a government mandated shutdown, you're still going to have consumers making decisions for safety reasons, businesses making a decision for their own reputation or having to clean if there was an eruption of cases. So I think there are second-order economic effects that will come regardless of whether we continue to see this resurgence in new cases in certain states.
It's interesting that you just brought up the second-order economic effects. What specifically are you thinking?
Well, I think there's little question that some of these perceived temporary layoffs will become permanent job losses. If you just think about the restaurant and bar industry, to the extent that social distancing is maintained, many of these restaurants, particularly the individually owned, not part of a larger corporation, it's not sustainable at even 75% capacity, let alone 25 or 50% capacity, and or in an environment where there might have to be periodic shutdowns because of a resurgence in cases. So I just think the second order economic effects could be driven by things like bankruptcies, continuing claims staying relatively high. Those would be the factors that I would look at. I just think the speed with which we're going to recover from such an epic decline, I think, has been shortened in the minds of some investors, and I think we need to kind of think longer term about this path toward full recovery.
Yeah, it's actually interesting that you just brought up that longer term, and it made me just think, about 47% of employment in the U.S. I guess before this crisis, it was small businesses, and also you're just mentioning the continuing claims. That's something that folks really, as you just referenced, should pay attention to. What else should be done, though, from a policy perspective, whether it's fiscal or monetary, or is the more that they go, does that just set us up for even longer term consequences that we might not even be aware of yet?
Yeah, I mean, that is the tough part of this. I think in the near term, from a policy perspective, probably the least that can be done is make sure programs like the PPP, which did get extended, are fully understood by small businesses. There have been ample surveys saying that many small businesses haven't applied, or if they have, they haven't received an answer. Many who haven't applied simply don't understand how the program is working. Looking at extending the enhanced unemployment benefits at the outset, I just think there's a lot more thought that could go into sort of stabilizing the mindset around many of the existing policies that we have. And the good news from the Fed's perspective, because we've got fiscal stimulus and monetary stimulus is that many of the new programs that the Fed brought into this crisis specifically that were not pages pulled from the playbook of 08, the good news is many of them haven't been tapped. There were facilities set up. The fact that they haven't been tapped suggests that we're not yet seeing sort of carnage in the credit markets and defaults. But that's another area we need to keep an eye on in the next couple of months to get a sense of where we are in this recovery.
Liz Ann Saunders, Chief Investment Strategist of Schwab, thank you so much for calling into the program.
My pleasure. Thank you.
All right, let's take a quick check of the markets. All three major Wall Street industries are in the green, though they've been largely flat with the Nasdaq as the biggest gainer. I'm going to turn it over on the other side of this break to the final round. Stay tuned.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Ludlam with you in New York. Let's take a look at the market on this final trading day of the month of June, the final trading day of the second quarter, and the first half of a very eventful 2020. Right now, we've got all three major averages higher on today's session. The Dow, a notable laggard, the blue chip index up just 0.1% right now. The Nasdaq is up almost 1.5%. The S&P up right around 1 percentage point. The Russell 2000 also higher by about 1% during today's trading session. Overall, an interesting day. A lot of headlines, a lot of news on the virus front, a lot of news coming out of Washington, D.C. Of course, there's some mergers news from last night that we'll get to in just a bit. Before on today's market action, I want to bring in my co-host for the next 2 hours, Shauna Smith. Shauna, for your takeaway, I guess on today's action, but also this milestone day. We have finally made it halfway through 2020. Maybe the second half won't be quite as eventful as the first, but certainly a year we won't forget.
Yeah, Miles, I think that is the case. And it's interesting here when you take a look at what exactly we're seeing play out, because we had this massive rebound from the lows that we hit back in March. We had the S&P and the Dow both on pace for their best quarters since 98, the Nasdaq on pace for its best quarter since 2001, with all 11 of the S&P sectors higher. I think the question is whether or not any of this momentum is going to be able to be sustained here in the second half of the year. And this narrative that we talked about a lot more so in the beginning of the quarter, but it still remains to be true now, kind of this disconnect that we've been seeing between the markets and also the econ data that we've been getting. While the econ data has improved a little bit, it's clearly not reflecting the same picture as to what we saw in the market. So I think that will continue to be the story here as we head into the second half of the year, just whether or not we will see some more volatility because of that and exactly what that means for the markets. I also want to point out that some of the recent data that we've gotten out, some of the consumer surveys, Piper Sandler was out with one today, and we're seeing some strong data on the points of consumer confidence. I was out this morning, was better than expected in the month of June. Housing, home prices continuing to rise. But the survey data that we've gotten out, Piper Sandler saying that consumers are still very hesitant. People aren't exactly eager to go outside of their homes. A lot of people would still rather stay at home because of the rise in the outbreaks that we have seen in some parts of the country. And then also couple that with the fact that we are seeing some of those reopenings begin to scale back. The fact that we had New Jersey yesterday, for example, saying that they're suspending their indoor dining indefinitely. I think that remains to be seen just how quick of a recovery we are going to have in terms of the economy in the second half of the year and exactly how that's going to play into the markets.
Yeah, certainly it is clear at this point that a steady increase back towards whatever we had before is probably off the table for a variety of reasons, and we're all finding that out kind of on the fly as we go here. Let's go to Jared Blicker now for a little bit more on today's market action, but also, Jared, putting into context where we stand as we head towards, again, the end of the month, quarter, and first half of the year.
Yeah, we can take a retrospective, see how things settle after the bell, but here's a quick look here. If we look at what's happened over the last 3 months, and this is going to be the S&P 500, we can see that we're just now breaking out of this channel, this downward trend line that has been in play for several weeks now, and we've been consolidating in this pennant formation. And it's not confirmed yet. If we were to break to the upside, probably have enough momentum to retest these 3250 highs, maybe higher. If we break down, we have a lot of support all the way going down to about 2750 to 2800. If that happens, then that's kind of the Rubicon, I would say, for the S&P 500 and some of the broader markets. But what we're seeing today, we're seeing outperformance by an interesting mix. And we'll go to our sectors here. Energy is the biggest winner, started out in the red. That was based on some Royal Dutch Shell news that they're going to write down $15 to $22 billion worth. Crude oil ending down on the day. But you look at what's happened with energy over the last 3 months, and it has maintained much of its gains over this period. And technology has really been the stalwart here. It's very close to its record highs, along with the Nasdaq and the Nasdaq 100. Healthcare kind of plugging along here. To the downside, it's been utilities and staples and industrials, not a pure mix in the sector-wise, but I want to get to the 10-year T-note yield because that's been instructive, and we've been tracking that. Its breakdown, after it broke down through this consolidation area, it's now climbing after hitting 5 months or 5-week lows. And that is helping out the situation with some of the growth, not only the growth stocks, but also some of the value and cyclicals. But again, not a pure value cyclical play today. Just looking at the NASDAQ 100, let's actually look at what's happened over the last quarter. So we're going to see some huge gains. Apple up 42%, Alphabet up 21%, Facebook up 35%. Just sorting by performance here, Tesla, the biggest winner, along with Mercado Libre and PayPal. Tesla up over 100%, Melli almost there, PayPal, Zoom. So these are some of the defensive stocks that we've seen during the COVID-19 era. And to the downside, we see Biogen, Walgreens, which is a staple, Ross Stores, they've been having some problems. But really, we saw the value in cyclicals assert themselves early on in the rally. That would be after the March lows. And then again, briefly for a couple of weeks when we were getting to those June highs. But really haven't done a whole lot lately. So looking at the sectors over the last quarter, tech and discretionary here, containing some of those FANG stocks, Amazon being a big weight, about a quarter of discretionary. Those are the big outperformers along with energy and materials. And then to the downside, you see utilities, staples, and financials taking up the rear, but everything in the green. And just looking up at the bank stocks here, some decent price action over the last day. We're still sticking with the quarter here, but we can see Wells Fargo down 11%, and they're one of the few big banks, or medium-sized banks even, to big banks that have had to cut their dividend as a result of the stress test. We got that news after the bell. So just looking at today's performance for the banks, you can see Wells Fargo and Capital Finance, Capital One, those are in the red today. It's been a really interesting quarter. We've had various leadership assert itself at various times, but tech and some of these defensive names that we were just going through, like Zoom and Tesla, if you can believe that's a defensive stock, just really knocking it out of the park in this quarter.
All right, Jared Blickery, we'll check in with you later on in the program. But again, kind of giving us the overview there of where things stand as we approach the end of the second quarter, and we'll see where most of these superlatives shake out in a little less than an hour. But as we mentioned at the top of the show, a lot of headlines today out of Washington, D.C. And as usual, Dr. Tony Fauci making perhaps the biggest splash. It seems that when Fauci speaks on the virus, the public listens most closely relative to anybody else that is part of the coronavirus task force at this point in time. Anjali Khemlani joins us now for more on what we heard from Dr. Fauci earlier today. Anjali.
Thanks, Miles. Yep. So Dr. Fauci was in front of a Senate committee today discussing really the U.S. response to the outbreak and answering a lot of questions about how, some of these experts are going about with their appropriate departments in terms of, worrying about the safety and effectiveness of vaccines or what needs to be done in terms of greater response with testing and contact tracing, et cetera. But Dr. Fauci did make one comment that seems to have caught everyone's attention, and that is that as we're seeing these resurgences in these southern states and California, it's really concerning for one really key reason. This goes back to sort of that really worst case scenario that he and others were talking about earlier on. And he said specifically that we could possibly reach 100,000 cases per day, which is a pretty shocking number. Right now, we're averaging about 40,000, and that's double what the average was before. Previously, the U.S. was doing about 20,000 cases per day. Obviously, some of that is from the increased testing has been discussed, but listen to what he had to say earlier.
I can't make an accurate prediction, but it is going to be very disturbing. I will guarantee you that, because when you have an outbreak in one part of the country, even though in other parts of the country they're doing well, they are vulnerable. I made that point very clearly last week at a press conference. We can't just focus on those areas that are having the surge. It puts the entire country at risk. We are now having 40,000+ new cases a day. I would not be surprised if we go up to 100,000 a day if this does not turn around. And so I am very concerned.
As you hear there, he's very concerned, and that's something that he's been talking about in recent appearances, just the current concerning trend of cases. Miles?
All right, Anjali Khemlani with the latest from the coronavirus down in D.C. Anjali, we'll talk to you in the next hour. All right, let's turn now right into Melody Ham's wheelhouse. Mel, it's been quite a 24 hours for you. Last night we were on the air 4 o'clock. We'll start there with the news. Lululemon buying Mirror for $500 million. Now, Mirror, the at-home fitness company that, Melody, I know you've covered closely over the last couple of years, and in many ways a natural partnership. They'd already been working with Lululemon. The founder of Mirror is a Lululemon or was a Lululemon brand ambassador. Lulu's tried to get into the subscription game with, they had a subscription, I guess you get some clothes and kind of a membership at a store, but it makes sense now, but probably would have eventually, made sense as a deal even without the current pandemic.
Yeah, it's so interesting, Miles, because I wish I was that prescient when I interviewed Bryn Putnam, the founder and CEO whom you're talking about, who started as a professional ballerina. She's Harvard educated. After she had children, she realized that she couldn't be a ballerina anymore, and she kind of pivoted careers. And she was met with a lot of skepticism. She was early in the boutique fitness space because she actually started a physical studio called Refine Method, which is based in New York City. It's a very booty-kicking Pilates bar workout. And then she realized there was another hurdle because all of the mom cohort, they quickly said, we don't actually have time to come to the studio. We want that kind of an intense class with the full sort of engagement of an instructor at home. And that's when Mirror came to life. So for some more context here, Mirror was founded in 2016, but the actual product launch was September 2018. So in less than 2 years, Bryn was able to sell Mirror to Lululemon for $500 million, which I think must make some sort of record in terms of exit strategy, especially as we talk about the startup world and how companies have not figured out their sort of liquidity plan going forward. As I understand it, the company is still less than about 50 people when it comes to the corporate side of things. They have a couple retail locations that are staffed with some part-time workers as well. But just thinking about the natural fit and the natural acceleration that COVID really provided Mir and made it a lucrative place, I joined the call yesterday, and the executive team at Lululemon made some really interesting points saying, it's not quite yet that Lululemon ads would be peppered in the mirror, right? Like when you're doing a 15-minute workout, that would be really an awful experience to be served ads. I'm not saying that that wouldn't happen in the future, according to the CEO, but ultimately the idea is for mirrors to be in Lululemon stores, to be ubiquitous on the Lululemon website, because if you think about the $1,500 price point, that's very much in line with the demo that Lulu has already been serving. So it's fascinating to me that as you alluded to, a lot of that initial connection was because Bryn Putnam herself kind of embodied that lifestyle. And she is the prototypical Lululemon customer who ended up founding her own brand. I do feel like the other interesting stats that came out of the call yesterday was that it's a 50-50 breakdown. I think often people associate Mir as a feminine brand because there are a lot of Pilates classes, yoga classes, but according to the company, it's pretty much an even ratio. And another interesting stat is it's only 10% penetration rate. What that means is only 10% of people surveyed actually have heard of Mir. So of course, with the New York City or LA mindset, there's often this thinking that, okay, everyone must know about it. You see it plastered on subway ads, you see it served to you on Facebook, but at the same time, I think there is a lot more room to run when it comes to this sort of acquisition.
Well, and I think also if you think about just the pure data play from Lululemon's point of view, now they are going to know how often Mirror users work out, and they can do the math that they already have in their head of how often does someone need to refresh their shorts, their tights, their shirts. And it also is a reminder that companies that sell physical goods, and I know they all have a lot of data on their customers, you don't really know what happens to pieces of clothing or footwear or so on when they leave the store. You know they get used because someone comes back, but now Lulu, I think, has a real chance to understand in a way that few of its competitors, maybe none of its competitors, know, like how much their shirts are being worn, and therefore how quickly a certain customer may come back for another, and so on.
And Miles, that's a great point. Also, I know you are a Lulu fan yourself, so that's a question that I should be asking you, actually. But when you think about the potential for the instructors on Mirror to be sporting head-to-toe Lulu, right, from the headband to a scrunchie to socks to shoes or whatever in between with the yoga mat itself, to your point, the product placement is sort of ingenious. I think we've talked about it before with golf, right? With some of the athletes who are sponsored by Under Armour. I think one athlete at one point had 27 different Under Armour logos on his body, and you wouldn't really notice it. But then you, without even thinking about it, you're like, oh yeah, of course Jordan Spieth is wearing this. I need that immediately. So just like with Peloton, as these instructors gain more street cred, and as they have a wider audience, of course, they will become celebrities and influencers in their own right. Yeah. And without a doubt, that's going to be a seamless transition. Also, keep in mind that there are 2,000 Lululemon ambassadors to this day. They will also be pushing Mirror. So the kind of collaboration, it makes a lot of sense to me.
Yeah, we'll see certainly how it goes. They said in the press release last night that Mirror would operate as an independent unit. So I'll be interested to see how disciplined Lulu's management team is in letting Mirror continue to do what it wants to do. Let's pivot quickly and talk a little bit about a report from last night, Mel, that Uber was looking to buy Postmates for $2.6 billion. So a much smaller transaction than they were looking at when they tried to buy Seamless not too long ago. Uber shares up 4% on the news today. Everyone who follows food delivery knows that consolidation is coming. It'll just be interesting to see if Uber can finally close the door on this one.
Yeah, and let's keep in mind that SF-based Postmates was last valued at $2.4 billion. The last time they raised capital was back in September of 2019. I have spoken with Postmates reps in the past, and they did not actually respond to comment when I emailed them today. However, previously, the ambition was always IPO, right? We are taking our company public. We are serving our 1,000 employees. This offer on the table probably seems lucrative, though, at this point. And from Uber's side of things, of course, it makes sense for them after they lost that massive Grubhub deal. There will also be less regulatory scrutiny with a deal like this, just in terms of market share and consolidation here. To your point, consolidation needs to happen. There is going to be a tie-up. It's just a matter of who. DoorDash is almost too big at this point, and as we know, DoorDash acquired Caviar at one point and then sold off Caviar. Square owned Caviar, sold off Caviar to DoorDash, and so there's already been a tie-up in that space. I do think that an Uber Eats, in order to actually obtain profitability at this point, there needs to be some sort of melding of worlds.
Yeah, and now there's reports CNBC saying Postmates may go the IPO route via a SPAC, which is the hottest trend in the market right now. It doesn't matter when, where, or how. As you mentioned, the economics do not make sense if there are 4, 5, 6 players in food delivery and ride sharing. And so, look, the Silicon Valley playbook, very clear. You get to a market where you're either a monopoly or a duopoly. Otherwise, you're not making enough profits to justify whatever valuation you have likely gotten in the private markets. All right, coming up on the other side of this break, we're going to talk about our call of the day. Cowen's latest note on shares of Netflix, raising its price target up to $535 per share. We'll discuss that coming up in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. It's time now for our call of the day. Today we are talking about Cowen's latest note on shares of Netflix, the firm reiterating an outperform rating and raising its price target to $535 per share. And Shauna, in the note, Cowen is talking about the thing that I think really bolsters Netflix's valuation now. It just hasn't really materialized quite yet, which is pricing power. I mean, Netflix has inched up a couple of dollars every couple of years recently, but just news today that YouTube TV is going to go from $50 to $65 a month. I think there's definitely a sense that the day is coming when Netflix is going to be able to really clamp down on its dominant market position and maybe double or even triple its price from where it sits today.
Yeah, Miles, I don't think that this is a big surprise to anyone because Netflix hasn't raised their prices, since the beginning of 2019 at this point. And there was a huge fear the last time that they did this that maybe people won't be willing to pay the extra $2, $3 per month. Maybe people will get scared. Maybe people will just drop it. And that didn't really prove to be the case. So I think the fact that Cowan's saying that, hey, COVID has proven the fact that this is almost an essential entertainment piece of the whole puzzle, that, hey, they have more pricing power at this point. They're not saying that they will raise prices right away or anytime soon, but looking ahead into next year, into 2021 and going forward, obviously this is a play that would make sense for Netflix. And Miles, one thing that stuck out to me in this note from Cowan was they had some interesting charts, and it was just talking about how valuable Netflix is and how many people come to favor Netflix over anything else that's on the market. And 25%, just around 25% of the respondents saying that Netflix was their preferred place for entertainment. So when they go and watch videos, they're going to go to Netflix first, beating out basic cable, beating out broadcast networks, YouTube, Hulu, Amazon, any of their other competitors. So it really just proves the fact that they are owning their market share. They are the proven leader in this space, and they haven't really given to any of those fears. Remember a couple of years ago, and really over the last, I guess, couple of months as well, we've been talking about the fact that maybe they have reached a saturation point, at least here in the US, yet they continue to add users. COVID-19 has proven the fact that, hey, people still want to use Netflix. People want to become users if they haven't been in the past. Their investment on original content has been paying off. So it's a company, and it's a stock that's already risen, 40% this year, and they think it has a ways to go, raising their price target to over $500 a share. So Netflix, I think, does have pricing power. I do agree with their argument, but it will be interesting just to see if Netflix does, in fact, raise prices, how big of an increase it's going to be.
And Shauna, picking up on your point, specifically, we saw a note out a couple weeks ago that APAC was the fastest growing region. There has been deceleration in other parts of the world, but we've talked about on this program just the plethora of content that we don't even know exists. And a lot of it is licensed, right? Whether it's a Polish drama, whether it's a Korean soap opera, this sort of melding and globalization that exists on the Netflix platform alone, there's no comparison. Like, obviously you can say you like Normal People on Hulu. I do. And that's your show of choice. But at the same time, the kind of diaspora, I guess, you could find on a platform, it's just really unrivaled to that degree. Another interesting point, I have such a love-hate relationship with these surveys because you have to take it with a grain of salt. Of course, they spoke with 2,500 people, so it's pretty comprehensive. But at the same time, Shauna, to your earlier point about the surveys where people say, no, if the prices are up, then I'm not going to renew. Are you kidding me? We saw that with Amazon Prime as well. The surveys always indicate that half the people will drop off, and that has repeatedly not been the case. So I think in this case, we did see an increased number of people who did say they would stick with the Netflix. They're just so sticky, right? It's a necessary platform for them to view entertainment. 55% said that they would stick with their membership versus 47% in December of 2019. I still think that's very low relative to the reality of the situation. So again, I like a lot of these insights, but I'm a little bit skeptical just because I know as a survey taker myself, I sometimes inflate the truth a bit.
Well, and to that point, Melody, we'll know that Netflix itself is, again, this is a survey from a Wall Street firm about their view on Netflix's pricing power. When Netflix itself makes it more difficult to cancel, we will know that Netflix believes they cannot raise prices. But we know right now you jump on and off with ease. And as long as that's the case, clearly Netflix feels fine about its competitive position and continues to be really in that early stage of aggregating the demand. And then they'll figure out how to extract the most dollars out of that over the next couple of decades. All right, coming up on the other side of this break, we're going to talk to Jared Tingle, managing partner over at Harlem Capital, about diversity in the VC space and what areas Harlem likes right now, where they are putting their money to work. We'll get into all that coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Sutherland with you in New York. Quick check of the markets here about 30 minutes ago in today's trading session. All three majors are higher and just below their session highs. So we'll see if we continue moving higher as we head towards the final closing bell of the month of June. But let's turn now to what's going on in the venture capital space, and specifically the lack of diversity that we have seen forever, and I think in many respects still see far, far too much of. We're joined now by Jared Tingle. He's a managing partner over at Harlem Capital. Jared, good to have you back on the program. Let's start with some stats that you provided to us, and we've seen versions of these for the last several years about how few dollars of venture funding are allocated to female-led companies, minority-led companies, and you guys see this as led by the investor side, and you are on the investor side. So when you look at your peer set now, what is it that you see, and how can we get it to move from a sea basically of white male faces to something that's more representative of what this country is?
Sure. Thanks for having me. So the problem is dire. We estimate that women and minority-led exclusively companies only raise about 3% of all VC funding, despite being 70% of the population, which we do see stemming from the lack of diversity on the investor or GP side. The stats are pretty bad there too. Anywhere from 1 to 3% Black and 1 to 3% Latinx on the investment professional side. So what we're seeing now is, there's a lot of talk in the ecosystem now with the Black Lives Matter protests and all that's been going on in the world. And I think we do have more attention because of COVID and everyone being stuck at home. But I think broadly speaking, there are just huge kind of inertia patterns that are going to make it very tough to diversify this space. At least 80% of VCs are white, and probably a fair amount are male as well. So we do think that folks are just trying to do their best, trying to make money, but we do need structural changes to help diversify the venture capital ecosystem.
And, Jared, you mentioned there's a lot of talk, and I think VC is just one area of American life right now where there's a lot of talk about how people will do better. But when you think about actually making change and actually diversifying that flow of talent into the VC space, what are things that you think can be done that are practicable steps that are not, moving mountains? It's like, hey, just look around. This talent is available, for this space that again is jarring in its lack of diversity.
Sure, and I'm glad you're focused on the solution, as we are too. So first and foremost, we do think longer term investment firms should try to hire diverse folks on their investment teams. Hire more women, hire more Black, Latinx, Asian folks. We really do need more diversity to be able to change this. Ultimately, VC is a very subjective game where it's based on networks, it's based on potential, and without having diverse representation, it's really tough to make those bets in a good way. So longer term, I think that's the ultimate solution. What you've seen, the workaround for folks like myself who haven't had an easy way into VC, is to start your own firms. So I think one thing you're seeing is that a lot of women and minorities are having chances to get into VC because they start their own firms. For the larger tier one existing institutions, I think second, what you can do is just work with firms like us. We spend all day on the ground. We know where the diverse talent is. We know where the diverse companies are. You can work with us and be able to efficiently see more deal flow. And I guess more longer term, I do think it starts at the bottom as well as the top. You definitely have to have top firm-wide buy-in for why you should focus on try to improve the dynamics. And then on the bottom, you should make sure you're getting junior folks, so analysts and associates that are diverse on your investment teams as well.
I think there's a gaping disparity between kind of the movement that we're seeing right now and the feasibility for folks to be able to buy Black-owned products. For example, we recently spoke with the founder of the 15% Pledge, which is an awesome initiative trying to get major retailers to dedicate 15% of their shelf space online and in store to Black-owned businesses. But then the problem is oftentimes these Black-owned businesses don't have the capital to actually scale. They don't have the supply chain connections to be able to be in the targets very quickly. Are you speaking to any of these organizations and campaigns to really bridge those sorts of gaps?
Candidly, not as much. So we are a VC firm. We focus on seed stage investing. And so we're focused on tech-enabled, scalable companies. when you look at more consumer products or small, medium-sized businesses, that's not where we play. We want to be helpful. We want to do whatever we can. I think there's a lot of other capital sources that are best suited for them, but we do have an opinion on this stuff. I do think I wouldn't say necessarily that that's true all the time. Some of these companies are able to scale. Like Sundial Brands is a really good example of a company that was able to build a product that sold to Unilever for probably reportedly over $1 billion. What I do think we need to do is make sure we actually have more data. There are very few surveys done, and without measuring, it's hard to manage and improve the stats. So a lot of people are operating blind. People talk about the pipeline problem or X, Y, and Z without having true data or robust data to support it. I do think the initiatives are important, though. I do think we all should be focused on trying to spend our dollars with a more diverse set of folks whenever we're buying something, when we're investing. But ultimately, I do think first we need to have the information, and then we can make informed policy changes or private sector changes that actually catalyze and accelerate the change.
Hey, Jared. I mean, Harlem Capital has obviously been very successful in having a diverse workforce, just in terms of looking at your employees. So it can be done, and it can be done. You can hire extremely talented people, obviously. But for those companies that are struggling, obviously, what are some of the things that people could do, companies can do to better identify employees and in order to increase these diversity counts in a relatively short time frame?
Sure. For us, first, it's posting your job postings publicly, which a lot of small organizations don't want to do. But people can't apply to jobs that they don't know exist. And if you don't have a public job posting, you're just going to go to folks that you've known over time. And given how housing networks, friendships work, you're just not going to organically get those diverse folks in the ecosystem. So that's number one, which does take time, but I do think it's worthwhile. I think the second thing you can do is make an effort to work with folks that have cracked the code. So work with organizations that do focus on diversity, like us if you're in the VC space. There are other companies that are actually specializing in helping folks find diverse talent pipelines. Jopwell is one of them. I think they're backed by Andreessen and some others. They've done a really good job at really curating that. And ultimately, I think the first step is just acknowledging there's a problem. And then once you acknowledge there's a problem that you hope to solve it, then you can find and search for the folks that are specialized on the ground, do have the connection to resources that can help you with the talent pipeline. The first step is taking an interview. So you don't have to change your workforce overnight, but you should at minimum make sure the folks you're bringing in to interview are diverse and at least represent the country.
All right, Jared Tingle, managing partner at Harlem Capital. Always great to get your thoughts. Thanks so much for joining the program. We'll talk to you soon. Have a great summer.
Thank you. You too.
All right, coming up on the other side of this break, Brian Chung will join us to talk a bit about what we heard from Jay Powell and Stephen Mnuchin on Capitol Hill earlier today. We'll get into all that coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's go to Jared Blickery now for a quick look at this market as we head towards the month's final closing bell. Certainly the market continuing its rally today. The S&P looking set to finish out the month just under 3,100, Jared.
Yeah, we're looking at the Dow here. This is set to be the best Q2, so this is second quarter only since 1938, up 17.4%. Looking at the Nasdaq, which is up over 30%. This is the best second quarter in history since inception of the data going back to 1971. And the S&P 500, which began officially in 1957, this is the best Q2 as well, up nearly 20% for the quarter. And here's the Russell 2000 up about 25%. We went over some of the heat maps before, judging the quarter by quarter comparison, but I just want to hit some markets that are really moving today. And the first one is going to be gold, because that has broken to new highs. In fact, these are the highest levels above 1,800 that we have seen since 2011. And now we have the big 1,900, 2,000 level in sight. Gold is already is actually at record highs in a number of currencies. And then we also had a big breakout in copper futures. Let me put a different chart on so we can see that. This is at a multi-month high. In fact, you'd have to go back to January to find these prices. So let's take a look at some of our heat maps today. And we were doing the quarter end before, so let's just do June, because June has been kind of a sideways month, but we still have a lot of outperformance in the tech stocks and the defensive stocks. So Zoom up 41%, Tesla up 29%. You include the whole quarter, both of those are close to about 100%. Even United still up 25%, and that's based on that real big value cyclical burst we saw a few weeks ago. To the downside, Ulta Beauty's down there, also ending, I think, almost in last place for the quarter, followed by Biogen and Ross Stores. Some of the biggest losers here really haven't even been able to make these dead cat bounces. But just looking in the energy patch, we've seen that rebound as well. Let's take a look at some of these smaller stocks here. We're going to sort by performance. Some of the smaller shale plays like Oasis Petroleum, that's up 63%. Some of the bankruptcy plays like Whiting Petroleum, that's up 60%. Just a lot of outperformance here. But crude kind of hit a wall at about $42 per barrel. Just taking a look at crude for a second, and we'll take a look at the quarter to date. We can see wasn't able to punch through these levels here. Hasn't retreated that much, but considering the fact that it went from negative 40 to 40 in a span of a few months, really an impressive run here. And then we'll just take a look at the travel stocks, because those got a boost too, and kind of a mixed board here. But Hertz, another bankruptcy play, up 40% for the quarter, followed by Spirit Airlines up 38%, and then American and United each up about 25%. To the downside, Wynn just not being able to take a break or catch a break because of the Macau situation, then Travel Zoo down 8%, and some others. At Hotel Hyatt is down about 8% as well. So it's been an interesting quarter. June flat for a lot of stocks. S&P 500 ending up right at its VWAP for the month, actually a little bit above. It's going to be interesting to see what happens in Q3. And I'll just add this one thing. Very strong parallel to 2009. And it was in 2009 that we saw another big run up starting in July.
And, second quarter earnings season coming up. I think a lot of people are talking now about upside surprises for that Q2 GDP print, which looms at the end of July, potential boost from Congress. Lots of, to your point, Jared, I think a lot of negatives right now, but there are some potential positive catalysts that I think will come up as we head over the next month or so. All right, let's turn back now to what we heard from Washington, D.C. today. We talked earlier about the comments we heard from Dr. Tony Fauci on the coronavirus front, but we also heard from Fed Chair Jay Powell and Treasury Secretary Steven Mnuchin. Brian Chung joins us now for all of that commentary. And Brian, I guess what was the tone of the proceedings, and was there any signal maybe on Treasury's willingness, the administration's willingness to start thinking about extending or kind of refilling the coffer on the CARES Act at the end of next month?
Well, I think you can really tell the tone of the hearing based on the fact that the visuals showed them wearing masks. So you had Jerome Powell wearing a mask in the hearing today, whereas Stephen Mnuchin wearing it occasionally during the course of that hearing with the House Financial Services Committee today. This is a hearing that's happening in late June. This is not the first time that either the Treasury Secretary or the Fed Chair have had to testify to Congress. They were doing that a few months ago when maybe the more optimism in the market would have said maybe we wouldn't have needed this hearing at the end of June. So here you have Treasury Secretary Mnuchin being very closely watched for any sort of details on what might be in that next fiscal package. Something that was discussed was PPP, for example. The Treasury Secretary saying he could see a case for re-upping maybe a small pot of new PPP money, with it having expired yesterday with over $100 billion going unused. But then on the monetary policy side of things, you had Jerome Powell saying that, quote, a second outbreak could force government and force people to withdraw again from economic activity, end quote. He said that there would be loss of confidence if there were to be a failure on the health response here in the United States to contain the virus, as we've seen in states like Arizona, Florida, California, a lot of those cases really cropping back up, arguably not a second outbreak per se, but just a continuation of that first outbreak. A few other kind of interesting points that were in this testimony. One thing that was obviously in view was the Federal Reserve's Main Street lending program, its efforts to offer loans to businesses with less than 15,000 employees or less than $5 billion in annual revenue. The Federal Reserve, which still has yet to actually get any of that money into borrowers' hands, says that it could lower the minimum loan size. It could also include an asset-based test for eligibility over EBITDA, which is something that's being included right now. There's an argument that some businesses might not qualify because they don't have an EBITDA-based kind of business model. And then one other thing that was kind of interesting was that apparently the Federal Reserve and the Treasury were looking at some point at some sort of commercial mortgage-backed security or commercial real estate-backed facility. Federal Reserve and the Treasury ultimately decided not to do that. Mnuchin saying that there were structural issues with that and said if anything were to be done on relieving funding pressures for hotels, for example, that should be something that Congress should do. But regardless, nothing particularly new. It seemed like, if anything, the bigger focus was really on Treasury Secretary Mnuchin for any details on that next fiscal package.
Yeah, and it's interesting, Brian. I think everyone is rightly focused on getting the CARES Act extended and some kind of enhanced unemployment benefits hanging in, because we saw how clean the data was in terms of bolstering incomes. Consumer spending has been pretty solid over the last couple of months, all things considered. But you mentioned the Main Street lending facility from the Fed. It does feel like there's been a gap in how to get money to businesses. I'm not really sure what the solution is, but it's clear there needs to be one, because the PPP ran out today. There was still money that hadn't been taken up yet. So whether it's the conditions on these loans, the way that they're working with banks to get them to businesses, there's clearly a gap, I think, on the business side. And I think everyone is bracing and concerned that there will be a lot of business failures as we get into the second half of the year if that situation doesn't turn around. All right, Brian Chung, thanks for joining the program. We will talk to you, of course, coming up later in the month. Let's take a break now. And on the other side of the break, we're going to talk to Scott Wren of the Wells Fargo Investment Institute about what to make of this first half of the year, the second quarter. Jared had the data earlier, but also where we head over the second half of 2020 and what investors are asking about what to expect in the months ahead. We're coming up with that conversation in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Again, we're closing out an eventful month, quarter, and first half of the year. Joining us now to make sense of it all is Scott Wren. He's a senior global equity strategist at the Wells Fargo Investment Institute. So, Scott, as you kind of look back on what we've seen so far or what we've seen during the second quarter, how are you making sense of the rally that we are going to, kind of codify here, right? This is one of the best second quarters that we've seen for the market really in history. And as you look at the situation right now, is there a way that actually makes some sense to you?
Well, Miles, I tell you, it has been a crazy quarter, and certainly our clients are asking us, how can we have such a major rally when all of the economic news is pretty bad? And so, the market's going to look ahead. Clearly, the market's anticipating that we see some GDP growth as we are in the third and fourth quarter, and then we're back to a modest pace of growth in 2021. But this has been a crazy quarter, and I will say one thing: when you shut the economy down, do you expect a big move down in the stock market? You do, but the magnitude of this rally coming back, and really, we're off the recent highs, but from the March 23rd panic low until that recent high, the S&P 500 was up 47%. So did we anticipate that? We definitely did not. But did we want to put our toe in the water and start buying some large cap stocks and a few other things? We did. So this has been a nice surprise. I think we're probably going to tread water for a little while, but this has been a nice bounce back in the second quarter.
And Scott, when you think about what the market has been pricing in, or I guess responding to, a version of an argument that I've heard quite a bit is that there's nothing negative we haven't thought about yet, right? I mean, every doomsday scenario seems to be on the table and in many ways assumed back in the spring. And so all of the surprises ended up being to the upside. As you look out for the next few months, does that balance of risks, as it were, seem more balanced, or does it still seem like everyone is well aware of all the downside risks and that we're still not appreciating potential upsides when it comes to whether it's employment, consumer spending, earnings, and so on?
Well, of course, on the downside, the negative scenario is we're all sitting at home in September and October, afraid to go out because we don't want to catch the virus. That's the worst case scenario. The market's certainly not anticipating that, but thinking about it. We've all heard about these virus cases, and in your last couple of segments, you guys have been talking about that. But as we look ahead, stocks right now, our year-end target is 3250 on the S&P 500, so we're a little bit below that. But we think we're going to spend some time consolidating. We've got this slight bias to the upside. But then when we look out through year-end 2021, which really we're trying to get our clients to focus on year-end 2021, we're looking for about 3,500. That's the midpoint of our target range for 18 months from now. So really, that's a nice appreciation in the market over that course of time. That's what we want our clients thinking about. We don't want them worrying about what's going to happen over the course of the next month or two. There'll be a lot of noise. There'll be a lot of uncertainty. But over the next 18 months, we think we have a good potential both in the economy and then in the stock market to move higher.
Yeah, and Scott, we've talked to a lot of folks who've said that it's really important to keep in mind the 18-month time frame, and it's certainly everyone says, oh, have a long-term time horizon, but actually sitting there and saying, okay, I'm going to not worry about 2020 earnings and maybe not even the first half of 2021. Are you getting positive responses from clients on that? Are they in agreement that it is fine to maybe sort of look through what we're likely to see over the next 3 to 6 quarters?
Well, that's always, Miles, that is very tough for most retail investors to do. And what typically happens is when you talk to these people in normal times, whatever normal time is now, they'll say, yes, my tolerance for risk is quite high, or at least I have a pretty good tolerance for risk. Then when you see some market moves like we saw over the course of the last 4 or 5 months, and you see these 1,000-point moves in the Dow and the S&P's up or down 50 points, they step back and they say, boy, I think my appetite for risk isn't quite what I thought it was. So this kind of market action, for the most part, it scares retail investors. I mean, when the market just keeps going up, everybody's happy. My phone doesn't ring too much. But when the market's as volatile as it has been, that's when my phone rings. And we talk about opportunities with clients and to take advantage when your forward look is good, as ours is economically. You want to take advantage of these pullbacks and these big down days and these big down weeks. But sometimes it's difficult for retail investors to step in. They have a plan, but they have trouble pulling the trigger on that plan when the opportunity presents itself.
All right, Scott Wren with the Wells Fargo Investment Institute. Always great to get your thoughts. Thanks so much for taking the time.
Thanks, Miles. Have a great afternoon.
You do the same. All right, coming up on the other side of this break, we're watching a market that continues to rise here as we head towards the closing bell. The Dow now up more than 1%. The Nasdaq up 2%. We'll keep our eye on that, and we're back here in just 2 minutes. All right, stocks are ripping higher as we head towards the closing bell. Jared Blickery, the ramp is in full force on this final day of June.
Yeah, so much for that pension fund selling. That was probably happening, if there was any, several days ago. A lot of FOMO into the close here. We're seeing energy, tech, healthcare, and material now to the upside. They're the leaders, and there have been several leadership changes today, which is interesting in and of itself. But Dow is a laggard. Nasdaq here is up 2%. We can see this candle here, a lot of buying into the close, or a lot of market orders. I think you just said 6 billion into the close. Here's the S&P 500 up 1.7%. And the Russell 2000 up about 1.4%. So just a lot of action here into the close. We'll take a look at the NASDAQ heat map. Not many red squares anymore. Still the same leadership here. Xilinx, Tesla, Lulu, Micron, those have been the leaders all day. Some earnings in there, some news with Lulu. To the downside, the travel stocks still lagging. But overall, some nice leadership into the close. Have to see what comes in the coming quarters. But very, very interesting way to end the quarter here. And it's going to be the best for the S&P 500 and the NASDAQ going back to the respective inceptions, and the best quarter in the Dow since 1938. Well, excuse me, quarter two, not any quarter, quarter two.
Best second quarter in the Dow since 1938. And Jared, as they say in the business, great quarter, guys. Congratulations. All right, coming up on the other side of this break, we're going to have the closing bell on this Tuesday afternoon, final day of the second quarter and the month of June. We're back with that in just 2 minutes.
Welcome back to the final round. I'm Shauna Smith. We're just around 20 seconds away from the closing bell, and stocks adding to gains here in the final 15 minutes of trading. We now have the Dow up over 200 points, the S&P up just around 1.5%, and the Nasdaq, it's been the leader all day, up almost 2% here, up around 185, above 10,000, pushing further above that level. Taking a look at the sectors, all 11 sectors are in the green today. Energy leading the way, followed by tech and healthcare. That wraps it up for the trading month, quarter, and also for the first half of the year. The S&P today is securing gains here for the third month in a row, with the S&P up just around 1.5%, the Dow closing up just over 230 points, and the Nasdaq up nearly 2%. Now, it's been quite a quarter for the markets. I don't think that is to anybody's surprise. S&P posting its best quarter here since 98, Dow best quarter since 87, the Nasdaq posting its best quarter since 2001. In terms of the sectors, what we've seen in action here, all 11 sectors closing to the upside here for the second quarter. Consumer discretionary was a standout. It was a top performer for the quarter. In terms of the Dow stocks, what was the top performer? Apple, that stock up over 40% over the last 3 months. I want to bring in my co-host, Miles Udland, here for the hour. And Miles, I mean, it's no surprise to anyone, but it has been quite a run for stocks over the past 3 months.
Yeah, and I mean, I just said it to Jared as we were wrapping up during the 3 o'clock hour. But what do they say on every conference call? Great quarter, guys. I feel like this counts. We can. Great job, everybody, to I guess fix everything with what we've seen in the stock market. But seriously, I think this is a very instructive time to look at. Ultimately, what moves financial markets, right? And what moves financial markets is when things surprise investors, whether that is to the upside or to the downside. In this quarter, investors were consistently surprised by the effectiveness of government policy, the size with which the government acted to alleviate stresses in various parts of the economy. And for most of the quarter, and I don't think it's true anymore, but for the first 10, 11 weeks of the second quarter, investors were surprised to the upside by good news when it came to the spread of the coronavirus. Now, we set up a very interesting dynamic here. We see case counts rising in a number of states in the U.S. In most of the rest of the world, if you back out Brazil and Russia, the coronavirus is largely contained in the Western world. But given what we're seeing here in the U.S., I think there's a lot of questions with respect to the virus as we enter the third quarter. But in Q2, again, there was so much bad news anticipated and expected, and any incremental piece of surprise ended up being a positive. And I think that's why we are mostly back to where we were when this thing started. And the question now is, will those surprises going forward remain positive, or do we re-enter a scenario when negative surprises move into the market? It's not like it was perfect, right? We had a 6% down day in the S&P 3 weeks ago. It hasn't been smooth sailing the whole time, but there was, again, I think when you look back, and this is always the thing, but when you look back, the reasons the market got to where it is now are fairly clear, I think. I don't think it's quite the mystery that it may have seemed during some of those days in April and May when the market felt like it went up every day no matter what.
Well, Jared, what do you make of the action that we've seen? Because obviously volatility is still present in the markets. And when you take a look at what we could expect going forward, we have obviously the election here in just a few months. So that will add a little bit of uncertainty here for the markets as well. So when you couple that with the fact that we are still seeing the number of cases rise in so many parts of the country, how do you think investors will be viewing this as we look ahead to the second half of the year?
I think we're going to see heightened volatility that's probably not going to go away entirely because there's still so much uncertainty, and investors are seeking protection in the options market, but a lot of it's to the upside. We've seen put-call ratios skew violently to one side, to the upside, and then to the downside, always mirroring the wrong side of the market. So investors need to be buying puts when they should be buying calls and vice versa. But here's the VIX on the Wi-Fi Interactive. Here's what happened this quarter. We can see that we did have this spike up on that 6% down day that Miles was just talking about. still at relatively elevated levels above the 30 level. I think it's going to be frustrating for traders. I wouldn't be surprised for the S&P 500 to get back to record highs, but I think there's going to be choppiness both to the upside and the downside, and it's not going to be the easiest market to navigate. There are going to be pockets when it looks like the US is going to kind of roll off to the downside again, and the market's with it. And we're going to see pockets of illiquidity. We're going to see the VIX spike, and then suddenly the market will regain its footing and maybe rally to new highs or new significant highs. And it's just going to be tough to navigate. You got to take this on a day-by-day basis.
And Jared, taking a look at some of the levels here of the major averages, we have the Dow just short of 26,000, the S&P just at 3,100, the Nasdaq pushing further above that 10,000 mark. In terms of some of those technical levels that we should keep an eye on here as we head into the second quarter, what are some of those numbers?
Well, just looking at the S&P 500, and this is a quarter, you can see we ended up 20% to the downside. We got broad support at the 3,000 level. We just touched that yesterday. We've slightly dipped underneath it earlier in the month, but I take this as a positive that we're now breaking out of this negative trend channel, which forms a pennant, and usually this has momentum. Sometimes you get a false breakout, but more often than not in the S&P 500, we get continuation with the longer term trend, which is up in this instance. So we could easily test these highs here at 3,250. Before we get there, probably have to get to 3,100 and change, somewhere in here. It's going to be, I think earnings season is going to help. I think the price action that we've seen in the banks over the last few days has also been constructive. Only Wells Fargo of the major banks had to cut its dividend, and banks really lead the market in this time of year. And just looking at the seasonality, for instance, in the Nasdaq, July has very positive seasonality. Over the last 5 years, it's the only month that has been up every single time. And the S&P 500, going back, I believe, to 1995 or so, so the last 25 years, you take the last 3 days of June and the first 9 days of July, we have an incredibly positive seasonality, something like 85, 88% of the time the market goes up. So market needs to capitalize on seasonality. That's what it has going for it right now. And I briefly mentioned the parallel to 2005 or 2009, and we'll just take a look at this here on the 15 year. So 2009, we launched off the bottoms in March, had a little bit of a stumble in June, which you can't even see here because the chart is so long, but it was in July that we found footing and were able to rally towards the end of the year. No election in 2009, so that is a wild card this year, and also no pandemic, but 2009 had its share of problems for sure.
It certainly did, but we're facing a different scenario now. And I want to drill down into one of the huge factors here that has been driving the markets. And that, of course, is the coronavirus pandemic. And to getting to some of the latest headlines out today, as we see the number of cases continue to rise in the U.S., we have the EU blocking Americans from traveling to Europe, at least for now. And we also had the FDA today releasing guidance here for approving a vaccine for coronavirus. This is something that investors, of course, are watching extremely closely. We have Anjali Kamlani, who has been tracking this story since the start of the year for us. And Anjali, what can you tell us about what the FDA said today, just in terms of the requirements for a vaccine?
Well, Shauna, we did hear, we have heard over time some concerns about what is the FDA willing to do? What is Operation Warp Speed willing to do? And all the bodies involved in terms of pushing ahead a vaccine. And today we got some of those answers, and really looking at what the clinical trial design is supposed to look like, how involved the FDA is willing to be, which, by the way, is very involved early on with these companies, as well as what are they willing to pass through? What will eventually get an EUA, an emergency use authorization? And so we got the answer to that, specifically looking at a 50% efficacy rate. Now that number specifically is really important because we've been hearing, how some vaccines are more effective than others. We've heard Dr. Fauci say that the measles vaccine was about 98% effective, and he was willing to accept about a 70-75%. So the fact that the FDA is looking at a 50% at the very minimum kind of indicates what they've probably already been seeing behind the scenes. Meanwhile, two other things jumped out to me with these guidelines. One is that while there is a focus, obviously, on the older and the vulnerable population, which is very important with this virus, another thing was encouraging. It wasn't a requirement, but it was at least addressing health disparities and encouraging that these clinical trials look at a diverse population, specifically focusing on those minorities that have been adversely affected. And then the third thing, looking at, we've been talking about broadly how these trials are supposed to be designed and what really goes into them. And one of the things to pay attention to really is just how many trials and how far they're willing to go. One of the things about the cases and the spread of it is just how effective it can be when there is enough of a spread. And so a very interesting topic has been challenge trials, which is infecting someone who has been vaccinated to test the efficacy of that vaccine. And that's something the FDA did bring up, saying that it could be considered, though important to note, it hasn't been accepted or authorized just yet. But the fact that they even brought it up sort of gives some weight to the arguments that have going on behind the scenes with public health experts. Shauna?
At least they certainly are thinking about it. Anjali, with the latest on coronavirus for us. Thanks so much. I want to get to some breaking news here after hours. We have FedEx out with earnings. Shares popping here on the results. Miles has the numbers for us. Miles?
Yeah, Sean, a pretty comfortable beat here for FedEx on the top and the bottom line. The company reporting adjusted earnings per share, $2.53. The street was looking for $1.52. So a nice beat there. Revenues coming in $17.4 billion. The street was looking for $16.3 billion. Now, this wraps up FedEx's fiscal 2020. The company says they're not providing an earnings forecast for 2021. Not totally unexpected. We've seen a number of companies do something similar. The company did say that it's targeting its CapEx to be about $1 billion less than it was during this past fiscal year. So $4.9 billion in capital expenditures for fiscal 2021. Again, billion less than the company had planned for in 2020. Company CFO Alan Graf saying the near-term outlook is unclear, but the company does expect to benefit from the global recovery. So, certainly seeing some signs of life there in the global recovery, at least based on what FedEx is saying in their results. Fred Smith, company's CEO, saying that they delivered peak level e-commerce volumes in the U.S. And so it gives us a sense again of what the environment was really like in April. The results show that demand has remained strong, and they mentioned that the residential side of the business has really picked up a lot of slack from the commercial side, but peak level demand. And we heard some commentary from Amazon as well, that really what we saw from the end of March into early April, that was holiday season type stuff. And so again, very interesting just to get this commentary here. The stock certainly higher here, up about 8% in after hours. This stock was at $90 a share back at its lows in early March. FedEx shares bottomed about a week before the broader market bottomed. The stock now trading at around 150. That would be a new post-pandemic or during this pandemic sell-off high for the stock. So we'll watch that through the after-hour session, Sean.
Yeah, Miles, some additional commentary, obviously talking about coronavirus, but he's saying just in terms of their strategic investments that they have made, that they have enhanced their capabilities and also their efficiency. So therefore, they're well positioned, they're saying, to support and, of course, benefit from the reopening of the global economy. But obviously, investors extremely pleased with these results as we see shares moving pretty significantly to the upside here in after hours, up just over 7%. I want to get to some merger headlines that we had out today. Uber reportedly in talks to buy Postmates for $2.6 billion. The Wall Street Journal reporting that a deal could be announced as early as next week. And Rick, I'd love to get your thoughts on this, just because we talked about the fact of Uber pursuing Grubhub a couple of month or two ago, and the big question mark there was regards to some of the questions that they could face in terms of regulations. What do you think they would face if we do see Uber and a Postmate tie-up?
I guess it depends when it would actually get to regulators and what administration that would be. Would it be the Trump administration? This is one industry they have not really shown much interest in regulating. You can ask the question, could this maybe go under the radar because of all the focus on the big tech companies? Regulators at the federal level anyway, kind of can only, they sort of take on one Goliath at a time and don't like to take on more than one that. And of course, States are also focusing on tech for antitrust, Facebook, Google, Amazon. So, I mean, this is basically a distressed sector now. Uber and Lyft, their riders have been disappearing while we've seen a surge in business in the delivery business. So, Uber, it looks like it wants to be the last man standing here. It's the biggest player. It's acting like it wants to stay the biggest player, and it sees this as an expansion opportunity. So I think there's a good chance this will happen.
And Akiko, do you think that Uber needs to do something just in order to kind of grow their Uber Eats business, and especially at a time like this when obviously coronavirus has had such a negative impact on the ride-sharing business?
Yeah, I'm not sure if Uber specifically needs to do it, but there's no question consolidation is long overdue in this space. And we've talked about that a lot. It is just so saturated. And when you think about a company like Uber, to Rick's point, that has been losing a lot over the last 3 months on the ride sharing side and seen huge growth on the delivery side, it makes sense for them to go after a company like Postmates that, by the way, has a huge footprint, especially on the West Coast as well. Strategically, it certainly makes sense. One less competitor down means, one less competition. And we've seen the huge losses in these delivery services as they try to one up each other in terms of the discounts on that front. So strategically, it certainly makes sense. It sounds like we could get some kind of announcement over the next few days. It'll be interesting to see what specifically the numbers are likely to look like on that front.
And of course, Postmates, the smallest tier of the 4 players in the market. They've struggled to keep up with Uber Eats and DoorDash and Grubhub in the past. So we will see if we do have any new developments. Of course, we will be watching that and bringing that to you as soon as we do get that. Well, we're going to take a quick break, but when we come back, we're going to talk about the business of telemedicine with Calibrate CEO Isabel Kenyon. She's going to talk about how she's disrupting the multi-billion-dollar weight loss industry. We have that interview when we're back in just 2 minutes. Welcome back to the final round. I want to bring in our next guest. We have Isabel Kenyon, founder and CEO of Calibrate, a new telemedicine business in metabolic health. And Isabel, it's great to have you on the show. Thanks so much for taking the time, and congratulations on the launch of Calibrate. I understand that it's an entirely digital approach. So tell us how Calibrate exactly works and how you're competing in a relatively crowded market.
Thank you so much for having me, Shauna. Calibrate launched last week as a 1-year digital metabolic reset. The program pairs you with a coach and a doctor to put together a holistic plan for you to reset your metabolic system. So the way you eat, the way you sleep, the way you exercise, the way you manage your emotional health. So you work with the doctor and the coach all via telemedicine, entirely virtually, over the course of the year to move through tiny changes to each of those behaviors.
And when you talk about, obviously, there's a prominence here of telemedicine. You do everything digitally. And as we see, the coronavirus has really accelerated some of those changes, just really in the healthcare industry overall. And Piper Sandler actually was out with a note today. They were talking about the rise in telemedicine, 28% of their respondents using telemedicine in the last 3 months. So to what extent do you think the virus has accelerated this shift and then therefore really transforming the doctor-patient relationship?
We think it's been an incredible shift. So we watched penetration here go from 1 or 2% to 28, 25%. And it's been absolutely remarkable to watch. And I think there's really no going back for consumers now that they understand how convenient it can be, how accessible it can be, and how incredible the quality of care can be. We're really focused on figuring out what are the things that people will share with you digitally that they wouldn't feel comfortable sharing face-to-face, and how do you use those things to provide better healthcare.
And then what about privacy? Because obviously that is so important, especially when you're dealing with people's healthcare and their different health issues. So how are you addressing that to make sure that people feel secure and that they have confidence in this?
Privacy is incredibly important to us, and we built it into the product from the beginning so that we're entirely compliant with local regulations, state-by-state regulations, and federal regulations.
Isabel, what are you offering that's different than what's on the market right now? I mean, it seems like a crowded space already. I know people already struggle with weight loss, even if it's an in-person type of program. What makes this telemedicine approach actually different and more effective?
The real difference with what we're doing is combining two things. So you have lots of programs that do one of each of these things, but you don't have any programs that combine the two. Our program is the first program that combines medication that resets your metabolic system with coaching. And those two things combined say we're going to address the biological, the underlying cause of your weight, not just the lifestyle choices behind it or the willpower choices behind it.
Hey, Isabel, Rick Newman here. How do you keep people motivated? I mean, do you have a track record on this? This seems to be a problem with everything related to weight. Fitness is just, we know everybody signs up for the gym in January and they quit going by February or March. How do you keep people going?
We put together an incredible team of clinicians who have been treating obesity in academic research settings for decades. And we asked them what works, what keeps people engaged. And then we put together a program that reflected that. And so we got experts from eating, we got experts from sleeping, we got experts from emotional health, and we put them together and we said, how do we create content that really engages the consumer and puts it in front of them on a weekly basis so they stay engaged? And so we reward the consumer for coming back week after week and staying engaged with us.
Do you have a track record yet that you can brag about? I mean, can you prove this is more effective at keeping people engaged?
We just launched the business last week, but we have based the business in research that's been published for about 2 decades coming out of Penn on the combination of behavior therapy and medication for weight loss.
Hey, Isabel, I just want to ask you a question just in terms of being a female founder, because we were talking to Jared Tingle of Harlem Capital last hour just about the fact that the still majority of the VC dollars, they are not allocated to female founders or also minorities. So what was your experience when you were looking to raise money? Because I know you recently secured a seed round of $5.1 million just in terms of seed funding.
The real challenge is just finding people who believe in your vision the same way that you do and who will help you and support you along the way to your mission. And so for us, we really wanted to find investors who understood that intersection of consumer and healthcare and understood how challenging it could be to change consumer behavior in healthcare, but also were committed to building new brands and to pioneering new ways of thinking about things. And so for us, when we met Kirsten and our team at Forerunner and when I met the team at Redesign Health, it was really clear that those people really understood consumer healthcare and they really understood where the consumer was going next.
And just in terms of where you're going next, because I know right now you launched in New York, California, Texas, and Pennsylvania. What are your plans for future growth?
We're planning to get to all the states as fast as we can and hoping to be in about 50% of the US by Labor Day.
All right, Isabel Kenyon, founder and CEO of Calibrate. Thanks so much for taking the time. We wish you all the best.
Thanks for having me.
We're going to take a quick break, but when we come back, Biden vowing to get rid of Trump tax cuts, what this means for his wealthy donors and for corporate profits. We have that coming up next. Welcome back to the final round. Joe Biden giving some details last night about what his presidency would potentially look like, laying out some policy goals during a virtual campaign fundraiser. And Rick, he told those potential donors that he would roll back most of President Trump's tax cuts. What do we know about Biden's plan, and what do you think the reception for this will be?
We know a lot about Biden's plan. He published it last year, so this is nothing new. I guess what happened last night is, keep in mind, these are wealthy donors. This is not your average man in the street who's part of a Biden online fundraiser event. These are wealthy donors, and he basically told them what he's already said, which is, you people, among you wealthy people, I'm probably going to raise your taxes, and that's because Biden has said he favors raising the corporate tax rate from 21% to 28%. He raises higher income taxes on people with incomes above $400,000. Higher capital gains taxes, and also higher inheritance taxes. That's all part of his published plan. I think a lot of people probably don't know a lot about Biden's economic plan because they've been preoccupied with the coronavirus and the recession and other things. But Biden himself is bringing it up, so I guess people are going to be learning more about it.
Yeah, and also, Rick, going off that, he mentioned some interesting things. Obviously, he made the point that he wants to beat the virus, clearly, but he was also talking about how he wants to build a stronger and more responsive public health system. He talked about how he wants to invest record sums of money in clean energy innovation and also infrastructure. So how does that stack up, do you think, to what we're going to hear, what we could hear from President Trump over the next couple of months?
Yeah, again, those are all those programs by Biden. They've all been on his website since last year. We just have not been talking a lot about them. He has a whole list of plans. I mean, not as many as Elizabeth Warren, famous for her plans, probably had when she was a candidate, but he's got a lot of things. He's basically taking, he had his own ideas for what to do, and lately he's been taking some of Elizabeth Warren's ideas, some of Bernie Sanders' ideas, and putting together this very large agenda. Trump has been struggling to define what he would do in a second term. He got some attention for an interview he did this week with Sean Hannity on Fox News, where Hannity asked him, what is your second term agenda anyway? And Trump didn't really have a solid agenda. So this is part of Trump's problem. Just because Biden has a clearer agenda than Trump, I don't think that in itself gives Biden a huge edge at this point. It will as we get closer to the election. And you mentioned healthcare. I mean, the Democrats obviously have been trying for a long time to patch the holes in the healthcare system and create better public options for people. Biden does favor an expanded public option. He does want to fix some of the problems with the Affordable Care Act. And Trump's healthcare plan at this point almost doesn't even make sense because it's just repeal the Affordable Care Act, the same thing he said in 2015 and 2016. He's still trying to do that without a plan to replace it. So that does not seem like it is completely in tune with what's happening during this pandemic.
Well, Rick, Joe Biden is now running only against Donald Trump, but in even just the 3 months since it went from, Joe Biden is part of a very large Democratic field until now, does it seem that that his platform, I guess, has moved a little bit to the left? And then would that be another way of saying that the broader Democratic platform, which, under the Obama administration was pretty center left. I mean, it didn't really hew that far off that middle line. That kind of broad, party-wide policies are moving to the left, and at the same time, right? I think Republican policies have moved further to the right.
Yeah, I think you're right, Miles. So Biden, what Biden needs to do is get the votes of supporters of Elizabeth Warren and Bernie Sanders, and that's not automatic just because they all happen to be Democrats. I mean, there were a significant enough group of people who supported Bernie Sanders in the primary elections in 2016, but then went on to vote for Donald Trump. The Democratic Party knows that now, so they want to make sure they don't lose those so-called Sanders to Trump voters. So yeah, Biden has tacked to the left a little bit. Green New Deal, he now embraces the Green New Deal, although not all the specifics of it. That's the huge climate plan that some of the progressive Democrats had. He also said earlier this year, I think, he'd be fine lowering the eligibility age for Medicare from 65 to 60. That is starting to sound like Medicare for all. I mean, it's which is the big health care plan for everybody that would eliminate private insurance. Now, Biden has said many times, no, he wants to keep the private insurance system in place. But look what he's doing by making it easier for younger people to get into Medicare, he's kind of creating a pathway toward Medicare for all. So for sure, he's doing what you just suggested, which is trying to appeal to everybody in the Democratic Party and independents.
It certainly is. And then he's also getting criticism from people who are more down the middle, just in terms of they think that he's going too far left at this point. So it'll certainly be an interesting next couple of months as we lead up to the election here in November. All right, well, we're going to take a quick break, but when we come back, the housing market getting another piece of data today. Home prices rising in the month of April. We're going to talk to the CEO of Coldwell Banker about the rise in prices and also about how the housing market is changing in wake of COVID-19 outbreak. We'll have that when we're back in just 2 minutes. Welcome back to the final round here on Yahoo Finance. Stocks closing what has been the best quarter here in decades for the market. The S&P posting its best quarter since 98, the Dow's best quarter since 87, and the Nasdaq's best quarter since 2001. We have Jared Blickery, who's been watching this very closely for us, who has the latest. Jared.
Yeah, not trying to rain on any parades here, but we were coming off extremely depressed levels on March 23rd, and then we had this huge bounce. So timing is everything, especially when it correlates with the calendar quarter. But just looking at the Dow here at the Wi-Fi Interactive, up nearly 18%, Nasdaq up much better, over 30%, S&P 500, let's see here, 20%. And there was a lot of choppy sideways action for a lot of this time. You could even argue that we're still in some chop right here, even though we're just now breaking to the upside again. And we're not even at the highest point in the quarter. So very impressive gains here. Here's a Russell 2000 up 25%. And then I just want to hit the Philly Semiconductor Index, because this is practically a new high here. Here are the old record highs, almost there. That's up over 32%. And off of those Micron and Xilinx earnings that we got yesterday after the bell, really had a nice pop in chip stocks. So here's the Nasdaq, but we're going to take a look at the Dow. We did the Nasdaq before. Here's what's happened over the quarter. You can see nice gains for Apple, up 43.5%, Microsoft 29%, software doing very well. Sorting by performance, Apple is in the lead, followed by Dow, up 39%. Materials had a nice quarter. A lot of that has to do with some of the commodity space. Gold only today closed at the highest level since 2011 and finally punched above 1800. Then you look down the line, Home Depot, the home trade, kind of the rebuilding trade in play there. Microsoft up 29%. Goldman Sachs coming in at the rear. Financials had some nice spouts during the quarter, but I just want to highlight, it's been frustrating for a lot of traders because we've had so many leadership changes. And when we saw value in cyclicals surged so much in what is essentially, or could have been, a short covering rally, a lot of people were left behind. So shorts were covered and not a lot of people necessarily in those stocks. But if you were in the tech stocks, especially chips and software, you've done pretty well. If you're in the travel names, a lot of these have done well too, but from those very depressed levels. And it remains to be seen if they can continue that kind of performance. And for all the talk about Hertz, down 77% for the quarter. So you got to be really tricky. Unless you time this little bounce here around the bankruptcy perfectly, probably sitting on some losses, Shauna.
Jose, maybe you shouldn't play the bankruptcy names. There's some smarter bets out there. Jared, thanks so much. Let's turn to the housing sector. We had some data out this morning. S&P Case-Shiller reporting that home prices actually rose in the month of April. For more on this, I want to bring in Ryan Gorman. He's president and CEO of Coldwell Banker. And Ryan, great to have you on the show. Let's talk about that rise that we did see in housing. We also had the massive jump yesterday in pending home sales, although it is important to point out that it was from extremely depressed levels. But what's your take on the recent data that we've gotten? And also, is it consistent with what you're seeing from your clients?
Well, thanks for having me. And yes, the data is definitely consistent from what we're seeing. What we're seeing with Coldwell Banker agents out in the field is over 90% of our agents are telling us that their markets, this is across the United States, have a shortage of listing, and over 80% are saying that there's pent-up demand, meaning more listings coming onto the market could actually pull more demand forward. So what you're seeing appear in the numbers is definitely what we're also hearing anecdotally.
So Ryan, you say 90% of your agents are experiencing some sort of shortage of listings. So that, of course, will explain this pop that we're seeing just in terms of pricing right now. But when we talk about some of those dynamics that are at play in the housing market right now and this trend that we are seeing in terms of price, do you think that this is a trend that you expect to continue here, at least in the short term?
It is. It's actually a trend that we had predicted early on in COVID-19. We did a lot of consultation with our agents as well as some consumer surveying, and we held an event a few months ago where we talked about us seeing the value of home being more understood today than ever, a lot of government support being plowed into the market, interest rates remaining extremely low, in fact, hitting historic lows. All of that coupled together with high equity in home properties and rigorous underwriting leading to a place where we did not think there would be a big spike in foreclosure activity. It seemed like it had all the ingredients to hold up very well, despite the incredible economic headwinds.
Hey, Ryan, Rick Newman here. This seems to be, the nature of this recession seems to make it more of a renter class recession than a homeowner class recession, if you know what I mean. Do you have a way of measuring what's happening in the rental markets, whether there is stress or distress there? I mean, those seem like they could be a lot of the workers who have been furloughed. Maybe those layoffs are going from temporary to permanent, who are going to start having trouble making their rent payments.
Unfortunately, I think you're right. This recession certainly is hitting harder a lot of the service jobs and a lot of the individuals who are more likely to be renters than owners. Fortunately, there's been significant government support there, as well as some of that incremental unemployment assistance for those who are on furlough or who were permanently laid off. We're a large property manager, but we certainly consult with a lot of others who are apartment owners or managers. And we're seeing softness in rental demand, but relative to what you might expect, strong payment processing. So we are seeing people able to make their rental payments, but we're certainly seeing, especially in the hottest of markets, softening of rental demand. It's starting to show up in the asking rental prices, but it's more the overall demand for the properties.
Ryan, in terms of home buying, who's benefiting, or which markets are benefiting the most from this push to work from home? I mean, we keep hearing there's a lot of people moving to the suburbs, but I'm curious just what you're seeing on the ground, how quick that shift has been.
Well, we certainly saw a lot of increase in, to the earlier point, renting, but in the suburbs, and renting single family homes as opposed to some of the multifamily rentals early on in COVID. What we saw shortly after that is in the most dense of cities, the inner rings around those, especially the higher value properties, including some of the luxury properties that candidly had sat on the market for longer, for instance, in the northern New Jersey suburbs pre-COVID, were moving very briskly. And today what we're seeing is moving from a place of a listing that may have been, say, 45 minutes outside of the city, may have taken a few months to market and appropriately sell. Today, we're seeing multiple cash offers on a property like that. That's not to say everyone is leaving the city. It is to say there's enough incremental demand, and it doesn't take much to create a different market for that individual property.
And then Ryan, thinking about the way the industry has digitized over the last few years, obviously a lot of your agents haven't been allowed to show homes in person, or maybe they are recently, but they spent months where they had to do it digitally. Do you think that this is changing maybe what buyers expect the experience to be like? Is there a class of buyer now, maybe someone who's closer to my age, who just says, well, you know what, if I can't see the home in person, it's fine. Virtual tour is fine. Show me a floor plan, show me an inspection certificate, and then we'll just move on from there.
Yeah, we are seeing about 1 out of every 5 or 1 out of every 4 of our agents reporting that they have sold a property sight unseen. However, I want to caution too much exuberance around that. I think that's more likely to happen on the rental side than the purchase side. And today what's happened is we've worked with a lot of governments to help them understand that a transaction can be done safely and confidently, even in a COVID environment. So this is unlike some other industries where it's difficult to imagine a lack of person-to-person contact. Here you can safely distance from one another when reviewing property and even closing a transaction. We've also moved very aggressively towards that digital closing. So we've gotten a lot of our individual states that were resistant to a purely digital closing on board with the purely digital transaction. So those two things coupled together, I think, will change expectations of the buyer's experience, but I don't think we're going to see an overall shift from people needing to see a property, to walk the yard, to walk through the property, and to really understand it before they ultimately transact. I think it'll happen in the edge cases, but for the most part, they can do so safely, and I think they will.
Hey, Ryan, I'm wondering if the enough people are leaving urban markets, if it's softening up enough there, that's where you might find buying opportunities. If COVID drags on and we don't have a vaccine as soon as some people would like to think we might, I mean, this could feel like a real slug by, let's say, this time next year. I'm wondering if that could be a buying opportunity if you're willing to take a chance on an urban property and wait it out.
I think you're right about that. I would never want to peg the bottom of a market, but there are a lot of people who've lost a lot of money betting against places like New York City over the years. And I think that's probably a relatively safe bet that there'll be some of that today as well. So inevitably, there's a clearing price for every property. Today, properties are still being sold in some of those markets that you might think people are fleeing. There have been a lot of good survey work done by Coldwell Banker as well as other groups in some of those cities. And what you're finding is the vast majority of people who wanted to make their home there are staying there. But to your point, they may be looking for an opportunity to upgrade their living situation as they see a little bit of a softness in a market that's been very strong for a very long time.
And Ryan, you mentioned the exodus that we're seeing out of the city, but just in terms of the fact that you have agents nationwide, where are the areas that are the strongest at this point?
Well, it's interesting. It's shifting over time. At first, the areas that were the weakest were those that were the lockdown the hardest, not necessarily where the virus was strongest. And some of the greatest strength was in markets as juxtaposed as Columbus, Ohio, and Hawaii. Those are two opposite ends of the spectrum in many different ways, but we saw relative strength in demand and supply sort of being somewhat disjointed in those two places. Today, the strength overall, I would say, is the prior trends of people wanting to move to some of these sunnier and perhaps lower tax states is increasing. There are more people who aren't necessarily thinking that they're going to work completely from home, but are seeing an opportunity to work more remotely, who are taking an opportunity to accelerate some life plans. So if they had planned on moving 3 or 5 years from now from New Jersey to North Carolina, they may accelerate that life plan, look for the property now, and shift a little bit sooner than anticipated.
I think we've all spoken to people in our lives who are doing exactly that. So it's pretty interesting to hear that from your point of view as well. Ryan Gorman, Coldwell Banker, President and CEO, thanks so much for joining us today.
Thank you for having me.
We're going to take a quick break, but when we come back, keeping food supplies safe is a major priority for restaurants amid the coronavirus outbreak. We're going to talk to the CEO of a company that's helping fast food chains like Domino's and Taco Bell navigate the pandemic. We'll have that interview when we're back here in just 2 minutes. Welcome back to the final round. I want to bring in our next guest. We have Vlad Richter. He's CEO of ZenPut, which helps the restaurant chains and grocery stores automate their operating procedures. So, Vlad, great to have you on the show here today. The restaurant industry obviously has been hit significantly hard by the coronavirus outbreak. So, talk to us about how your technology is really helping those restaurants reopen and then also just manage their operating procedures.
Yeah, thanks, Sean. Thanks for having us on today. So we've been working with large restaurant convenience store chains like Domino's, Chipotle, 7-Eleven for a number of years now, and we help them throughout the day for their general managers to be able to track, the execution of COVID initiatives around cleanliness, sanitation, to make sure food is being prepared and handled safely. And so what we've seen over the course of the last few months has been an increase in the amount of activity that they're tracking along the lines for, checking employee wellness, making sure that the place is relatively clean for everyone that's coming in here, and more importantly, trying to communicate out all the different initiatives that are happening from state to state and city to city. Because needless to say, it's a moving target across state lines and across municipalities at all times.
It certainly is. And Vlad, obviously these procedures are very important, especially in the midst of a pandemic. And I know your clients include big names like Domino's, Chipotle, Sweetgreen, Taco Bell, just to name a few. So what are these restaurants seeing demand-wise? Because I know you help them with their food supply, because some of the data that we've been getting is conflicting, because some is telling us that, hey, people can't wait to get outside. They're going to those restaurants. But then there's also that are saying that people are a little bit hesitant now to venture outside of their homes.
Yeah, so we've been seeing actually pretty phenomenal support in the last few months. We, starting from the close of COVID, in the QSR and fast casual segment, we saw about 15% of the locations that we support shut down, and that bottomed out right around the middle of April. As of right now, from what we're seeing within our customer base, they're open, right? And I think a lot of us as consumers, I've got 2 kids at home, so being locked up in a 1,500 square foot house for the last couple months has now asked us to want to get out a little bit more and try some food as opposed to our own cooking. We're seeing everyone open up, and we're seeing volumes go through, making sure that they're sustaining the restaurant level. The casual dining segment and the full service segment a little bit different. We saw about 35 to 40% shut down within a couple of weeks. I think it was right at the end of March, beginning of April. We're starting to see them open back up, and we started to see them open back up at the beginning of May. And I think the main driver has been that a lot of people had to sit down and try to figure out delivery. They had to figure out pickup and takeout as a new method for them that they didn't have before. So they're open. They're definitely servicing customers. They just may not be servicing them at the same levels that they were before, and maybe not even in the dining facility, more about taking food away from their environment instead.
Hey, Vlad, Rick Newman here. A couple of questions about different segments. So most of the chains that people are familiar with, the sort of well-known brands, are they all equipped to survive this financially when you're talking about the quick serve segment? And then when you get into the full service restaurants, that seems to be just a perilous situation, because we're talking about stores that typically have a single-digit profit margin, and now you're telling them you have to operate at 50% capacity. And it seems like there's no way they're going to make that up on takeout and stuff like that. So how treacherous does that look in the full service sector?
Yeah, look, I think without a doubt that's going to be painful. As we've seen both from the public filings from some of the fast casual and fast food environments, they're doing really well, right? Papa John's had come out and said that their best month ever, I think, in terms of jump year over year was either April or May. They were up 29 or 30% year over year, something along those lines. And so we're seeing tremendous support from those areas. They're more affordable for people to eat at. They're a little bit faster to pick up, and they're really set up for that environment. I think for the casual dining segment, I think it's going to struggle. I'm worried about individuals wanting to go back into those environments. We talk to operators on a regular basis that say, listen, we're doing well, we're doing as best as we can, but the reality is that they may have a 7,000 or 8,000 square foot facility that they just don't need to use 50% of it for, right? So I think you'll start to see a little bit more on the casual dining segment, where some of them will start to open up smaller footprint locations for delivery purposes only. Buffalo Wild Wings came out with that, I think it was a few months ago, right as the first COVID portion happened. They opened up a 1,500 square foot facility to do delivery only. And it'll be interesting to see who else starts to kind of navigate in that direction. I think if they've got the cash on the balance sheet, they can weather the storm. I think on the independent restaurant, it's going to be very difficult.
Vlad, I guess this is kind of picking up on that point. We've seen in some cities sort of this stop and go process, the reopening, and then only to realize things are going to be pulled back. You look at a place like New York City. Now they were planning to start the indoor dining, or even New Jersey, and they're saying, look, we budgeted for all of this. We had all the food prepped, and now we have to pull that back. What does that mean from a cost perspective? The uncertainty of the back and forth, and then not being able to see how much inventory they need.
Yeah, look, in the conversations that we've been having with operators, it's going to be a struggle, right? Initially, what ends up happening is if you've had your restaurant or location shut down for a little bit, you've got to build inventory back up. So immediately, you've got to turn around and place an order for $5,000, $10,000, $15,000 worth of goods that you want to service in your environment. And if 2 weeks later you're being told you've got to turn around and shut down again, you've got basically two options. Either you're going to be tossing that food out, or you need to find a way to potentially sell it in bulk. I think it was there's some chains that have been clever and tried to find a way to kind of act as wholesale grocery distributors to consumers. But without a doubt, that'll make it a little bit more painful. And on the flip side of it, if for some reason business actually takes off, you might not have the inventory to service people, right? So there might be times when you as a consumer walk up to a restaurant and they potentially might not have something in place there that they typically would.
Vlad, what's demand been like for your product? Because it seems like this technology would be extremely helpful at a time like this when so many of these restaurants are, like you were just talking about, facing this uncertainty. And then, of course, now with this rising risk of a second wave.
Yeah, so we've been pretty fortunate on our end. I think what's happened is that for a lot of these brands, they were planning to go through a digital transformation process. They wanted to get to a new state where they're using technology to be a little bit more agile. What happened with COVID was that it forced them to kind of jumpstart that process a little bit longer, right? Because all of a sudden, instead of rolling out a new procedure, rolling out a new marketing initiative, rolling out a new program, once a month or once every 3 months, you're doing something new, if not every day, every single week. And to be able to communicate that effectively, to be able to track the execution across all those locations, that's not easy. And so for us, what's happened is that folks that typically would have an engagement process that might be a year out from now have all of a sudden sped up and saying, look, we've got to get something out the door before the end of the summer, before the end of the year. So in a lot of ways, fortunately for us, there's been some benefit, given the sort of unfortunate circumstances of COVID.
Vlad Richter, CEO of Zenput, great to get your perspective on the show. Thanks so much for joining us today.
Wonderful. Thank you, Shauna.
We're going to take a quick break, but when we come back, we'll take one more look at today's big rally. And then, of course, the performance that we have seen over the past 3 months and what that means as we look ahead to the second half of the year. We'll have that when we're back here in just a couple of minutes. Welcome back to the final round. Today marked the end of the quarter, the first half of the year, and of course the month here for the markets. Stocks getting a boost in the final 15 minutes or so of trading as the markets recorded their best quarterly performance in decades. And Miles, when we take a look at what this could mean just in terms of what to expect going forward, I think the consensus, though, is the fact that the econ data continues to lag, obviously, the market performance. We could be in for some more volatility.
Yeah, I mean, I think, and I've thought about this a lot with respect to the economic data, as you mentioned. We always know it comes in on a lag, but in normal times that doesn't really matter. But when the situation with the virus changes on a daily basis, I think what you assume is going to happen needs to be revisited probably more often than in the past. And I think that was really the challenge for investors who got caught flat-footed at the beginning of this rally. There was a view that things would never get better. And well, they did get a little bit better, but maybe there was a sense at the beginning of June that the situation was under control. And we'll just look around what's happening in the country now. Pandemic is not under control. This isn't a second wave. This is still the first wave. And so I think it's just imperative that investors continue to reevaluate the assumptions they've made about this period, because I think there was definitely a large group of folks who didn't do that expediently in the beginning of this quarter. And so I think that's really the name of the game as we head into the second half of the year.
It certainly is. There will be a lot of uncertainty and, of course, maybe some volatility, I should say, over the next couple of weeks and months. But again, it was quite a quarter for the markets. We had the S&P posting its best second quarter since inception back in 1957. Nasdaq, that was the case since 1971. Dow, the best second quarter since 1938 in terms of the best overall quarter performance. S&P posting its best quarter since 98. Nasdaq, best quarter since 99. And the Dow's best quarter since the first quarter of 1987. Well, that does it for us today on the final round. Thanks so much for joining us. We'll see you back here again tomorrow. Have a great night.